Greetings and welcome back to the lesson. The subject is Introduction to Law and Governance. We today going to study compliance obligations. But first of all, we define compliance. Now, compliance candidate is the act of adhering to and the ability to demonstrate adherence to mandatory requirements. The law requires companies to do certain things or not to do certain things. So the act of obeying the laws, the act of obeying the regulations is what is known as compliance. The act of adhering to mandated requirements that are defined by law, that are defined by regulations, as well as voluntary requirements resulting from contractual obligations and also internal policies of the company. And compliance mainly operates at two levels. One is compliance with the external rules that are imposed upon an organization as a whole. Then the second level of compliance is compliance with internal systems of control that are imposed to achieve compliance with the externally imposed rules. So compliance can be seen from two levels or two perspectives. That is the compliance with the external rules, then compliance with the internal rules or regulations or internal systems of control. Now, candidates, compliant organizations need an effective approach to verify that they are in conformity with the external standards or regulations and also internal policies. A company that complies, what I'm calling a compliant company, needs an effective approach. There has to be a system in place to verify that the company is adhering to rules and regulations. There has to be an approach because we know candidates, companies operate within a certain legal environment. Companies are expected to adhere to many laws. Many laws have to be adhered to. So it's important for an organization to have a system or an approach which can help the company in verifying if the rules are being adhered to. And such an approach or a system is assisted by what we call risk management. Risk management, which must identify and prioritize risks that are already aligned with corporate objectives defined by governance. So compliance with law and regulation must be managed as an integral part of any corporate strategy. And the board of directors and management must recognize the scope and implications of laws and regulations that apply to the company. They must establish a compliance management system. Compliance management system. Compliance management system. There has to be a system in place to verify that the company is adhering to rules and regulations. And that's the role of the board. The board and the management as well must recognize the scope and implications of laws, the scope and implications of regulations that apply to the company. They must establish a compliance management system. And this compliance management system is a system that helps support the risk management system. Because when a compliance management system is put in place and there is a risk management system that is also put in place, that reduces compliance risk to a great extent. Compliance risk management, I mean compliance risk candidates is the risk that the company or the risk that the company may face as a result of failing to adhere to regulations and laws. And to ensure an effective approach to compliance, the participation of senior management in development and the management of compliance program is necessary. They should review the effectiveness of its compliance management system at periodic intervals, so as to ensure that it remains updated, so as to ensure that it remains relevant in terms of modifications, in terms of changes in the regulatory regime, including acts, rules, regulations, and so on. And also due to changes in the business environment. Compliance what? Obligation. So in today's lesson, candidates, we will study the approaches of compliance. We are going to study 3 approaches or aspects of compliance. Aspects of compliance. The first aspect is legal compliance. The second aspect is corporate compliance. Legal compliance, corporate compliance, and also the third one is regulatory compliance. Regulatory what? Regulatory compliance. 3 aspects. Now, legal compliance, candidates, is the process of, or the procedure to, to ensure that the procedure that the company puts in place to ensure that the organization follows relevant laws, relevant regulations, relevant business rules, and so on. Legal compliance, I repeat, is the process or the procedure to ensure that an organization follows relevant laws, regulations, and business rules. Okay? Failure to which will, failure to ensuring that the company complies to laws and regulations and business rules, then there is that what we call a compliance risk. All right? There has to be an approach or a process through which the organization checks or verifies that the company is obeying or adhering to regulations, adhering to laws, adhering to business rules. And there are 2 requirements for an enterprise to be compliant with the law. That is we may have the policies, all right? The organization's policies, and that need to be consistent with the law. Then we also have its policies that need to complete with the respect to law. So there are two aspects: the policies that ought to be aligned with the law, and also its policies that need to be complete with respect to the law. So the role of legal compliance has also been expanded to include self-monitoring. To include what? To include self-monitoring and the monitoring of the non-governed behavior. And that is mostly in respect to industries and also corporations that could lead to workplace indiscretions. So there are certain aspects that are not regulated, but which could lead to risks. The organization should ensure that such areas are also looked into. So the role of legal compliance, I'm saying, has been expanded not only to laws, explicit laws, but also the non-governed areas with the industry and corporations that could lead to problems at the workplace. And it is also important to keep in mind that if a strong legal governance component is in place, then risk can be accurately assessed and the monitoring of legal compliance can be carried out efficiently. And therefore, companies today are challenged to comply with laws and regulations while also increasing shareholder value and protecting the brand of the company. Legal compliance with laws, regulations, and business rules, now expanded to cover areas that are not regulated. Then there is corporate compliance. Corporate compliance. Now, corporate compliance program, on the other hand, is generally defined as a formal program specifying an organization's policies, procedures, and actions within a process to help prevent and detect violations of laws and regulations. So this is limited to a certain process within the organization. And it goes beyond a corporate code of conduct, since it is an operational program. It's not just a code of conduct. No, it is a program. It is a program. It could be a program that is used in carrying out a certain operation, or what we can just call an operational program. It's not just adhering to a code of expected ethical behavior, no. Because clearly, candidates, a code of conduct is an important component of compliance program and ethics, which remains the heart and the soul of all corporate compliance programs. However, a comprehensive program goes further by applying the code to the specific risks of organizations and also integrating measures to address those risks. So a more integrated approach also focuses on legal as well as internal compliance to mitigate the risks of fraud, to mitigate areas to do with strategy, operations, the financial reporting objectives, and so on. So a corporate compliance program is a magnet that brings all of a company's regulatory and internal compliance requirements, as well as a roadmap to action. A roadmap to what? To action. It is a comprehensive program that helps position a company to divert disasters, to meet objectives, and grow shareholder value. Corporate compliance. Then the other aspect of compliance is a regulatory compliance. Regulatory compliance. Now, candidates, regulatory compliance is an organization's adherence to laws, regulations, guidelines, and specifications that are relevant to its business. And violations of regulatory compliance regulations often result into what we call legal punishment, including penalties, including fines, and such like. So regulatory compliance has become more prominent in a variety of organizations today. And we have seen the trend towards creation of positions within the company, like the chief regulatory compliance officer. Such a position is used to hire employees whose sole focus is to make sure that the organization conforms to stringent, complex legal mandates. So regulatory compliance varies not only by industry, but also by location. And the financial, the research, the regulatory structures in one country, for example, may be similar, but with particular difference in another country. So there could be similarities and differences, which often lead to changing of objectives, changing of requirements in different countries, in different industries, and also different policy contexts. So regulatory compliance, we have bodies that regulate the conduct of companies, like the stock exchanges. They have regulations. We have capital markets authorities. They regulate certain industries. So each industry could have some bodies that put in place measures or laws that companies within that industry should adhere to. Legal compliance, on the other hand, mainly these are laws that are put in place by the government through statutes, statutory instruments, and so on. So these are three major aspects of compliance: legal compliance, corporate compliance, and regulatory compliance. So that will mark the end of the lesson. I'm going to give you one question. Explain assignment. Explain the following aspects of compliance in the context of corporate governance. A, legal compliance; B, corporate compliance; C, regulatory compliance. Thank you for attending today's session. Bye-bye. Hello and welcome to the lesson. The subject is Introduction to Law and Governance. We continue with the topic Introduction to Corporate Governance. In our previous sessions, we defined corporate governance as the way in which corporations are controlled and managed and also directed. In today's lesson, we will study the role of stakeholders in corporate governance, the role of stakeholders in corporate governance. Candidates, we know that organizations cannot achieve their intended objectives without involvement of various stakeholders. For a company to achieve its objectives, then it requires the input of various stakeholders, like the shareholders, the management, the employees, the suppliers, the customers, the government, and so on. In today's session, we are going to study roles of stakeholders, specifically the shareholders, the directors, and the government. We will restrict our study to three stakeholders. Number one, the shareholders. Number two, the board of directors, and the government. Let's begin with the shareholders. What is the role of shareholders in corporate governance? What is the role of shareholders in corporate governance? Now, candidates, shareholders of a company both jointly and severally, are expected to protect, preserve, and actively exercise the supreme authority of the company in general meetings. The voice of the shareholders, as far as corporate matters are concerned, is to be expressed in the general meetings. They have a duty jointly and severally to exercise supreme authority, because shareholders are the owners of the company. Shareholders appoint the directors to run the affairs of the company on their behalf. So they have certain duties to perform in relation to corporate governance, which is said corporate governance is a way in which corporations are managed and directed. So what is the role of the shareholders in directing and managing a corporation? Number one, shareholders have a role to ensure that the directors who are appointed are persons that are competent and reliable, persons who can add value to the company when elected or appointed. So directors, or the board of directors, is a group of individuals who are appointed by the shareholders. So that is the first important role of the shareholders, to appoint the board of directors. And when appointing board of directors, the board should comprise of individuals who are competent and reliable. So when appointing the directors, the shareholders ought to ensure that the individuals who they are putting in office are people who will discharge their functions as required. They ensure that only competent and reliable persons are appointed. So their role is to ensure only competent and reliable persons or individuals are appointed to the board. To ensure only competent and reliable persons are appointed to the board. That is supreme authority of the shareholders, to ensure only competent. Competent means persons who have the required skills, persons who have the required experience. So when appointing these board of directors, they should be persons that have the relevant skills, relevant traits to discharge the functions of a director on a board. Now, the second role of shareholders in corporate governance is to ensure that the board of directors is constantly held accountable. To ensure that the board of directors are constantly held accountable, because they ought to account their responsibilities to the board. So the shareholders should ensure that the board of directors are constantly held accountable. They are constantly held responsible for the efficient and effective governance of the company. All right? Held accountable and responsible for the effective and efficient governance, right, of the company. Efficient corporate governance of the company. Corporate governance of the company. So the shareholders should ensure the board of directors are constantly held accountable and responsible for the efficient and effective corporate governance of the company. All right? What is the third role of shareholders in corporate governance? Is to change the composition of the board of directors that do not perform to expectation, where the shareholders have appointed the board and the board is not discharging its functions as required, then the shareholders have a role to change the composition of the board of directors. To change the composition of the board of directors. To change the composition of the board of directors that does not perform to expectation. All right? That does not perform, because when the board of directors are appointed, there are certain expectations. They have certain duties that they need to perform. They have certain responsibilities. When they do not perform to the expectation of the company or the board of directors, or to the expectation or in accordance with the mandate of the corporation, then the shareholders have a duty to ensure that they are removed from the board. Where directors are not performing or discharging their functions as they ought to discharge their functions, the shareholders have the duty to ensure that they are removed from the board so that more competent and reliable directors are appointed. Confidentiality is another role. Confidentiality. Shareholders, candidates in a limited liability company are obligated to protect and maintain the confidentiality of company secrets. Shareholders of a company, by virtue of their position, may or will come into contact, will have access to certain information that may be considered secret, company secret. And such information should not be disclosed to third parties. And therefore, the shareholders have a role to maintain confidentiality. They are obligated to protect and maintain the confidentiality of company secrets. Now let's move on to the second stakeholder. The first stakeholder is the shareholders. The second stakeholder is the board of directors. 2, what is the role of board of directors in corporate governance? Now, the board of directors exercise all the powers of the company subject to the limitations contained in the law and the memorandum and articles of association. That means that the powers or the duties or the responsibilities of the board of directors is limited to what the law says, is limited to what is contained in the memorandum and articles of association. And therefore, one of the roles of directors in relation to corporate governance, number 1, is that they exercise leadership enterprise. Exercise leadership board of directors exercise leadership. They do what? They exercise leadership. They are also expected to make sound judgments in directing the corporation so as to achieve continuing prosperity and to act in the best interest of the enterprise while respecting the principles of transparency and accountability. They exercise leadership, they act, they make sound judgments, and when exercising leadership, they're supposed to exhibit high levels of integrity, because these are individuals who've been entrusted with the duty to steer the company to prosperity. So exercise leadership. The second role of board of directors in corporate governance is to ensure that through a managed and effective process, board appointments are made that provide a mix of proficient directors, each of whom is able to add value and bring independent judgment to bear on the decision of the company. Independent judgment. They have a role to bring independent judgment. The board of directors exercises its functions through board meetings. When decisions are to be made, the board sits, and therefore, the directors who sit on the board are expected to bring independent judgment, which is expected to bear on the decision-making process. Independent judgment is a judgment that should be objective. Judgment should not be biased. Judgment that is in the best interest of the company. Judgment that is free of conflict of interest. The third role of board of directors in relation to corporate governance is to determine the corporation's purpose and values. Determine the corporation's purposes and value. To determine the corporation's purpose and value, to determine the strategy to achieve its purpose and also to implement its values in order to ensure it to ensure that it survives and thrives, and ensures that procedures and practices are in place that protect the corporation's assets and the reputation of the corporation. To determine the corporation's value, to determine the corporation's purposes, and to ensure that there is a strategy in place for implementation of the purposes and the values of the company. To monitor and do what? And implement. To monitor and implement. To monitor and evaluate the implementation of strategies. Monitor and evaluate implementation of strategies. First of all, the board envisions. The board envisions or comes up with the what we call a picture of what the company should be in future. The board determines the strategic direction of the company. The board develops strategies, and then the strategies are to be implemented by the management on day-to-day basis. So they come up with a vision of the company, where the company ought to be and all that. they come up with strategies, but the implementation is carried out by the management. And therefore, the board of directors has a role to monitor and evaluate the implementation of strategies. Okay? To do what? To monitor and evaluate the implementation of strategies, the implementation of policies, and management performance. Policies and management performance. These directors are monitored by shareholders. And these directors monitor the management. So it's a very key role that the board of directors plays in corporate management, that one of evaluating the implementing of strategies, policies, and also evaluating the performance of management. Number 5, the board of directors should also ensure that the company complies with various laws to ensure compliance to various laws, regulations, and so on. Ensure that the corporation complies with all relevant laws, regulations, codes of best practices, and so on. Regulations, codes of best practice, like the one we are studying. We are studying the code of corporate governance, which is a set of guidelines on how corporations are to be managed. So the board of directors should ensure that the company complies with the laws. These are laws that are put in place by the government, the acts of parliament, the taxation laws. There are also regulations that are put in place, like authorities like the capital markets authorities, the securities exchanges, and also the codes of best practice. The board ensures compliance to such laws. The next role of directors in corporate governance is to ensure that the corporation communicates with shareholders. The corporation communicates. Is to ensure the corporation communicates with stakeholders. To ensure that the corporation communicates with the stakeholders and the shareholders and stakeholders effectively. Effectively. There ought to be communication. The company is required to communicate with all the stakeholders. The government, the shareholders, the financiers, the customers, and all that. There has to be proper communication, because candidates, we know that the company cannot achieve or attain its objectives without the input of different stakeholders. Number 7, the board of directors serves the legal interests of the shareholders. That's another role of the board of directors, to serve the legal or the legitimate interest of the shareholders and the corporation, and also to account to them fully. Serves the legitimate, let me use the word legitimate, to serve the legitimate interest of the shareholders. They have a role to do what? To serve the legitimate interest of the shareholders. So these are 7 These are 7 roles. Let me add another one, 8. Regularly review processes and procedures. Board of directors have a role to regularly review processes and procedures. And why should the board regularly review and review processes and procedures? So that the board can ensure effectiveness of its internal systems of control, so that decision-making capability and the accuracy of its reporting and financial results are maintained at a high level at all times. So the processes and procedures of the company ought to be regularly reviewed by the board of directors. Number 9, appoint the CEO, Chief Executive Officer. It is the role of the board of directors to do what? To appoint the Chief Executive Officer of the company. And they should at least also participate in the appointment of senior management to ensure the motivation and protection of intellectual capital intrinsic to the corporation. Remember, candidates, corporate governance refers to the way in which an organization is managed and directed. The chief executive officer of a company plays a key role in proper management of a company. The chief executive officer is the one who is in charge of the day-to-day operations of a company. Then, if that be the case, then the board of directors should be responsible for the appointment of such an individual. Of course, we have seen here that the board of directors develops strategy, policies that the company ought to be guided with in the process of discharging its function. They develop strategies. They give strategic direction. But the day-to-day operations of the company are left in the hands of the CEO. So this CEO ought to be a person who has the required skills, the required expertise, the necessary experience in order to steer the company to the desired end. And therefore, the board of directors should appoint the chief executive officer. And we know the chief executive officer does not work as an individual. No, there's a team of management, the management team. So the board of directors should at least participate in the appointment of senior management to ensure the motivation and protection of intellectual capital that is intrinsic to the. So that is appointment, but that's not enough. The board of directors should ensure that this team of managers, these senior managers, are continuously trained. They should have continuous training, continuous training, so that they discharge their functions effectively. Appointment of the CEO and the senior management. So we can go on and on, candidates, and mention roles like that are related to technology. We can say that the board of directors ensures that technology and systems used in corporations are adequate to properly run the business. All right? So that such technology can help the company to maintain what we call competitive edge. The board of directors, you can also say, that has a role in relation to risk. The board of directors have a role to identify key risk areas. Identify key risk areas. Identify key risk areas. Identify the key risk areas and also the key performance indicators and key performance indicators. Key performance indicators of the business. And the board should not just identify, but should also do what we call monitoring. They should monitor the key performance indicators of the company. Yet another role is in relation to going concern. Going what? Concern. The board of directors should ensure annually that the corporation will survive, the corporation will thrive, and the corporation will continue as a viable going concern. As what? As a viable going concern. So these are 13 roles of board of directors in corporate governance. We are going to discuss the last stakeholder, C, the government. The first role that the government plays is legislative and regulatory. Now, government through parliament makes public policy, it legislates, and also makes what we call statutory instruments. The government creates a conducive environment for business to operate. The government regulates and comes up with what we call the statutory frameworks. And the government, through the courts, also interprets and enforces the legislation that is done through the courts or the judiciary and other national enforcement agencies. So legislative and regulatory role. Government through parliament, I've said, makes legislation, makes statutory instruments. The government creates a conducive environment for business to operate, and through making regulatory and statutory frameworks, the government can also the interpretation and the enforcement of legislation is done by the courts and other national enforcement agencies like the Kenya Police and other such bodies. So legislation ensures fairness, legislation ensures a level playing field, legislation ensures transparency in business dealings, and that is very important. It's an important tenet of corporate governance. Transparency, disclosure and transparency is a key component, is a key tenet of good corporate governance. Through legislation, we know the government can, for example, determine what kind of financial records are to be published, right? We know candidates that the company law provides for the financial statements that the public limited companies ought to make public, to disclose. That's a legal requirement. And transparency and disclosure, those are important tenets of good corporate governance. So the first role is legislative and regulatory. To legislate and to regulate. And by legislating and regulating, the government creates a conducive environment for business to operate. Is that clear, candidates? The second role of government in corporate governance is a monitoring role. Monitoring. Monitoring what? Monitoring. The government ensures that there is fair play in business through monitoring. How does that happen? The government oversees and monitors organizations such as the Securities Exchange Commission, the Stock Exchange, and other financial institutions. Another role that the government plays is an overall role, or what we can call an overarching role. The government provides an enabling environment within which the private sector can thrive. The government is responsible for example, for providing basic what I call basic security. The government, through the public law, maintains order. The government ensures the protection of private property. And it also has an obligation to protect the vulnerable members of the society. All right? Overarching role. Let me call it overarching role. The government has an overarching role. It provides a general basic security, it provides law, it provides order, it helps in the protection of property, and so on. The fourth important role that is played by the government is that one of solving disputes. Solving disputes, and when disputes are solved, then justice is ensured and ensures justice. And where there is justice, candidates, there is most likely to be peace. So the government helps to bring justice in corporate leaders. Because you know corporate leaders who are from time to time involved in scandals. The government does what? Solves disputes among the corporate leaders, disputes between companies, disputes that may arise because of financial scandals, because of fraud. And the government can also help gather enough evidence against the corporate leaders who are involved or who are involved in scandals. The government can gather enough incriminating evidence against such individuals, and that is a very important role in corporate governance. Justice. The government does what? Ensures justice. So these are four roles that are played by the government in corporate governance. And that will mark the end of our today's lesson, where we've discussed the role of stakeholders in corporate governance. The syllabus restricted us to study the three stakeholders, that is the shareholders, the board of directors, and the government. Today we have learned that the shareholders ensure only competent and reliable persons are appointed to the board. We also learned that shareholders ensures that the board of directors are constantly held accountable and responsible for the effective and efficient corporate governance of the company. Efficient, good corporate governance of the company. The third role played by shareholders is that they help change the composition of the board that does not perform to expectation. In case there are directors who sit on the board who do not perform their duties as expected, then the shareholders have a role to remove them from the board. There is also the role in relation to confidentiality. Shareholders are under obligation to maintain information that is considered secret. The company secret should be protected by the shareholders of the company. We went ahead in this lesson to discuss the role that is played by the board of directors in corporate governance. We saw that board of directors exercise leadership. They bring independent judgment. They determine the corporation's purpose and the value. They monitor and evaluate implementation of strategies, policies, and management performance. The board of directors also ensures compliance to various laws, regulations, and calls of best practice. The board of directors communicates with stakeholders efficiently. Number 7, they serve the legitimate interest of the shareholders. Number 8, they regularly review processes and procedures. They also have a role to appoint the chief executive officer. And number 10, they identify key risk areas and key performance indicators. Then there is a role in relation to going concern. We've also discussed the role that the government plays in corporate governance. The first is the legislative role and regulatory role, the monitoring role, the overarching role, and the role of solving disputes and ensures justice. The government helps to bring justice in corporate leaders who are involved in scandals. Who are done what? Who are involved in scandals. So candidates, I'll leave you with an assignment based on what we have studied today. Discuss the role of the following stakeholders in corporate governance. A, shareholders. B, board of directors. C, the government. Thank you for taking time to attend today's lesson. When answering this question, close the notes, close the video. Try and see if you can recall what you have learned in today's lesson from your memory. God bless you. Bye-bye. Greetings and welcome back to the lesson. The subject is Introduction to Law and Governance. Today we're going to study the legal audit as a subtopic under the chapter on Introduction to Corporate Governance. In our last session we discussed the compliance obligations. Today we're moving on to legal audit. By the end of this lesson, you should be able to define legal audit. You should also be able to explain the importance of or the objectives of legal audit. Legal audit. Remember in our last session we said that compliance is the process of adhering to rules, regulations, and laws. We also mentioned that a company should put in place a system to monitor and check if the company is adhering to rules, regulations, and laws. And legal audit then is defined as the inspecting or the inspection of the company's activities, transactions, and practices to establish their compliance to its constitution and with the applicable authorities. Legal audit is the process of inspecting the company's activities, transactions, and practices to establish if the company is adhering to laws, regulations, and rules that are applicable to the company. It can also be defined as the systematic review of the company's transactions, contracts, and practices to establish its legal status and identify the potential legal problems. It may also help minimize its legal liability. So the main purpose of a legal audit is to help the company minimize risks and potential legal liabilities. It focuses on subjects like the form of business organization, the review of taxation law compliance, a review of intellectual property issues, use of internet, the human resources, among other areas, though legal audit covers such areas. So I've defined legal audit candidates as the inspection of the company's activities, the company's practices to establish their compliance to laws, regulations, and rules. It is the inspection of the company's activities, the company's transactions to establish compliance with laws, to establish compliance with laws. It is the inspection of the company's transaction to establish compliance. All right? It is the systematic review of the company's transactions. It is the systematic review of the company's transactions, the company's contracts and practices to establish its legal status and identify potential legal problems and help minimize its legal liability. So let's now study the objectives. What are the objectives of legal audit? Objectives of legal audit. Objectives of legal audit. Now, objective number one, candidates, is that legal audit promotes accountability. Promotes accountability. Legal audit does what? Promotes accountability. By doing what? By reporting deviations from violations of authorities so that corrective action may be taken by the company. Because when you are carrying out a legal audit, you on one hand have a list of the requirements, the legal requirements. Then you check if the company has complied, you tick, all right, with this one, complied. Number two, complied. Number three, not complied. So it's a systematic review of the transactions of the company. It does what? Promotes accountability. When review is carried out, when the activities are compared vis-a-vis the requirements, then it's possible to identify areas that have not been complied with. So the legal audit will identify deviations, and that promotes accountability. Two, identifies the company's legal liabilities. A legal audit can help identify a company's legal liabilities and risks beforehand. And risks beforehand. It helps, in other words, identify the potential liabilities and risks before they come up, all right? And if it's possible to identify legal liabilities and risks beforehand, then the company can come up with a way of averting potential lawsuits and penalties. And that is a sure way of saving the company's money in litigation costs and other unnecessary expenses. The third objective of a legal audit is that legal audit helps the company become or remain compliant. Helps the company remain compliant. It helps the company to remain compliant with the laws and policies that are put in place as it exposes the laws that have not been complied with. And that provides a way of complying with the laws that have not been complied with. Because when you carry out a legal audit, it's possible to identify the laws that have been complied with and the laws that have not been complied with. So the laws that have not been complied with, they can now be complied with as a result of carrying out a legal audit. 4, promotes good corporate governance. A legal audit promotes good corporate governance, both by identifying the weaknesses and deviations from the law and regulations, and by assessing propriety. All right? It promotes good corporate governance by, 1, identifying weaknesses and deviations from laws and regulations, and by assessing propriety where there are insufficient or inadequate laws and regulations. And when that happens, then fraud and corruption are by their very nature elements which counteract transparency, accountability, they counteract good stewardship, and so on. So good legal audit promotes good corporate governance. Then number 5, a legal audit also demonstrates that the company's directors and managers have carried out due diligence. Due diligence. By carrying out a legal audit, that demonstrates that the management has done what? Has carried out what we call due diligence with regard to the activities undertaken, thereby minimizing their exposure to personal liability. When the directors conduct a legal audit, that legal audit helps the company to carry out due diligence. That demonstrates that the directors have done what? Have carried out due diligence with regard to the activities undertaken by the company, and that minimizes the exposure to liability, minimizes exposure to directors' personal liability. When directors carry out a legal audit, then they are reducing the possibility of personal legal audit, because they would have conducted their work as required by laws, as required by regulations, rules, policies, and so on. So these are 5 objectives of a legal audit, and that will mark the end of the lesson. Remember, the objective of this lesson was that by the end of the lesson you should be able to define legal audit and explain the objectives of a legal audit. And that will form the basis of your today's assignment. Define a legal audit. 2, highlight 5 objectives of a legal audit. That is your assignment. When answering the question, ensure that you do not directly refer to the notes. See if you can recall what you have learned in today's lesson from your memory. Thank you. God bless you. Bye-bye.
Number 2, we have ratio analysis. So when talk about the ratio analysis, as the name suggests, this is basically a tool of analyzing the financial statements, and it involves computation of ratios. Or this tool entails computation of what we refer to as the financial ratios. What is a financial ratio? This is basically a relationship between 2 or more financial variables. For example, in this case, as a financial analyst, you can express the profit reported by the company, or maybe the net profit or the operating profit, as a percentage of the company's revenue. So wherever you get which automatically would be a percentage, is a financial ratio. And basically it shows the relationship between the operating profit or the net profit with the company's what? Revenue. So therefore you can say financial ratios is the relationship ship between two or more financial variables, two or more financial variables. Financial variables are those items which are included in the income statement, items of revenue, expenses, asset, liabilities, or what? Equity. Now, we have various ways in terms of these particular ratios may be used by various users. So therefore, you can look on the uses of ratios, or uses of financial ratios. And even before you look on these uses of the ratios, it is important here to note that we have around 5 categories of ratios which may be computed using the information in the income statement and the statement of financial position. We have the profitability ratios, liquidity ratios, efficiency or activity ratios. We also have the solvency or capital structure ratios and the investment ratio. So therefore, what we are going to do here, we are going to look on what is the uses of those 5 categories of ratios. So let's start by looking on the uses of the profitability ratios. Now, these particular ratios here are used in terms of measuring the performance of the company's management, because in this case we say that if the company is performing well, then that is as a result of the good performance of what? The company's what? Management. So therefore these ratios we can say they measures performance of company's management. If a company is performing well, we have said that will be as a result of the good performance of the management. If the company is not is performing poorly, that we can also say it is as a result of the performance of a company's management. Then we also have the other category of ratios, and that is the liquidity ratios. So how do we use these particular ratios, or how are these particular ratios used? Liquidity ratios, these are ratios which are computed. We're going to look on various types of liquidity ratios, and they are used to do what? To measure the ability of the company to meet the short-term financial obligations as and when they fall due. These ratios are computed to determine whether the company will be in a position to pay the short-term debts as and when they fall what? Due. So therefore this one measures ability of a company to pay, or in other terms we can talk of to meet short-term financial obligations. So will a company be in a position to pay the short-term financial obligations as and when they fall due? Short-term financial obligations, basically we are talking of payment which are supposed to be made to the creditors and basically the other who? Suppliers. So the company will need to compute now the liquidity ratios. So then from there we have the other category of ratios. So number 3, we have the efficiency stroke activity ratios. And these ratios, on the other hand, are computed to determine how well or how efficient the company is using its assets or its resources to generate revenue, or basically to generate profit. So we can say the measures the efficiency basically efficiency, we are talking of how well the efficiency of a company in using its assets to generate a profit. How well is the company using its assets to generate what? Revenue. And then the other category of ratios is the solvency through capital structure ratios. Now, these ratios, on the other hand, are computed to determine the ability of the company to pay or to settle the long-term debts as and when they fall due. They measure the ability of a company, to meet long-term financial obligations. So these ratios are computed to determine whether the company would be in a position to do what? To pay the long-term financial obligations, e.g. The loans which have been acquired by the bank as and when those particular loans fall due. Then we have the last category of ratios, and that is the investment ratios. They are also known as the equity ratios. Now, these ratios are computed to help the shareholders of the company, or basically to help the equity shareholders of the company in terms of doing what? In terms of evaluating how well the investment in the company is performing. As a shareholder, once you invest there by buying shares, you want to know how well your investment is performing. So therefore, we can say the help equity shareholders to evaluate performance of the investment. Evaluate performance of the investment. So therefore, we have those as the 5 category of ratios, and basically the uses. Okay, so then from there we need to proceed and look on what are the limitations of ratios before we can look on the various ratios which are computed under each of these category here. We can first of all look on what are the limitations, or what are some of the shortcomings of the ratio analysis. So let's look on the shortcomings. Limitations of ratios. And basically here we have various shortcomings. We have various limitations associated with the ratios. Number one, we say that ratios are historical in nature. So historical in nature means what? It means that when a financial analyst is computing ratios are always computed based on the past data. And therefore, if the circumstances have changed, then those particular ratios cannot be used in terms of making what? Decisions about the future. That is one of the limitations. Number two, we say ratios ignores the time value of money. So ratios do not have any consideration as far as the time value of money is concerned. If the company, for example, acquired an asset some time back, like 3 years back, maybe at a cost of 2 million. When computing the ratios, we use that amount of 2 million. I will basically use that figure of 2 million. So despite now 2 million currently not having the same value as 3 years what back. So the ratios here totally ignore the time value of what? Of money. On the other hand, we say ratios also ignores inflation. Also ignores what? Inflation. Ratios do not have any consideration as far as the changes in the prices of goods and services is concerned. Number 4 is that ratios ignores a qualitative aspect. Ratios ignores the qualitative aspect. So basically what that means is that the information which is provided after computing the ratios is purely quantitative. Ratios provide information about profitability, about efficiency, about now and that is profitability, liquidity, and efficiency. That is a quantitative information about the company. But ratios which have been computed, they do not provide any information about the qualitative aspect of the company. When we talk about the qualitative aspect of the company, we are talking of aspects such as customer satisfaction. We are talking of aspects such as what maybe the quality of a product and also the services. We're also talking of maybe the quality of management. So the ratios computed, they do not give any information about all those quantitative all those qualitative aspects. That is the other limitation of ratios. On the other hand, number 5, we say ratios are subjective. Ratios are subjective. So basically what that means is that the ratios computed by each company will be affected by the accounting policies which a company adopt in terms of preparing financial statement. When we talk about accounting policies, we are talking of things like methods of depreciation. So basically what that means is that assuming you have two companies within the same industry, company A and company B, and you want, for example, to compare the performance of these two companies, and therefore you have computed similar ratios of the two companies. Now, if these two companies, company A, company B, happen to be using different accounting policies, like company A is depreciating its asset using straight line method, company B is using the reducing balance method, then the ratios which you are going to compute will be highly affected, will be highly influenced by the accounting policies adopted by this company. So mean that you may not be in a position to use those particular ratios to compare the performance of the two companies due to the fact that they are using different accounting policies. That's why we are saying ratios are subjective. They are highly influenced by by the accounting policies which are basically adopted by different entities. So therefore, these are basically some of the limitations which are associated with this particular tool or this particular technique of analyzing financial statement. These are very, very common questions, particularly in this paper called FRA. So therefore, you have to recall those particular limitations of of ratios. So next, I want us to look on the various categories of ratios which are computed, and actually the ratios which are computed under each of the category. So we start with the profitability ratios. So these are categories of ratios. Category of ratios. So let's just go straight to the first category, and that is profitability. Profitability ratios. Remember, in this case, we have already said that profitability ratios are the ratios computed to evaluate the performance of the company's management. Because you have said that if the company is performing well by the end of the day, that is attributed by a good performance of the management team. If the company is not performing well, then we can say that that is equally due to to the poor performance of the management team. So which are some of the profitability ratios which may be computed? So we can say these include These ratios include So, and what is important as far as these particular ratios are concerned is to recall, to remember the formula, because without remembering the formula, then you can't be able to tackle any question on ratios. So we have the first ratio here, or the first profitability ratio, which is known as the return on capital employed. Return on capital employed, abbreviated as ROCE. So how do we compute this? This one is computed by taking the profit before interest and tax, which is also known as operating profit. Operating profit. We divide that with the capital employed. Capital employed. And because this is a profitability ratio, by the end of the day, we express it as a percentage. So what is capital employed? Capital employed. So capital employed, we can abbreviate that as CE, capital employed. This one is computed by taking the total asset of the company minus current liabilities, or you can compute the capital employed by taking total equity. Total equity is the ordinary share capital plus reserves plus non-current liabilities. It is important for you to remember those two formulas because the formula which you use, it always depends with the information the examiner has given you. So the other profitability ratio is what we refer to as the gross profit markup. Gross profit markup. This one is computed by taking the gross profit of the company divided by the cost of sales times 100. Number 3, we have gross profit margin. Gross profit margin. Anytime you see the word margin, as far as the computation of these ratios is concerned, the denominator is always revenue. Anytime you have seen the word margin, and then the denominator automatically will be the word which comes first, that is gross profit. So that is how we compute that. The other profitability ratio is something known as the operating profit margin. Operating profit margin. Equally, you can see the word margin here, meaning that in computing our ratio here, the formula will be, or the denominator will be revenue, and then the numerator will be operating profit. Operating profit. And you have to recall up here, we have said that the operating profit is known as PBIT, profit before interest and what? And tax. So the other profitability ratio that should be number 4 is the return on equity. The return on equity, ROE, or this is also known as return on investment. ROE, return on equity or return on investment. These are computed by taking the net income, the net what? The net income. So we take the net income here. Net income, or basically the profit after tax. And then we divide that with equity. Equity times 100. So equity, you have to recall, this is ordinary share capital and what? Ordinary share capital plus reserves. Ordinary share capital plus reserves. We have the other profitability ratio, which is net profit margin. Net profit margin. And the net profit margin, equally, because we have the word margin, our denominator here will be revenue, and then net profit. Net profit. So the net profit of the company is the profit after tax, which is also known as net income. Which is also known as net income times what? Times 100. Times 100. So therefore, these are some of the profitability ratios which may be computed by the company purely to evaluate how the company is performing. And you have said that the company performance will be directly related to the performance of the company's what? Management. So let's move and look on the other category of ratios. Number 2, we have liquidity ratios. Liquidity ratios, and basically liquidity ratios, you have said that these are ratios which are computed to do what? To evaluate the ability of the company to meet the short-term financial obligations as and when they fall due. So majorly here we have like 3 liquidity ratios. The first one is the current ratio, which is also very, very common in the questions in this paper. So current ratio is computed by taking the current assets all over current liabilities. And in this case, it is important to mention here that a recommended, or in other terms, we talk of ideal current ratio should be 2:1. So for the company to be in a position to pay the short-term financial obligations as and when they fall due, the current liabilities must be 2 times of the current what? The current asset must be 2 times of the current liabilities. So then from there we have the quick ratio, which is also known as the acid test ratio. So this is a ratio which is computed to determine the ability of the company to pay the short-term debt as and when they fall due using the highly liquid current asset. And basically all the current assets of the company are highly liquid except the inventory. So therefore, to compute the quick or the acid test ratio, we take the current assets minus the inventory. We say inventory is not highly liquid. It cannot be converted into cash within a short period of time. If you have a business and you have some inventory which is lying there in your business, there is no way you'll keep on calling your customers maybe to come and buy the inventory which is there. Inventory is not highly liquid. So we take current asset minus inventory divided by current liabilities. And then finally we have the cash ratio, which is basically a ratio which is computed to determine the ability of the company to pay the short-term financial obligations using cash and cash equivalent. So therefore, in terms of how we compute this, we take cash plus cash equivalents, or basically we can say cash and cash equivalents. Cash and cash equivalents, then divide that with the current liabilities. So when talk about cash here, we are talking of cash in hand, cash at bank, and then cash equivalent. These are short-term investment. Short-term investment, or those particular investment by the company, and which in the statement of financial position are part of the current asset. So therefore, you have those as the various liquidity ratios. Let's move and look on the other category of ratios, number 3, and that is efficiency stroke activity ratios. And I think we have already said that these are ratios which are computed to determine how efficient, how well the company is using now its assets to generate profit. So in this case, we have a number of efficiency, or a number of activity ratios, which include the inventory turnover ratio. This one is computed by taking what? By taking the cost of sales divided by average inventory. So the cost of sales, this is something already which will be given to you in the income statement. Average inventory, this one, average inventory. This one is equal to opening inventory plus closing inventory divided by 2. Opening inventory plus closing inventory divided by 2. Then, and basically this ratio here is a ratio which is computed to measure the frequency of making sales. How the number of times on average the company converted inventory into sales. So then we have inventory turnover in days, inventory turnover in what? In days. Some books can also refer to this as inventory holding period. Inventory holding period is a ratio which is computed to determine the number of days the company takes to make sales. So in terms of how we compute this, we take the average inventory, then we divide all that with the cost of sales times the number of days in a year. Usually you'll be told to use 365 days. 365 days. So the other efficiency or activity ratio number 3 is the trade receivables. Receivables turnover. And on the other hand, this is a ratio computed to basically determine the frequency of debtors paying their debts, or in other terms, is a ratio which is computed to determine on average the number of times the debtors paid their debt. The higher the number of times, the better. So how do we compute this? We take the credit sales, or basically the credit revenue. We divide that with the average trade receivables. That's how we compute the trade receivables turnover. Then next, number 4, we have trade receivables turnover in days. In other terms, this particular ratio can also be known as the trade receivables correction period. It is a ratio which is computed to determine on average the number of days the customers take for them to pay their debts. The shorter the number of days, the better. So how do we compute this ratio? We take the average trade receivables, we divide that with the credit sales times 365 days. Then the other issue, number 5, we have trade payables turnover. And on the other hand, this is a ratio now which is computed to do what? To measure the frequency of paying the suppliers, or the number of times on average the company paid the suppliers. So in terms of how we compute this, we take what? We take the credit purchases, or the cost of sales. In most of the questions, the examiner will not have given you the credit purchases. So instead, we use what? The cost of sales, and then divide that with the average trade payables. And anytime you see average, to compute the average, you take the opening balance plus the closing, divided that with 2. And then we also have the other efficiency or activity ratio, which is the trade payables turnover in days. In other terms, this can also be known as the trade payables payment period. Is a ratio which is computed to determine on average the number of days the company is taking to pay the suppliers or to pay the creditors. So in terms of how we compute this ratio, we take the average trade payables, divided that with the credit purchases times 365 days. 365 what? Days. So therefore we have this as actually some of the efficiency or activity ratios. We have mentioned about what? The inventory turnover in days, the trade receivables turnover. Then we have also talked about the trade receivable turnover in what? In days, trade payables turnover. Then you have also talked about the trade payables turnover in what? In days. And I think we also have another one which is also known, which is known as what? Which is known as the total asset turnover. Total assets turnover, still an efficiency ratio, and this is computed by taking revenue. Remember, revenue is the same with the sales. We divide that with the total assets. Total assets. So those are the various efficiency or activity ratios which may be computed by a company to evaluate how well the company is using its assets to generate a profit. So let's move and look on the other category of ratios, which is number 4. Number 4, we can look on the capital structure. The capital structure stroke solvency stroke leverage ratios. And we said that these are ratios computed basically to evaluate the ability of the company to pay the long-term debt as and when they fall due. So these ratios, we have a number of them. Number 1, we have the debt to equity ratio. Debt to equity ratio. This one is computed by taking the debt. Debt is all non-current liabilities. We divide that with equity. Times what? Times 100. Then we also have number 2, the interest cover ratio. The interest cover, or basically we can just refer to it as interest coverage ratio. Basically, this is a ratio which is computed to determine on average the number of times the company would have paid the interest using the profit before interest and tax. So therefore, in terms of how we compute this, we take the PBIT, profit before interest and tax, which is also known as operating profit, and then we divide that with the interest or the finance cost for the year. The interest or finance cost for what? For the year. Let's look on the other ratio, number 3. Number 3, we have financial leverage ratio. This one is computed by taking the total assets and then we divide that with equity. Equity, always we have to recall that is the share capital plus reserves. And then number 4, we have the debt ratio. Debt ratio, this one is equal to total liabilities all over total assets. So I've said this is total liabilities all over total assets. So this ratio, we express it as a percentage. It shows the relationship between the total liabilities of the company and what? And total asset. So basically, those are some of the capital structure or solvency or leverage ratios which are ordinarily computed to evaluate whether the company is in a position to pay the long-term debt as and when they fall due. Finally, I want us to look on the investment stroke equity ratios. And recall, we say that these are ratios computed to help the equity shareholders, that is the ordinary shareholders, in terms of evaluating how well their investment in the company is performing. So we have a number of investment or equity ratios, which include number 1, the earnings per share. Earnings per share, this is equal to the profit attributable to ordinary shareholders. This one is abbreviated as PATOS, which is profit attributable to ordinary shareholders. We divide that with the number of ordinary shares. number of ordinary shares issued by the company. In terms of how we compute or we determine this profit attributable to ordinary shareholders, we take the company's profit after tax, and then to this we less the preference dividend for that year. Preference dividend for that year. Whatever you get here is known as PATOS, the profit attributable to ordinary shareholders. Profit, the company's profit after tax, or the profit for the year, minus the preference dividend for that year. So then from there we have the other ratio, and that is the dividend per share, DPS. This one is equal to total dividends paid. Total dividends paid. We divide that with what? Number of ordinary shares. So this is a ratio which is computed to determine the dividends paid per share. Dividends paid per what? Per share. So that is the other investment or equity ratio. The other one is called the dividend cover. Dividend cover ratio. So this ratio here is computed using the earnings per share and also the DEPS. So we take the earnings per share, we divide that with the DPS. So whatever you get here is known as the dividend cover, the dividend cover. Number 4, we have something called the dividend yield, the dividend yield ratio, dividend yield ratio. So how do we compute this particular ratio? Here we take the dividend per what? Per share, DPS. We divide that with something called the market price per share, abbreviated as MPS, and then times 100, times 100. Whatever you get there is known as the dividend yield what? Ratio. And then from there we have the last ratio, which is called the dividend payout ratio. Dividend payout ratio. So how do we compute this one? We take the dividends per share, all over earnings per share, equally times what? Times 100, times 100. So therefore, those are the various investment, or basically the various equity ratios which are computed by the company to help the shareholders of the company in terms of evaluating how well the investment they have made in the company is actually what? Performing. So therefore, those are some of the ratios which you need to know, and also their formulas, and they may be computed by a company to help the various users in terms of making what? Decisions. So I want us to take a short break. Once we come back in our next session, we are going to look on some illustration questions from the Kasneb past papers regarding the ratio analysis, regarding computation of ratios, and regarding something called the common size. So see you in the next session.
Welcome to Manifested Publishers.
Welcome, my dear learner, and thank you so much for continuing to study with us. Now, in this study session, we are going to look at topic 3, the futures market and contract. Therein, after looking at the various types of futures contract, it's also prudent that we look at the pricing and valuation of futures contract. The pricing and valuation of futures contract. Now, you will recall from our prior sessions that pricing means the determination of a fixed amount, or in some instances, this amount could be a rate when you're talking about the exchange rate or the interest rate. So at which the long will buy from the
short an underlying instrument, at expiration of which we call its maturity, which we called it the maturity of the futures contract. Futures contract. So pricing is just we want to get a rate or an amount. Now the party that is long is the buyer. We will pay who? The party who is short, the seller, for the exchange of the underlying instrument at expiration. Now, we also said that futures contracts have in all manners and respects the behavior of a forward. It's only that now futures trade at the listed exchanges. So we remember that with a forward also, this was a contract that had a zero value contract at initiation. A zero value contract at initiation. What did we mean here? We mean that the present value of the payment promised to each party, of the payment promised by each party to the other, promised by each party to the other, is the same, therefore, none of the parties pays, none of the parties pays anything at the start. So that's how we value a zero value contract at its initiation, which similarly occurs with futures contract. So we say they are zero value contract at initiation. We also do remember the basics about the valuation of futures, and we say the value of the contract. We need also to have the same understanding about the value of the contract. And this value, we said, is set with from the long's perspective. Set from the buyers, which is the long party perspective. So, and how do we set it? Now, we set it as a present value promised by the short. Now, the buyer, the long, should be promised by the counterparty, that the short, to the long minus the present value of payment promised by the long, promised by the long to the short, We are going to see the mathematical expression validating this in just a few moments. So the generic pricing and valuation of a futures contract we want to see. Now the other item is generic pricing and valuation. of a futures contract. Now, for us to be able to drive the basis of how to going to price and value, it is very important for us to look it through the timeline. So a timeline like that. So where 0, now this is today or the day of initiation, the beginning or when the contract is being made. So over time, this T can be the expiration. So this is the contract what? Expiry. Now, we went through the market-to-market process in our previous session, and we saw that any day, the contract can be marked to market. But that marked to market must be able to compare by the prices that occurred the previous day. Yeah, the settlement price, and compare it with the closing price of the previous day to be able to determine which party owes the other when that price changes. So this one are T and T minus 1 are arbitrary days. Arbitrary days into the life of the contract, into the life of the contract, when the contract is marked to market, when the contract is marked to market. So, and that is just the representation of the generic pricing. Now, for us to be able to proceed, we must understand the stipulations of CAPEM. The stipulations of CAPEM affect us. Okay, stipulations of CAPEM, capital asset pricing model, that we did in our previous learning in the intermediate and foundational levels. Now, with CAPEM, first we say that in the world of finance, we will trade at no arbitrage prices. So prices reflect no arbitrage opportunities. So markets are assumed to be very efficient. There are many buyers and sellers, such that the prices are reflective of all the information the parties have, and therefore, if there are distortions in the prices, then the parties can be able to execute buy and sell, yeah, accordingly, such that now the prices will be able to go back to the equilibrium. So the prices will reflect no arbitrage opportunities, and that buyers and sellers can borrow and lend at the risk-free rate. So buyers and sellers, sellers can borrow and lend at the risk-free rate. The risk-free rate. So that is that. So if these conditions are to hold, and those are the conditions we assume are holding in the futures market, then two conditions occur. So we will have that there is now the ST at maturity there, and the futures price. So the ST here, now this one will denote what we will be calling the spot price at expiration. The spot price at expiration. And the FP now will be the futures price. Now, for the condition of CAPEM to hold, then we are saying that the futures price should be equal to the spot price at expiration. So therefore, the futures price must converge or be equal to the spot price, to the spot price at expiration. Okay, so then this will guide us now in the valuation. So on the valuation, if these conditions are holding, first we will have the value at the value at T at expiration for the contract will be now 0. And we also want to see any time the value at T. So we will see value at T, and we will also want to see the value at a particular time there. The value at T minus 1 now will be what? 0 there, and then 1. This one, before the, I will explain them. Let me write them, then explain them. The future price minus the value at T minus 1. Now, these are the conditions we will use to hold. So the value at expiration, is set at 0 because the futures price is converging at the spot price. Correct? Now, the value is 0 as soon as the marking to market process is completed. So the value is set at 0. Value is set at 0 as soon as the marking to market process is concluded. So, however, before the marking to market process happens, you find that when you compare the futures price, which is the settlement price, to the prior day's closing price, then you find that either party, whether the short or the long, owes the other by the decrease in price, of course, multiplied by the number of contracts. That is how we saw the amounts that are used either to be credited or debited to the long or short accordingly. So we write that and state that an instant day or a previous day before the account is marked to market. So there could be either a gain or a loss to the short, or there could be, so there exists either a gain or loss to the long or short. Yeah, the long or short. So if it's a gain to the long, there could be then the loss to the short. So that also sets us will guide us during the valuation. So in general, therefore, if these are to hold, or generally, if this is holding, then we find that FP, the futures price, will be the SO times 1 plus RFT. What does that mean? So this means that the futures price FP is the spot rate or spot price, SO, compounded at the risk-free rate RF, compounded at the risk-free rate RF, over the life of the contract T, over the life of the contract T. So that's how we generally have that. So and then compounding, we learned that compounding can be either on a discrete basis, for which we apply this formula, or continuously compounded. Continuously compounded. Risk-free rate. Risk-free rate. We know that we can get our continuously compounded risk-free rate by ln 1 plus the RF. So therefore, the FP is the SOERF, continuously compounded, times the T. So in such a manner, we can be able to proceed like that. So for us to be able now to apply that valuation through an example. So, and in our example, we are going to see, and our example reads, consider a futures contract with a life of 182 days. The annual interest rate is 5%. Compute the no arbitrage futures price if the underlying spot rate is at Kenya shillings 1,000 for both the discrete and continuously compounded interest rates. So that example requires us to compute the futures price for both the discrete and the continuously compounded interest rate. Now, discrete, so we are going to use this formula, whereby now we know that our SO has been given as 1,000. Our RF has been given as 5%, which is 0.05. And our T has been given as 182 over 365. So our FP now, the SO 1,000 times 1.05, our T is 182 over 365. So this one gives me 1,000 times into bracket 1.05 open the bracket again, raised to power, open the bracket, 182 divided by 365, close the bracket, close the bracket. This gives me 1,024.627. Now, under the continuously compounded interest rate, so now we will use, first of all, this formula to be able to convert our discrete risk-free to a continuously compounded manner. So our RF continuously compounded is equals to the ln of 1.05. So ln 1 into bracket 1.05, close the bracket, is 0.04879, rounded off there. So then our futures price would be the SO now, applying this formula. The SO is 1,000. Our E, then 0.04879 times 182 over 365. So this gives me 1,000 shift E into bracket 0.04879 times 182 divided by 365, close the bracket, 1,024.627. So you find that whether you use the discrete format or you use the continuously compounded route, then the future prices will converge at the no arbitrage price. So this takes us to the end of our lesson, having understood the introduction to basically the pricing and valuation of the futures contract, how the notations we use, the understanding that will guide us, and in terms of now the time frame and what notations we will be taking, and also reminding ourselves that pricing and valuation takes a similar manner to that of the forward contract we studied earlier, but now we'll be cognizant of the fact that there is a marking to market process, and we'll be seeing for the individual underlying instruments, then how do we consider the same. So having understood that, it is our time for an assignment. Okay, so for our assignment, we are going to consider a long futures contract to purchase a non-dividend paying stock in 3 months. Assume the current stock price is Kenya shillings 400 and the 3-month risk-free rate is 5% per annum. Required, compute the futures price, A, assuming a discrete interest rate, B, assuming a continuously compounded interest rate. Thank you for your participation.
Welcome to Manifested Publishers.
Hello, Lana. Once more, welcome. In this session is a continuation about the pricing and valuation of futures contracts. And we have laid the ground to the point that we have seen how we can be able to determine the futures price and the generic valuation. So the story is continuing. The story of valuation continues so that when we finish with the generic pricing, we might be able to see the valuation of the specified instrument. So in this lesson, this study session, we're going to build up to that concept further. So we also want to recall that we made some recall that when we were discussing the various underlyings, especially the commodities, we said that there are two broad categories of the underlying. So the first category was especially the investment assets, and the second broad category was commodities with consumption, commodities on consumption assets, consumption assets. So for the investment asset, we said that these assets are able to generate a particular yield, and this was the case for gold, right? We saw that the holder of the gold was able to charge the rented gold to the investment bank and generate a gold, some yield there. Then we also know that with bonds, there could be cash flows that they generate, which we normally call interest, or the frequent what? Coupons, as they underline. We also saw that with stocks, an investor in stock is able to be paid what? Dividends. Okay, so the investment assets are able to give us some yield there. However, with consumption assets, we saw these to be the examples with oil, wheat, and so on and so forth. So we saw that there could be very significant storage cost. Yeah, for example, if you are to store wheat, yeah, to use to maybe bake cakes or even bread, then that would call for significant storage cost. However, there are some benefits that accrue, benefits, and these benefits could be in non-monetary form. Yeah, non-monetary form, for which we call these benefits the convenience yield. Yeah, the convenience comes from the fact that, which we will expound later on that concept, that you are storing wheat to be able to be used in the baking process for either cakes or even bread. So anytime you want to produce or go to along with the baking process, there is already the raw material within what? The facilities. So there is no headache that you must source, wait for the supplies to be done. No. That is readily available, giving the production process some convenience. So therefore, in the understanding on how we are going to proceed to price and value futures contract, we must be cognizant of the fact of 3 items. One is the storage cost. We must be able to know how we account for the storage cost in the valuation. There's a cash flows on the underlying. Cash flows on the underlying. And of course, these cash flows are positive in nature most of the time. Then the other aspect we should be able to account for the convenience yield. how we account for that gives us these three that we should be able to account for. Then how do we pricing futures with storage costs? How do we go along on the pricing futures with storage costs? Now, with storage costs, these sometimes they are referred to as the carrying costs. So these costs involve the establishment of maybe a warehouse. You must also establish the stock keeping systems. Stock keeping systems, just an example. And for example, also with an example we saw on oil, for example, if the underlying is the crude oil, you know, crude oil comes with the risks such that you must avoid spillage, you must avoid the risk of fire, or you must also avoid the risk of explosions. So even storing crude oil, for example, will call for you to take what we are calling insurance. And for insurance, you'll be able to pay premiums on them. So therefore, this needs to be considered. So when that is considered, so the future price, the futures price will be now the spot price compounded over the life of the futures contract, over the life of the futures contract, using the risk-free rate, and now we should be able to add plus future value of the storage cost over the life of the contract, of the storage cost over the life of the contract. So these costs, which you are calling the carriage cost or the storage cost, now need to be added when you are determining the futures price. Let us see also the futures when there are cash flows on the underlying. Pricing futures when there are cash flows on the underlying. Now, the cash flows on the underlying, they generate positive cash flow. For example, we talked about the interest, coupons, or even dividends. So this will be positive to the holder of the contract. So the future price is the spot rate. So the future price here is the spot rate at compounded at the risk-free rate minus, now this is minus future value of the cash flows, future value of the cash flows. Remember, why it was plus is that as the holder of the underlying, you need to be compensated when you sell that underlying for any costs that are used to make that underlying. For example, if a warehouse person stores for you a good, right? So over a particular period of time, when you go to buy or to get that back good, then you will be able to pay back what? The storage cost. So therefore, we say these are structured from the buyer's perspective. So the buyer should be able to compensate what? The additional cost of the storage. Now, why do we minus when there are cash flows on the underlying? Now, we say now the future price should be reduced by an appropriate amount, enough to account for the positive cash flow, when the trader buys the underlying asset. When the trader buys the underlying asset, this avoids overcompensation. To avoid overcompensation, and this is commensurate with this. Now we'll be able to create hedged risk-free position. Now, this avoiding of the overcompensation now brings about the creation of a hedged risk-free position. So we will have created a hedged risk-free position. So there will be no any party who will try to get an overcompensation. So how do we then price futures contract when there is the third item, which is the convenience yield? So pricing a futures contract, when there is convenience yield. So when there is convenience yield, so the non-monetary benefits, that we have talked about there. For example, the oil that is available to a refinery. So the refinery company does not have to think about sourcing for oil. So this convenience yield can also be seen through the aspect of during rising prices, isn't it? So during increasing prices, the company that stores now will be able to benefit, because it will not be able to go back into the market and buy expensive product. So when the asset is increasing prices, or this period could be during short supply seasons. So those would yield a convenience yield to the person who is storing. So so commensurate with the hedging pressure theory, in line with the hedging pressure theory, This theory states that the prices of the derivative instrument should be at the edged risk-free position. So now we should be able to get the futures price. The futures price is equal to the spot rate compounded, of course, at the risk-free rate over the time of the contract plus the future value of what? The cost. Yeah, we add the cost minus the non-monetary benefit. Non-monetary benefit. Then which this monetary benefits are what? The convenience yield. Yes, then close those brackets. So this formula that we have gotten over there, so if the cost of storage, for example, exceed the monetary, the non-monetary benefit, we will be able to add. However, if the benefits, yeah, both monetary and non-monetary, yeah, so there will be negative here and we will be able to minus. So this model is commensurate from the hedging pressure theory and also gives rise to the cost of carry model. Cost of carry model. So this is the cost of carry model. Having seen that, then let us illustrate the hedging pressure theory as it relates to the pricing of futures contracts. So hedging pressure theory, hedging pressure theory, as it relates to the pricing of the futures contract. So this will be likened to a diagram here over time. I know we know it. So at time 0, we would buy the asset at SO. Buy the asset at SO. Then you sell the futures contract. Sell futures contract at FP, and then the outline now for the investor, for the trader, is equals to SO. Then over the life of the contract, like this, so you hold the asset, and incur the costs, less benefits. That is what we said there. Then after expiration, what normally the trader does at T over here, then you will be able to deliver the asset. You'll be able to deliver the asset at expiration over here, then receive what? Receive the FP, and then the consideration should be made the cost less benefit, then the payoff here, payoff at expiration T will be now be the FP minus the future value of any cost less than the benefit. So that is the payoff there. So that's how we will illustrate the hedging pressure theory that is commensurate, or that is in line with the cost of the carry model. Let us understand that through an example for us to be able to take into consideration for further understanding. Example. This example is on the pricing of futures contract when they are storage costs, cash flows on the underlying, and the convenience yield. Consider an asset priced at Kenya shillings 50. The risk-free rate is provided at 8% and the futures contract on the asset expires in 45 days. Answer the following questions with A, B, C, and D independent of each other. Part A, find the appropriate price, futures price, if the underlying asset has no storage cost, cash flows, or convenience yield. Number B, find the appropriate futures price if the future value of storage costs on the underlying asset at the futures expiration equals Kenya shillings 2.25. Number C, find the appropriate futures price if the future value of positive cash flows on the underlying asset equals Kenya shillings 0.75. Part D, find the appropriate futures price if the future value of the net overall cost of carry on the underlying asset equals Kenya shillings 3.55. Part E, using Part D above, illustrate how an arbitrage transaction could be executed if the futures price contract is trading at Kenya shillings 60. Part F, using Part A above, determine the value of the long futures contract an instant before marking to market if the previous settlement price was Kenya shillings 49. So we proceed on to solve that example. Solution. So first of all, we must define the element. SO has been provided at 50. Our time to expiration of the futures contract has been given as 45 days. So as a fraction of the total year is 45 over 365. Our R has been provided, our risk-free rate has been provided at 8%, which is 0.08. So for part A, we know that our futures price from our earlier learnings, then our future price will be given by the SO times 1 plus the RF T raised to power T like that. So we know now this one is equals to 50 times 1.08 raised to power 45 over 365. This gives me so 50 times into bracket 1.08 raised to power, open another bracket, 45 divided by 365, close two brackets, gives me 50.48. 50.48 rounded off to 2 decimal places. So part B, now the storage costs have been given. So this storage cost must be covered in the futures price. So storage costs must be covered in the futures price. Such that now these storage costs, now the futures price, so the futures price plus the future value of any costs, that what we said over here. So the future price, we have determined it to be 50.48 over there plus 2.25. This gives me 50.48 plus 2.25. 52.73 Kenya shillings. Now, part C, Now, there is a positive cash flow. In part C, there is a positive cash flow, maybe the interest or dividend on the underlying. And this now must be able to come as a benefit which we should minus from the futures price. So a positive cash flow on the underlying reduces the futures price. Futures price. So future price minus the future value of the benefits. So the future price, we got it at 50.48, and the future value of the benefits given in the equation is 0.75. This gives me 50.48 minus 0.75 to give me 49.73. So that is the answer that example required on that part. Now, for part D, if you allow me, with your permission, to wrap these a bit. So, for part D, we find that the overall cost of carry must also be covered by the futures contract. Overall cost of carry must be covered by the futures price. So here to cover it, we say to be the futures price plus the cost of carry. Now this is Kenya shillings 50.48, the one that we had there, plus 3.55, the one that have been given by the question, and this gives me 50.48 plus 3.55 to give me 54.03. Now, part E talks about the arbitrage opportunity. So that is calling for us to understand the hedging pressure theory that traders will have to go through to take advantage of any arbitrage opportunities. So in number one, for the first step that we said here, you buy the asset. You buy the asset at SO. So we are going to buy the asset at Kenya shillings 50 over there. So the next step, you sell the futures contract at the price that is selling there. You sell the futures contract at Kenya shillings 60. Now, from there, because we know now the interest rate is at 8%, so the compounded rate will be 5.4. So we know that because the compounded spot rate at 8% of the risk-free rate of RF, the risk-free rate, gives 50.48. This means that the foregone interest by holding the asset means that the foregone interest in holding the asset holding the asset, it is like the opportunity cost, is what then? Is that amount that is higher than the 50, which is 0.48, yeah, in relation to the futures price we are saying. So the asset effectively then ST should be able to determine our ST. Remember, we said that at maturity, our ST should be equal to the FP. Yeah. So the holding the asset means that ST will be fairly 50.48. So we are supposed to now hold this asset there, lose the interests, yeah, but incur also storage costs and any other benefit from the carry model. So we are supposed to incur costs. So hold the assets, and incur costs of carry. Now, the cost of carry from the model has already taken in the difference between the benefit and cost. So we're going to use the cost of carry of Kenya shillings. Now it is positive, means that the cost exceeds the benefit of Kenya shillings 3.55. So that is that. Then step number 5, we are supposed to do what? Deliver the asset and be paid the future price. Deliver the asset and get paid what? Paid what you entered the contract at. You see, the future price was determined at the contract at the start, and get paid Kenya shillings 60. So from there now, we are supposed to get our payoff. So the payoff here is equals to what? The future price of 60 now minus, we should be able to minus the cost and the benefit. So the cost and the benefit will be our cost of getting the asset, which is 50.48. Now at expiration, this will be the cost of that asset at expiration, plus the cost of carry 3.55. Yes. So this will give me 60 minus into bracket 50.48 plus 3.55. This gives me 5.97. So the payoff will be positive 5.97, meaning that the value of the futures, there is an arbitrage opportunity. Why? Because the futures contract was sold at a price that was above the riskless compounding rate. So part F requires us now to value the futures contract given the previous day closing price of T minus 1 at 49. So the value of futures contract on the marking to market process will be now a settlement price of 50.48. That is one that the listed exchange will use, minus the prior day closing price of 49.00 to give me, so 50.48 minus 49 to give me 1.48. So it is a 1 plus 1.48. And we said in derivative instrument pricing and valuation, if the value is positive, this means is the gain to the long. Gain to the long. This, my dear learner, has taken us to the end of the lesson, and for us to be able to capture and understand the concept that we have done, it is time for us now to be able to see this concept well through an assignment. The assignment. Consider an asset that is priced at Kenya shillings 900. A futures contract on the asset expires in 75 days. The risk-free interest rate is 7%. Answer the following question, each of which is independent of the others unless indicated otherwise. Part 1, find the appropriate futures price if the underlying asset has no storage costs, cash flows, or convenience yield. Part 2, find the appropriate futures price if the underlying asset storage cost at the futures expiration equals to Kenya shillings 30. Number 3, find the appropriate futures price if the underlying asset has a positive cash flow. The future value of these cash flows is Kenya shillings 5.00 at the time of futures expiration. Part 4, find the appropriate futures price if the underlying asset storage cost at the futures expiration equal to Kenya shillings 30.00 and the compounded value at the time of the futures expiration of the positive cash flow from the underlying asset is Kenya shillings 5.00. Part 5. Using Part 4 above, illustrate how an arbitrage transaction could be executed if the futures contract is trading at Kenya shillings 950. Part 6. Using Part 1 above, determine the value of the long futures contract an instant before marking to market if the previous settlement price was Kenya shillings 895. Part 7. What happens to the value of the futures contract in Part 6 above as soon as it's marked to market? Thank you for your listening and participation.
Welcome to Manifested Publishers.
Happy day, our learners, and thanks for sparing some time to attend this session. In this Sunday session, we are still discussing the futures markets and contracts, and in our discussion in this study session, we will concern ourselves with the factors that determine the futures price, futures contract price. Now, you will recall that in our previous study session, we said that the futures price is given by the spot price of the underlying asset, spot price of the underlying asset. We multiply this with a compounding factor. We will see what this means in this session. Then plus the cost net of monetary, plus now the cost net of monetary and non-monetary benefits. Already, you can see that this is so similar to what we defined in the cost of carry model. Now, you will find that this compounding factor we are alluding to here is that the investor in a no arbitrage market need to be compensated for the opportunity cost of holding what? The underlying asset. So we are saying why the opportunity cost. We assume in finance and through the postulation of the capital asset pricing model that investors and lenders can either borrow and lend their monies at the risk-free rate. So we also assume that if the investor, of the underlying asset can spend his or her money, elsewhere than holding the underlying asset, therefore he needs to be compensated by the risk-free rate. So we added the compounding factor there. And then there are other costs, like, for example, storage costs, and there are other monetary benefits, like, for example, dividend on the stock, and there could be non-monetary benefits, which we call the convenient yield. That, for example, when we have oil refinery, by having not the headache to source for raw material, the crude oil. So that guarantee they have that they can hold the crude oil, then facilitating the smooth process, that is an monetary benefit. Now, let us look at the futures price when we compare it against the expected spot price. So when we look at the futures price, and the expected spot price. So then this will represent the cost of carry. Then if that is the expectation, then with no arbitrage opportunities, we are saying fair prices will be observed, such as the future price should be equal to the expected spot price in maturity of the contract. That's why we have a letter T there. So the expected spot price in maturity. However, now this cost of carry can change, isn't it? Because now we say, because the cost of carry can either be positive or negative, then we find out that the futures price can be greater than the futures price can be greater than or lesser than the spot price. So that is what can happen when this equation is violated by having inequalities this side. So then this futures price, when you compare it to the spot price, so the expected spot price there will be affected. Then because then the cost plus interest tends to exceed the benefit, now there is another factor we need to look at. From this equation also, we said this spot price is the cost to the investor, and this is the interest to be received because of the opportunity cost, right? So we say because the cost plus interest tend to exceed the benefit, then it is more common for the future price to be greater than the spot price. And this is a situation now. This is a situation called, this is a situation called contango. So we have contango over there. So we are saying this element can be negative, right? And therefore making the futures price be greater than the expected spot price, then that will lead to the contango over there. Then also in contrast, yeah, the other side of that, in contrast, so we are saying in contrast, then when the benefits exceed the costs, when the benefits exceed the costs, then we will find that, of course, we will have cost plus interest, the cost plus interest over there. Then you'll find that the futures price will be less than the spot price. The futures price will be less than the spot price. So, and this now is what we call, this is called backwardation. Backwardation. So the backwardation could be now where you find now the monetary benefit here will exceed the costs. And we say the monetary benefits have to be less than, so that you find that the futures price then now will be greater than the spot price. Then, it will be less than, because we are lessing here, then it will lead to a backwardation. Now, having seen the revisiting of that futures price equation, then we need also to revisit three elements that also are the theories that back the factors that determine the futures price. So we need to revisit the theories, revisiting the theories. Now, we have three theories that we will need to revisit. The first is the hedging pressure theory, the hedging pressure theory. Then we have the second, the capital asset in pricing model, the capital asset pricing model, commonly called as the CAPM. Then the cost of carry model, the cost of carry model. So we will need to revisit the postulations of this theory for us to firm up the understanding of the factors that determine what the futures contract price. So we look at the hedging pressure theory once more. Hedging pressure theory. Hedging pressure theory. So in our previous learning, we saw that when there are opportunities that the spot price that is observed does not follow this equation, the investors can be able to execute arbitrage profits, right? So this theory is derived from the work, derived from the work of two economists, There was Keynes there, and then there was Hicks. So comes to the theory of the works of Keynes and Hicks. So, and the postulations here say that if hedgers tend to hold, to hold short positions, and speculators tend to hold, and speculators tend to hold long positions. Futures price will be below the spot price. Now, we know hedgers are participants within the derivative markets who want to protect themselves against risk. That is their primary function. They enter the derivatives market. Speculators, on the other side, are the ones who do analysis, and they want, of course, to forecast about the patterns of the future prices. So for speculators to invest, they must be compensated. And for that compensation was an arbitrage opportunity. Which one then was the futures price being below the spot price, so that they can be able to make a gain. So speculators here, so the speculators require compensation for risk they bear, for the risk they bear. They have they trade only if they're expected to make profits. They trade only if they are expected to make profits. That's what we say. So if there is someone who is interested to protect themselves against risk, this risk could be prevalent at the hedgers, yes, because they don't want uncertainty. There's someone else who has the appetite to stock up that uncertainty, and there's a speculator, therefore it needs some compensation. So hedgers may lose money. So we are saying from this theory, then hedgers may lose money, but they are prepared. For this because the guaranteed futures price reduces risk, and this risk is from uncertainties, and this risk is price uncertainties. So hedgers don't want a scenario whereby they do not know the price of a product 3 months from now, 6 months from now. They need to lock that price to prevent further price uncertainties, which is a risk. The counterparty to that, if they are long, then they are short. Sorry, if hedgers are short, then the speculators tend to be long to provide the counterparty. So that is a stipulation of the hedging pressure theory. And yesterday we saw how investors can be able to enter into markets and take that advantage. Then the other one is the CAPEM. Now, with CAPEM, the relationship between prices and expected spot rate is based on the relationship on the whole market as at a whole. So the relationship between the expected spot prices and future prices is based on the relationship between the risk and return in the general economy. So in the general economy, we know that we can depict the relationship between the risk of return through a diagram here, a graph here. So in this diagram, we say there are two types of risks in the market. There is the systematic risk and the diversifiable risk. So the systematic risk is the one that all market participants now will be able to take. So, and then there is the diversifiable risk over there. So for this now, this would be the systematic risk. Systematic risk. And this is the diversifiable risk. Diversifiable risk. This is as we go there to increase the number of assets, through diversification, and this is the risk and return. A risk here and return over there, and this is the risk-free rate compensation. So normally, for you to get the risk-free rate compensation over there, so it means is what every other participant in the market gets. But the total market risk that people can get here, this is the total risk over there and up to that level. So this is the total risk. So the total risk is a composition of both the systematic risk and the diversifiable risk. So that's why even we are saying from the term stipulation, the compounding factor here should be the risk-free rate. At least the investor should be compensated for holding that investment. Then, therefore, an investor generally requires higher return. So an investor will generally require a higher return to be compensated for additional levels of systematic risk he needs to be to have. And sometimes beyond this point, an investment could hold a negative systematic risk, especially where we are saying what? There could be non-monetary and monetary benefits. So therefore, means that return is, that investment is yielding better. Therefore, the compensation might fall below the risk-free rate. So we are saying an investor generally requires, generally requires higher expected return than the risk-free rate for taking positive amount of the systematic risk than risk-free rate for taking additional positive amount of the systematic risk. For example, if he has to incur more costs, like for example, storage, that could be an element of some systematic risk. The investor is what? Is taking for them to hold a particular underlying asset. Therefore, that compensation must come in the futures price. Also, on the contract, it also, an investor is expected also, an investor is expected to accept a lower, expected return than the risk-free rate, expected return than the risk-free rate, risk-free rate when the systematic risk in an investment, when the systematic risk in an investment is negative. So a systematic risk in an investment could be negative when then the monetary benefits here and non-monetary benefits exceed the cost of storage. For example, when the yield of maybe the gold and also the convenience of holding that gold is high, then the investor needs to accept a less than the risk-free rate, which also would affect the futures price there. Then the third theory we need to look at is the cost of carry model. Costs of carry model. Of course, this is the model then that we introduced ourselves with the study session with that formula, that equation there. So the storage cost, we summarize the relationship between, this time we can give a summary. We summarize the relationship between the futures prices and expected spot prices through the following. So, and this is through what? It is through the storage cost plus the interest paid to finance the asset. So the storage cost over there plus the interest paid to finance the asset, then less the income earned on that asset. So of course, less the income earned on that asset. Because we are familiarized ourselves with that equation, it's vital for us to look at various examples. For example, we could be having non-dividend paying stock. So the non-dividend paying stock. This now, what is relevant in the cost and carry model, there will be no cost of it. There will be no monetary benefits. So the only factor that will affect the futures price there will be down the compounding factor, which is the risk-free rate. Risk-free rate. Now, when we look at the stock indices, now, with the stock indices is a portfolio of stocks. Within the stock indices, there is a probability. Some stocks within the index could pay dividends, others could not. So there are two factors now that will affect the prices. One is, of course, the risk-free rate, and of course now the monetary benefit which will be the dividends, which will be the monetary benefit. Then the other one is the currency. We are going to see the currency valuation later, but in the currencies, we said that you invest domestically for you to earn the foreign return. So you invest domestically, so you'll be able now to earn what we are saying the risk-free rate, and you will incur, some costs or monetary benefit for the foreign. So you must also be able to get exposure to foreign risk-free. Now, for commodities, now this will have, of course, the risk-free rate, We could be having monetary benefits, for example, gold, the monetary benefits. For example, the gold will be able to earn the gold lease rate, what we said in our previous lesson. And also the commodities now will come with non-monetary benefits. Which are convenience yield, the convenience yield. So those are the aspects that will affect the future price there. Having understood that, then this takes us to the end of our study session. And as has been our tradition, we come to the level whereby we say for these study sessions, we have an assignment. For the assignment, we are supposed to, number one, distinguish between contango and backwardation. Distinguish between contango and backwardation. Number two, using relevant examples, explain how the cost of carry model influences the futures contract prices. So, without referring to the material in the study session, the assignment now is, number one, distinguish between contango and backwardation. Number two, using relevant examples, explain how the cost of carry model influences the futures contract prices. Thank you for your participation and listening.
Welcome, learner, to our lesson today. We are looking at the human resource management subject, and this is under the manifested publishers learning platform. And in today's lesson, we are looking at reward management, and under this we are looking at two areas, pay structures and wage systems. We are going to start with pay structures, then we proceed to wage systems. So, dear learner, pay structures in reward management do several things. So one, they provide a framework for managing pay. Pay structures will provide a framework in terms of entry point, progression in relation to the workers. Then number two, pay structures contain the organizations, the pay ranges or scales for jobs grouped into grades, maybe grouped into grades, into bands, or job family level. So it depends on which one an organization has selected. Then three, pay structures define the different levels of pay for job groups or groups of jobs by reference to their relative internal value. So this relative internal value is usually defined by the process of job evaluation. And this is done in consideration of the external relativities of this particular job, so that the value of that job is determined and the worth is determined within the job hierarchy within that particular organization. And then pay structures also provide the scope for pay progression in accordance with the performance, competence, contribution, or service. And what this fourth point here helps an organization to do, you may have two different employees. And these two different employees, though they may have been employed at the same time and they're in the same grade, but their progression now will depend on the performance these particular employees have given to the organization, their competence. One of the employees might, for example, have gone through training, has gotten on-the-job experience, and that particular employee is contributing more, and that employee has made, for example, 5 years or 6 years of service to that particular organization. So when you take into consideration performance, competence, contribution, or the length of service, then that one can help an organization to determine what would be the progression level of a given employee or a set of employees in a given organization. So that is as far as the pay structures are concerned in terms of what they provide in relation to human resource management. So what are some of the guiding principles for pay structures when an organization is providing a pay structure? So what are some of the things that they should look at? So pay structures, dear learner, pay structures, what should be the guiding principles in terms of pay structures? So pay structures should be appropriate. So one, should be appropriate to a culture in an entity. Now, for example, if you are dealing with, say, public service, then the kind of pay structure that should be adopted should be an appropriate pay structure that can take into consideration the culture. And as you have noticed within the civil service ranks, what happens is that employees work for long durations of time, and in most cases they look at the aspect of seniority. So if you are looking at the aspect of seniority and the culture is that employees need to have loyalty and commitment, then the appropriate pay structure that should be, for example, adopted in the public service should take into consideration issues of performance, issues of seniority, and issues of length of service, so that becomes appropriate to that kind of setting. Then secondly, should facilitate a pay structure learner should facilitate achievement of transparency, should also facilitate the achievement of equity, should also facilitate the aspect of consistency in salary administration. So what you're saying, if you are looking at the pay structure, then that particular pay structure that is adopted by an organization, a guiding principle should be that this pay structure should facilitate equity, should facilitate transparency, should facilitate consistency in salary administration, so that it helps an organization to display the characteristics of a good reward management strategy within a particular organization. Then next, a pay structure should be flexible to respond to changes, e.g. skill acquisition, seniority. So basically you are saying you have a pay structure, and if employees for example acquire some skill, if employees for example attain a level of security, let's say for example 12 years of experience, for example. So if you have 3 workers, then this particular structure should provide that this employee who has been in an organization for 12 years could be moving maybe on an annual progression in terms of 3 years, or maybe annual increments and so on. So that becomes a very useful principle in relation to designing pay structures within a given organization. Then it should also facilitate another guiding principle. A pay structure should facilitate ease of administration. Take for example, learner. If an employee has been in one lower, for example, grade and is moving to another grade, so the pay structure should be made in such a way that they could be overlapping, so that that transition becomes smooth and an employee is able to be adjusted in terms of that particular next grade. Then should also facilitate management control of pay. So the system should be good enough so that an organization should facilitate management control of pay issues, so that in case an employee has a complaint, it is possible to be able to look at the pay structure and articulate issues in relation to how this particular pay structure is supposed to be implemented. So that again becomes one of the guiding principles, and it should also be capable of responding to market pressure. Now, what this means is that an organization does its pay structures in the context of, say, a labor market. So in this labor market, there could also be, for example, changes. Let us take an example. Government may provide for minimum pay. So if the government is providing for minimum pay, the pay scales that are being provided, or maybe the pay structures that are being provided, should be able to accommodate the labor market changes, like the minimum pay that are mandatory, so that it pays above that minimum pay, to avoid challenges that could come from the legal perspective, where organizations are not able to explain. Then should also encourage career growth, and development. So, dear learner, what this does, if you look at many systems within working environments, at the lower level, the pay structures would look like they have got lesser, for example, rewards or maybe less pay. But as people move up the ladder, then that particular growth enables those who remain in that particular organization to grow in terms of their careers and to develop to better, for example, emoluments within that particular organizational setting. And that's why one of the guiding principles of a pay structure should be to encourage individuals to make an effort so that they can grow in their careers and be able to advance. So these, dear learner, are some of the guiding principles that should be taken into consideration when designing pay structures within a given organizational setting. Then these pay structures, once you have looked into these, say, guiding principles, it is important to note that there are different types of pay structures that organizations may make use of. Types of pay structures. We can mention types of pay structures. Now, the types of pay structures may vary, and an organization may use specific ones or maybe a combination. And the first type is what is referred to as the narrow graded pay structure. Narrow graded pay structure. Narrow graded pay structure. Narrow graded pay structure. So the narrow graded pay structure is a type of pay structure, and then you have the broad graded pay structure. Broad graded pay structure. Broad graded pay structure. So that is also a different type of pay structure that an organization can make use of. And then you have broad banded pay structure. Broad banded pay structure. Broad banded pay structure. So that is number 3. And then number 4, apart from those 3 structures, you have a career family pay structure. Career family pay structure. Career family pay structure. So you have a career family pay structure, and from that another organization can maybe be able to use that. Then you have a job family. A job family pay structure. And then you have number 6, spine pay structure. So these ones are examples of types of pay structures that an organization may have. So you have the narrow graded pay structure, you have the broad graded pay structure, you have the broad banded pay structure, career family pay structure, job family pay structure, and spine pay structure that an organization can be able to also use in relation to the kind of pay structures that organizations may design or may formulate for purposes of payment of workers. So, dear learner, in today's lesson, we have looked at the reward management topic, and in that topic we have looked at the area of pay structures and wage systems, and initially we have now looked at what are pay structures in terms of what they provide, and we have indicated that number 1, pay structures provide a framework for managing pay. Number 2, contain the organization's pay ranges or scales for jobs grouped into grades. bands, job family levels. Number 3, pay structures define the different levels of pay for jobs or groups of jobs by reference to their relative internal value as determined by a job evaluation to external relativities. Number 4, pay structures provide scope for pay progression in accordance with performance, how the employees perform, competence, contribution, or service. Then we have also looked at now the guiding principles for pay structures, and we have indicated, dear learner, that pay structures, number 1, should be appropriate to the culture in an entity or an organization. Number 2, pay structures should facilitate achievement of equity, consistency, transparency in salary administration. Then number 3, pay structures should be flexible to respond to changes, for example, in skill acquisition, seniority, for example. Number 4, pay structures should facilitate ease of administration of the pay systems. Number 5, pay structures should facilitate management control of pay. And then number 6, pay structures should be capable of responding to market pressure, for example, the labor market minimum wage, that is minimum pay that is provided by government. And number 7, learner, pay structures should encourage career growth and development. So those ones are 7 guiding principles for pay structures. Then we have gone ahead, learner, and looked at types of pay structures where we have indicated that there could be narrow graded pay structures, or number 1, narrow graded pay structure. Number 2, broad graded pay structure. Number 3, broad banded pay structure. Number 4, career family pay structure. Number 5, job family pay structure. Number 6, spine pay structure that organizations may use maybe independently or in combination. So your assignment for the lesson today, dear learner, you have your assignment. Describe your assignment. Describe the guiding principles for formulating pay structures. So the assignment, dear learner, your assignment for today's lesson, which was pay structures and wage systems, describe the guiding principles for formulating pay structures. So that is your assignment, dear learner, and thank you for being attentive and participating in our lesson today. Dear learner, welcome to our human resource management subject. Today we are looking at performance-related pay, which is a subtopic in the reward management area of human resource management. And performance-related pay, as is used in human resource management, performance-related pay scheme is a remuneration system where reward to an employee depends on the performance of an employee, and the performance of the organization. So you can see, dear learner, there are two things. Performance-related pay is dependent on how the employee performs and how the organization performs. And that's why the issue of relationship comes in. So performance-related pay. So the pay is at two performance levels. The employee is expected to perform at a particular level, and the organization itself is also supposed to have performed at a particular level for this to be effective. Now, there are four main features of performance-related pay, and these four main features are the basis of the scheme, consolidated pay increases, variable pay, and pay progression. So when it comes to the basis of the scheme, in relation to performance-related pay, the basis of the scheme must be defined, and the basis of the scheme may, for example, be maybe organizational performance, So the way the organization performs may be the basis of the scheme, so that you look at the overall organization performance, and then the performance-related pay could be determined. Maybe you may want to look at it in terms of maybe a bonus, and the bonuses could be, for example, of various types. So the basis of the scheme may be organizational performance, which may be affected now in terms of the bonus or bonuses to be paid. Then when it comes to the consolidated pay increases, maybe the pay may be increased, pay may be adjusted, pay may be adjusted based on particular parameters that they may, for example, come in, and it will be in a consolidated way, so that a particular specified amount may be the total amount that is given as an increase, as a pay increase, and that may be given maybe at one point in time or over a period of time. And then when it comes to variable pay, the way the word suggests, this may vary and may be paid one-off payment. So let us say in the month of the end of December of a given year, an employee or a group of employees have performed and are supposed to be provided with a variable pay. Then for that particular end of year, maybe December or January, those particular employees, their pay is varied and then readjusted. Or maybe it is varied at one time, and then it's a one-off adjustment, and that becomes the variable pay, which is a feature of performance-related pay. Then there could also be pay progression determined. This could be determined for a given period. So you may, for example, say there will be pay progression maybe at the end of 1 year, say maybe in the month of July or in the month of January, the pay progression will take place, and it will be progressing maybe at a particular percentage, maybe at say 5% of the prevailing, for example, scale and so on. So that again could become pay progression as a feature of performance-related pay. So these are some of the main features of performance-related pay that we have indicated. Looks at specifically the performance of the individual and the performance of the organization. So what could be some of the suitable conditions for performance-related pay? Suitable conditions for performance-related pay. Suitable conditions for performance-related pay. And by this, dear learner, what we mean, what features should prevail on the ground, or what circumstances should prevail in an organization to make it suitable for an organization to operate a performance-related pay system. So an organization should have an entrepreneurial culture. an organization should have an entrepreneurial culture. So where employees are entrepreneurial, then these employees can invest their ideas, can invest their innovation, and that one can lead to better performance of the workers and the organization. So there should be be a practice of employee involvement in decision making. So for you to have a successful performance related pay system, then workers in that particular organization should have gone through a practice of being involved in the decision-making process, so that they can participate fully in ensuring that they can be able to bring in the aspect of performance-related pay in terms of agreeing on objectives. And then number 3, transparency in salary and wage, or what you are calling reward management matters. There should be transparency in salary and wage or reward management matters, so that workers can be able to have confidence in this particular system. Then 4, clear objectives of performance. A clear objective of performance must be in that particular environment, so that it is very clear in terms of what is expected, in terms of the management and so on, in terms of the workers. So that could be very, very clear. Then number 5, supervisors and managers should be well versed and skilled in managing performance. Then there should be a clear communication channel in the organization. And then number 7, full support of the top management regarding performance related pay. So what you are saying, Lana, there should be full support of the top management regarding performance related pay. Is it? And then number 8, payments should be made when they are due, to gain the confidence of employees in the system. So Lana, workers will give the system a benefit of the doubt, and they will want to see one cycle. So if they agree on what is supposed to be paid, they produce on their part and so on, the organization gains, so the workers will be waiting to see, will the management make that particular commitment in terms of payment? So if those payments are made, then workers can support the system. So these are some of the factors that should be suitable conditions for performance-related pay to succeed within a given organization. So today, Lana, we have looked at the performance-related pay area of reward management, and we have listed some of the suitable conditions. We have also looked at the main features, and we can very quickly revise what we have done today. And we have said that performance-related pay scheme is a remuneration system where reward to an employee depends on the performance of an employee and the performance of an organization. And the main features of performance-related pay are 1, the basis of the scheme, then 2, consolidated pay increases, then 3, variable pay, then 4, pay progression. And we have also indicated and discussed that when it comes to performance-related pay, for it to be able to succeed, dear learner, there are certain conditions that should be suitable, or an environment that will be suitable for the success of performance-related pay system. And we are saying that number 1, an organization should have an entrepreneurial culture. Then 2, there should be a practice of employee involvement in decision making. Then number 3, there should be transparency in salary and wage or reward management matters. Number 4, clear objectives of performance should be set out. Number 5, supervisors and managers should be well versed and skilled in managing performance. Number 6, there should be a clear communication channel in the organization. Number 7, full support of the top management regarding performance-related pay. And number 8, payments should be made when they are due to gain the confidence of employees in the system of performance-related pay. So, dear learner, those are some of the suitable conditions under which performance-related pay system can be able to be operated objectively and successfully. So before we terminate our lesson today, you have an assignment. Your assignment for today, examine the conditions, examine the conditions that may make the performance related pay system succeed in a workplace. So dear learner, your assignment, examine the conditions that may make the performance related pay system succeed in a workplace. So that's your assignment, and until our next lesson, bye-bye.
Hello, welcome back to our revision session. In this session, we shall be looking at the December 2021 sitting of advanced taxation. So welcome, and let's solve the questions together. So we start with question 1 of the paper. Question 1 in the current setting is mostly a theory question, and so be keen to be able to look at it keenly. It will always be testing a number of topics, majorly 2 to 3 topics in most cases. So question 1A of December 2021 advanced taxation says, as economies continue to recover from the impact of the COVID-19 pandemic, tax collection in many countries continues to face challenges. This trend has resulted in some revenue authorities resorting to some drastic measures to boost tax revenue. One recent measure taken in monitoring of social media accounts and postings is, to access taxation compliance. Required. Justifying your response with practical reasons, argue the case for or against monitoring of social media accounts to assess taxable capacity and compliance. Note, marks will only be awarded for one position taken. Now, this question is testing what we call emerging trends in taxation. So that reminds you to be keen on all the subtopics in that topic, including issues like high tax, COVID-19 and taxation, tax agents, tax experts, and all that. So in this particular case, we are looking at the impact of COVID-19 in taxation and what tax authorities have resorted to do for them to boost their tax collection. So let's pick the question again. Justifying your response with practical reasons, argue the case for or against monitoring of social media accounts to assess taxable capacity and compliance. And we are told marks will only be awarded for one position taken. So in this case, you were to take one position. That means you are either to argue for or against the monitoring of social media accounts by tax authorities to boost tax collection. But for learning purposes, I've looked at both sides of the coin, so I'll then be discussing arguments for and against monitoring of social media accounts. But in exams, please, in such a question, take one position and talk about it in detail. So one, I'm talking about arguments for monitoring of social media accounts to assess taxable capacity and compliance. Now, today, many business activities are done digitally. So then digitalization and rise of social media has changed the way businesses or other firms conduct their businesses. A lot of firms today do their marketing activities online. A lot of them conduct business and communicate with their stakeholders online. And therefore, the move by KRA and other tax authorities to monitor social media accounts helps such authorities to maximize on their tax administration, and therefore digitalization, in short, and the rise of social media accounts enhances the way people conduct business today, and therefore the move by KRA to monitor social media accounts is a new frontier in tax administration. Number two is that tax is a constitutional obligation that everyone has to bear fairly, and therefore all people must pay taxes, and therefore nobody is to pay a shilling less or more than what they should actually pay. And therefore, the move by KRA to monitor social media postings is therefore a good one to complement the traditional methods or traditional tools that were used by such authorities to ensure tax compliance and administration. Three is that monitoring of social media accounts supplement what we call lifestyle audit activities, such as wealth declaration by taxpayers, in order to determine whether such taxpayers are tax compliant or not. And through such audits, such authorities, including KRA, have been able to make or rather take enforcement actions against non-compliant taxpayers. In other words, I'm saying that monitoring of such social media accounts supplement or complement lifestyle audits by tax authorities to ensure maximum tax compliant by taxpayers. So those are some of the arguments for. And as I said, I'm looking at both sides of the coin. So the second bit, I'm looking at arguments against social media monitoring by tax authorities. One is that most tax regimes, including Kenya's tax system, is based on what we call self-assessment by taxpayers, founded on honesty and trust, where taxpayers are required to voluntarily disclose information about their incomes to their tax authorities. And therefore, monitoring of social media accounts by tax authorities goes against this trust and voluntary declaration of incomes by taxpayers. Two is that social media monitoring by KRA and other tax authorities goes against what we call freedom of expression through the Constitution, as well as other instruments like the international instruments, such as the Article 19 of the UN Human Rights Convention. For many social media users, their postings and communication through social media is just for fun, and for keeping their friends informed about their activities and lives. And so when KRA and other tax authorities starts monitoring such social media accounts, it infringes the the right of expression or the freedom of expression of such taxpayers. 3 is that social media mining by tax authorities, including KRA, may or might punish those who cultivate false image of themselves in the social media or online. In some survey conducted by the British social media users, more than 75% of the people admitted that they were lying about themselves on social media. And that happens in Kenya and all over the world. Many people post information on social media which are not necessarily true about themselves. So today, for example, if I take photos in front of big mansions or big cars every single day and I keep changing them, if I post such on social media, that is not necessarily, may not necessarily be me. And so if KRA uses such information to determine or that to say that I'm not paying taxes as required, then that may not be true. I may end up being punished falsely just because I'm passing information on social media that may not be true about myself. So such as some of the arguments for and against the use of social media, or rather social media mining by KRA and other tax authorities across the world. That is part A of the question. The question is all theory, remember. So I move to part B of the question. It says, a delegation comprising government officials and entrepreneurs from a neighboring countries has visited your country, which is a beneficiary of the African Growth and Opportunity Act, AGOA, to learn more on AGOA and its benefits. A delegation comprising government officials and entrepreneurs from a neighboring country has visited your country, which is a beneficiary of the African Growth and Opportunity Act, AGOA, to learn more on AGOA and its benefits required. Prepare a brief to be presented to the delegation covering the following. Prepare a brief to be presented to the delegation covering the following. 1 is background information on AGOA. 2, conditions to be considered as an AGOA beneficiary country. And 3, trade benefits provided under AGOA. Now, this is a question on the topic economic integration. Now, economic integration, in short, is simply the grouping together of countries in a given geographical region for purposes of promoting trade among themselves. Now, that reminds you to look deeply into trading blocks, especially the East African Community, COMESA, and so on and so forth. But this particular one is on AGOA, that is African Growth and Opportunity Act, AGOA. Now, this is the background information on AGOA. AGOA is a piece of legislation that was approved by the U.S. Congress on 18th May, the year 2000. AGOA is a piece of legislation that was approved by the U.S. Congress on 18th May 2000. The objective of this legislation is to assist economies of the sub-Saharan African countries to improve the economy and to improve the economic relations between the United States and the region. AGOA completed its initial period of validity, and that was in the year 2015. And therefore, it was extended on 29th June 2015 by a further 10 years to 2025. Now, each year, the U.S. President determines the eligible countries from the sub-Saharan Africa to be part of the AGOA. Then AGOA provides duty-free treatment to goods designated from such sub-Saharan African countries to promote the economic growth through governance and free trade. In other words, the aim of AGOA is to assist the sub-Saharan economies to grow and promote trade between that region and the United States. So the key points to note here is 1, the formation of AGOA. Number 2, the countries forming AGOA. And 3, the key objective of AGOA. So let me pick it again, as you may be noting. Number 1, I've said that AGOA is a piece of legislation that was formed and approved by the U.S. Congress on 18th May 2000. The objective of the legislation is to promote and assist the economies of sub-Saharan African countries and to improve their economic relations with the United States. Then AGOA completed its first 15-year period of validity in 2015 and was further extended by 10 years to end in 2025. Then each year, the U.S. President determines the eligible countries from the sub-Saharan Africa for the AGOA. Then how does AGOA benefit such countries? So lastly, I've said that AGOA provides duty-free treatment to goods of designated sub-Saharan African countries to promote economic growth through good governance and free markets. In other words, if such a country exports to the U.S., then the U.S. government will not be imposing duty, that is import duty, on such goods from such countries. And therefore, this will make these goods to be cheaper in the U.S., and therefore such countries will be able to export more and sell more, and therefore benefit more from such a trade. 2, still on that, is conditions to be considered as an AGOA beneficiary country. Remember, we have just mentioned in the first part that every year the U.S. President has the authority to determine which sub-Saharan African country joins AGOA. Now, you could say this in response to this. You say, AGOA authorizes the U.S. President to designate countries as eligible to receive the benefits of AGOA if they are determined to have established or are making continual progress towards establishing the following. In other words, the U.S. President looks at this for a country to qualify as a member of AGOA. 1 is market-based economies, that is, economies based on trade and economic growth. Number 2 is the rule of law. Such countries must be following the rule of law to the letter for purposes of promoting welfare of citizens in such countries. 3 is political pluralism, that is political inclusion, a case where every single citizen in such countries has the political right to do as they wish politically, of course within the limits. And 4 is elimination of barriers to the U.S. trade, that is, such a country must not be imposing any trade barriers between it and the U.S. Government. 3 is trade benefits provided under AGOA. That is, what does a country benefit to be, from being a member of AGOA? So you can say the following are the trade benefits provided under the African Growth and Opportunity Act. 1 is promotion of economic growth, of course through trade or increased trade between the country and the U.S. Government. Number 2 is promotion of political reforms. Remember, one of the conditions to be met by a country to qualify as a member of AGOA is political pluralism and the rule of law. And so through AGOA agreement, there is promotion of political reforms in such sub-Saharan African states. 3 is improve U.S. economic relations in the region. Remember, one of the conditions again that must be met by a country to become a member of AGOA is elimination of any barriers to the U.S. trade. And so by eliminating such trade barriers, such countries are able to have improved U.S. economic relations with themselves, which further promotes their economic well-being. That was part B of the question. Part C, still a theory, is saying alternative dispute resolution, ADR, is a method of handling tax disputes outside the judicial process. All applications for ADR should be through a suitability should go through a suitability test before the application is submitted for ADR. Let me pick that again. Alternative dispute resolution, ADR, is a method of handling tax disputes outside the judicial process. All applications for ADR should go through a suitability test before the application is submitted for ADR. Required: 1. Summarize the disputes that may not be suitable for the ADR mechanism. And 2. Describe the documents that must be submitted to support and facilitate the ADR discussions. Now, this is one of the emerging trends in taxation again, alternative dispute resolution mechanism. Now, as a measure to promote faster delivery of justice by the judicial system in Kenya, the government introduced what we call alternative dispute resolution mechanism, ADR. Now, this is basically any mechanism of solving or resolving tax disputes outside the normal court process, outside the normal legal process. So the question is, part A, summarize the disputes that may not be suitable for ADR mechanism for 3 marks. So you could say this, you could say the following are disputes that may not be suitable for the ADR mechanism. The following are disputes that may not be suitable for the ADR mechanism. This is as per the ADR framework in Kenya. 1 is disputes or suits which involve interest of the public or interest of several persons who are not parties before the court. In other words, ADR mechanism may not be applied in case a party to a dispute is not before the court. In other words, for ADR to be applicable, all the parties involved in such a dispute must be able to present themselves before the court, and if such a dispute involves the interest of the public, then such a dispute cannot be resolved through ADR. Number 2 is election disputes as to public offices. That is, disputes involving election issues that entail election of individuals to public offices, because that again is has public interest in it. And so any party, any dispute that involves or touches on the interest of the public cannot be resolved through ADR. 3 is proceedings which involve prosecution for criminal offenses. So criminal offenses cannot be resolved through ADR. In criminal offenses, it is the state that resolves the disputes, and so the individuals will have to go through the normal court process. 4 is special cases which involve protection of courts, such as claims against minors, deities, and mentally challenged. Remember, these are special groups which may not be able to participate effectively in the ADR process. So such special cases which involve protection of the minors, protection of the courts, such as claims against minors, deities, and mentally challenged, must go through the normal court process, facilitated by the government itself. 5 is cases which are related to serious specific allegations of fraud, fabrication of documents, forgery, and even impersonation. So such cases or disputes must go through the normal court process or the normal legal process, and therefore ADR is not applicable in such cases as per the ADR framework in Kenya. Part 2, the same, is asking, describe the documents that must be submitted to support and facilitate the ADR discussions. Documents that must be submitted to facilitate and support the ADR discussions. 1 is a summary of the issues in the dispute. That is, the particular issues which are being disputed in that particular case. So then the parties involved in the dispute must present to the court a summary of such issues that are in dispute. Number 2 is the relevant assessments, of course, in this case by the legal system. 3 is a notice of objection and all documents submitted to the commissioner. If there is any party in the dispute that is objecting any of the issues presented in the dispute, then a notice of such an objection must be submitted to the process. 4 is the objection decision, that is the decision arrived at as a result of the objection. Another one is a settlement proposal with basis in the law as may be appropriate, if any. That is any proposal by the parties on how to settle the dispute before the ADR process. And lastly, any other documentation as may be required during the ADR discussions. The court may require or order the parties in the dispute to submit any further documentation. So in that case, such documentation become part of the requirement to process and facilitate the ADR process or mechanism. That answers question 1 of the December 2021 paper. Remember, in the current setting, I said question 1 is all theory, and in most cases it will test you on 2 or more topics at the same time. So be keen, especially on the issues of current trends in taxation and any other tax theory. That answers question 1.
Hello and welcome to this session of Advanced Excel Formulas. In this session, we are going to cover formulas that are related to the if statements. If statements are advanced formulas that are normally used when you want to analyze your data and come up with formulas that will give you certain criteria. And with me here, I have created a workbook that will enable us to go through a variety of if statement formulas that are in use here. The first one that we are going to tackle will be the if statement formula. Now, if statement is a formula in Excel that helps in analyzing the contents of a single cell, and it analyzes the contents of a single cell and compares it against a condition that you've specified or a condition that you've stipulated. If the contents of the cell that you are analyzing surpasses the condition that you've set, then the formula will give you a true value, a true statement, or a true formula. But if the contents that you are analyzing don't meet or don't surpass the condition that you stipulated, then the formula will give you a false value or statement. So let us go straight to how the if statement is applied so that we can be able to see what happens if we use the if statement formula. So with me, I have come up with data that we are going to use. This is the student's grade sheet. It has column A through to column E. There is student name, there is the age of students, the exam score, there is age status, and there is grade. So we have a grade here. And first, we are going to look at the age status. And you can see the age status, we've stipulated a condition. There are conditions that have been stipulated here. Now, for age, if the content or the cell that we're analyzing surpasses 20 as the condition, then the formula will give back youth. But if it is less than 20, the formula will give us teen. So if it is greater than, we can use greater than or equal to 20, the formula will return youth. But if it is less than 20, the formula will return teen. So let us see how that is to be done using the if statement formula. First, we are going to precede every formula with an equal sign. So every formula is preceded with an equal sign. Then we type if, then double click on, you can see if checks whether a condition is met and returns one value if true and another value if false. So I'll double click on the if. Then you click on the value that you are testing, the logical test, the value that you are testing here, which is 34. So B4, where there is age, so 34. We are analyzing 34. We are analyzing 34. So if that cell, which is B4, and it represents 34, is greater than, so we are going to look at a condition that you've stipulated. If that is greater than or equal, now the condition is 20, we type 20. Now if B4 is greater than or equal to 20, comma, then the formula should give you youth. So the youth is going to be put in bracket in quotations. So full quotation, youth. Then you close the quotation. But if that is not met, then the formula should return teen. So the formula should return teen, and we are going to have the teen there. So if before the cell that you are analyzing is greater than or equal to 20, the formula will return youth. Otherwise, if that condition is not met, the formula will return teen. So teen is going to be there. You close the bracket, and after closing the bracket, you hit enter, and it returns that this person is a youth. You can see the person is a youth because the age is 34. 34 is greater than 20, and therefore the formula returns youth. Once that has been done, you copy your formula down up to where Tonet Meg is, and the rest will be pre-filled. Now, Lewis is a youth. David Ja is a youth. Cheryl is a teen. Of course, the age is 18. Gary Hall is 15 years. That one is a teen. We have another youth here. Of course, everything has been brought by your formula or the formula that we entered. So if the age is greater than 20, the formula returns youth. But if the age is less than 20, the formula returns teen, as it has been seen in the if statement formula. Now again, we also have exam score, and we are going to analyze the exam score using the condition that have been stipulated here. Now the condition is that if somebody scores greater than or equal to 60, the formula will return pass. But if somebody scores less than, this one should be less than. If somebody scores less than 60, the formula should return fail. So how is that particular formula applicable? So equal sign, then if, then you double click on the if. You click on the cell that you're analyzing, in this case you're analyzing 80. 80 is C4. So instead of clicking, you can just write C4. That is if you know the cell that you're analyzing, comma. If C4 is greater than or equal to 60, the condition is 60 here, 60, comma, then the formula will return pass. So pass should be in quotation. The formula should return pass. You close the quotation. Otherwise, the formula should return fail. So if the condition above on the left is not met, the formula should return fail. And fail should also be in quotation. So fail should also be in quotation like that. So after that, you hit enter, and the formula, of course, has some error. So we see where the error is. So if C4 is greater than or equal to 60, comma, the formula should return a pass. Otherwise, the formula should return fail. So let us see where the error in the formula is. And okay, so the formula is going to be redone. So if C4 is greater than or equal to 60, comma, then the formula should return pass. You close that, comma. If that is not the case, the formula should return fail. So the formula should return fail. Then we close the bracket and we punch enter. Let us see where the error is. C4 greater than or equal to, okay, so the comma was there after C4, then enter. Now it comes back. So we were putting the formula in just after C4, which was wrong. So if you miss a quotation, if you miss a comma, or if you miss where to place anything, the formula will give you errors, which is what we've encountered in our just concluded errors that happened there. So if you punch enter, then pass. That means if you score 80, the formula will return pass. Let us copy the formula down using the autofill here. So you click on the bottom right side of the formula, then drag it down all the way to Tonet Meg. So the rest, everybody who scored above 60, the formula returns pass. Anybody above 60, the formula returns pass. Anything below that, fail. Like Cheryl failed, got 50. Gary 40, that one failed, all the way to 72 here. That is Vim, who scored 72, and that is a pass. So that is how the if statement is applicable in analyzing whatever data that you have in terms of what we've seen here. So the formula can be applied in a variety of ways. You can use it to be able to determine whether your sales were high or they were low sales, or whichever any other analysis that you want to come up with. So that is the if statement. We now want to move to the second analysis, which is nested if. So on our other sheet, we have nested if, which we want to go to and analyze how different things can be done now using the nested if statement. Now, nested if statement, just like the if statement, it analyzes the contents of a single cell. It analyzes the contents of a single cell and compares it against a given condition, and compares it against given conditions. So it analyzes the contents of a single cell, but compares it against given conditions, compares it against given set of conditions, and it returns a true value or statement if the tested condition is met. Otherwise, it will be returning a false value or statement if the tested conditions are not met. So the nested if statement, it analyzes the contents of a single cell and compares the contents against several given conditions, so that it returns a single value statement or formula if one of the condition is met. Otherwise, if no condition is met, then it returns a single false value statement or formula. That is the nested statement here. So in this case, we want to analyze the grades of students on this student's grade sheet. And with me here, I have the students' names. There is Cat 1, there is Cat 2, there is Assignment 1, there is Assignment 2, there is presentation that was done, there is an exam that was also done, then there is total, then there is analysis for grade 1, and also analysis for grade 2 in that particular order. So first, we want to get the total. Remember, for you to get the total, it has to be the summation all the way from Cat 1 to exam. And the best formula that we can use here is AutoSum. You can see AutoSum. You just click on sum and it predicts that indeed you want to sum everything on the left. So that is AutoSum. Then you punch enter. Or you can say sum. Then you double click on the sum. Then you just highlight what you want to sum up to exam. Then you close your bracket then you punch enter. That is the same thing. Anyway, I want to drag the formula down so that the rest of the answers can be pre-filled. Then I want to reduce this to 1 decimal place. 1 decimal place, which means I'll decrease the decimals here. You decrease the decimal so that it's 1 decimal place. Then there is grade 1, there is grade 2, and there is the conditions that we want to follow here. So you can either come up with A, B, C, D, E, or from distinction through fail. If a student scores above 75 or equals to 75, the formula should return grade A or distinction. If a student scores 60 or above, the formula should return either B or credit. If a student scores 40 or above, the student should return C or pass. If a student scores 30 or above, the formula should return D or refer. If a student scores 30, less than 30, if a student scores now less than 30, if a student scores less than 30, that one is to be changed, then that should be an E or fail. So we'll start A through E for grade 1, then distinction through fail for grade 2 here, using the nested if statement. The only difference between nested if statement and the if statement is that for if statement, there is only one condition. But for nested if statement, you'll be comparing the contents of your cell against several given conditions. So straight to the formula, you precede your formula with an equal sign. Then if, double click on the if. So if the cell that you're analyzing is where the totals are, if that is 23 here, H4, which is 23, is greater than or equal, the condition is 75, so greater than or equal to 75. If H4 is greater than or equal to 75, then comma, this formula should give you A. So you type A, then close it in the quotation marks, then comma. Again, if, again you double click on the if, the same H4, which is 23, is greater than or equal to, the other condition was 60, greater than or equal to 60, comma, then the formula should give you credit. So the next one there was credit. Then that one is also enclosed in the closing bracket, then comma. If the same cell, H4, formula is missing an opening here. So if, then we double click on the if H4, the same cell, is greater than or equal to 40, greater than or equal to 40, then the formula should give us C. So we're going to type C in quotation, so that will be C. Then you close the C like that. I missed here, so this ought to have been D. So I'm going to correct this to D. There is A, not B, but B, A, B, C. Then now we move. Again, if H4 is greater than or equal to 30, comma, the formula should return or give us a D. So that one is a D there. We close. Then now we are on the last one. We have A, we have B, we have C, we have D. Now for the last one, there is no need of starting with if again. You just come up with the comma, then you bring the quotation. Of course, it assumes that whatever has been said already is not met. Then whatever follows will be E. That is what, if what is on the left is not met, then the formula should just give you E straight away. So if you don't need to be in the category of A, B, C, or D, then you'd be in the category of E. Then you close the brackets depending on the number of brackets that are open. So how many brackets are open? 1, 2, 3, 4 brackets are open. You're going to close ours with, again, 4 brackets. So 1, 2, 3, 4. After that, you hit enter and it will give you that the first person indeed scored an E. So you can see our formula here, the way it has been typed on the formula bar, and that is what is expected of us to do. So you copy it down and the rest will just appear. A few people have gotten E's, others have gotten A, like 80 is an A, 43 is a C, 62 is a B, 39 is a D, all the way to 24 being an E, 85 is a, we have C's, and we also have other D's there. So this is the score after analyzing these particular grades using the if statement formula. Again, we want to analyze the same thing, but now where there was an A or E or D or C, we are going to replace with distinction, credit, pass, refer, and fail in that order. This was 75. This was 75. Let me see if that was 75. It is correctly put. So again, we want to now replace with the distinction through to fail using the same formula. So equal sign, if, then you double click on the if. If the cell that you're analyzing is this 23 where there is total, that is E4, if that is greater than or equal to 75, comma, then the formula should give us distinction. The formula should give us distinction. The formula should give us distinction. Comma, if, again double click on the if, the same cell is greater than or equal to 60, comma, then the formula should give us credit. The formula should give us credit. So you enclose, comma, then again, if the same cell is greater than or equal to 40, then the formula should give us that was if it's greater than, that was pass, comma, then again, if the same cell is greater than or equal to 30, comma, the formula should give us refer. The formula should give us refer. You close the bracket, then the last one automatically, comma, then you bring in, the other one is fail. The other one is fail. The other one is fail. Then you close with the number of brackets that are open. 1, 2, 3, 1, 2, 3, 4. That is 1, 2, 3, 4. So you're going to close with the 4 brackets. 1, 2, 3, 4. I hope all the brackets have been presented, and that one is a fail for that particular student. So this one had everything. There was 30, there was 40, yeah. So once that is pre-filled, you copy your formula down again, and let us see if it is corresponding to the way we needed. So you can see E is fail, A is distinction, C is pass, B is credit, C is pass, B is credit, D is refer, E is fail, A is distinction again. So this is how you analyze your data using if statement and also using nested if statement. So that is if statement and nested if statement.
So let us look at allowable legal costs. Allowable legal cost number 1 is the legal cost for a lease. Legal costs for a lease not more than 99 years. 99 years. So when you are doing your business and you decide you want to occupy a property, let's say a building, and that building you are going to occupy for 99 years, 80 years, 70, 10, 5 years, 1 year, and you decide to make it legal, you require a lawyer to help you in preparing that lease. And that lawyer even sign that document of the lease. And you pay for that service. That is what we call legal cost for a lease. As long as it's 99 coming down, that is a allowable expense. And that means if the lease is for more than 99 years, it can be 99 and a half years, 100 years, 105, 120, 150 years. That legal cost is not allowable. You cannot deduct it against the taxable incomes of the business. Number 2, we have legal costs for preparing staff contracts. That's another one. That in your business, when you are hiring your staff, some of your staffs may tell you, I want you to make this agreement legal. And so you will have to hire a lawyer. In the process of hiring a lawyer, they charge you some fee and you pay. When it comes to the taxation of your business, that you are allowed to deduct that legal cost when you're determining the taxable incomes of the business. After that, we have the third one. We have legal costs relating to customers and debtors. Although debtors are your customers, but it's good to specify, because most of the time you find that those legal costs normally relate to the debtors. A good example, a debtor has refused to pay you what they owe you. So you decide to take the legal process. You go to a lawyer, ask that lawyer sorry, if he or she can prepare for you a demand letter. You take to that customer to notify them that you're going to take a legal process. And now that lawyer writes for you that demand letter, but charge you like 3,000, 10,000. When it comes to the determination of your taxable income, you'll be allowed to deduct that legal cost against your taxable incomes of your business. Number 4, we have legal costs to list a company at stock exchange. We normally have what we call listed companies or quoted companies. These are companies whose shares are traded at stock exchange market. In Kenya, we have Nairobi Stock Exchange Market. That means anybody who may want to become a shareholder of that company just need to go there and you buy shares of that company. It's open. When that company was getting there, it could have incurred several costs. One of them was to hire a lawyer to help them in preparing the document for presentation to, for example, Capital Market Authority, for them to be allowed to, for their shares to be traded there. That legal cost they paid when they were getting there, it's supposed to be an allowable expense. Number 5, legal costs to defend property rights. It means you have, for example, land somewhere. You own that land. Or you could be owning a motor vehicle. Somebody from outside just come and say, this land used to be mine. This motor vehicle used to be mine. It was stolen from me. This building used to be mine. You decide, no, I bought these items legally. So you decide, let us go to court so that the judge can decide who owns these items. And because you are not a lawyer, you hire one to go and represent you. In the process, he charges you some legal fee That is the one we are saying legal cost to defend your property. And when you pay, that become an allowable expense. The last allowable legal cost, number 6, is the legal cost relating to tenders. Tenders relate to your business. For example, you want to supply something to your customer. They tell you you have to tender. But maybe because you don't know the process of doing that, you hire a lawyer. Come and help me prepare these tender documents. They charge you some legal fee. That legal fee is supposed to be allowable. So these are the allowable legal costs. While still under the legal costs, I want us to also look at non-allowable legal costs. Non-allowable legal costs. It is the opposite of the allowable legal costs. That these are the costs or expenses which cannot be deducted against the taxable incomes of the business when you incur them. They are which one? Number 1, we have legal costs. Legal costs to purchase or transfer a fixed asset. The other name we normally give that cost is the conveyance fee. Why don't we allow it? Because here we said the legal costs we allow are the ones that are revenue, that the benefit can be realized within a year. The one that benefit extend beyond 1 year, we don't allow. Fixed asset is one of the item where you enjoy benefit for a period that is more than a year. So when you are purchasing, selling, you incur some legal cost that you're not allowed to come and deduct it against the taxable income of your business. That cost is also called conveyance fee. This is very common. So it is usually not allowable expense. It is related to the fixed asset. It's not allowable. We have number 2, legal costs to defend. To defend a crime. So what we saw, legal costs to defend your property is allowable. But if you commit a criminal activity and you're taken to court, you hire a lawyer to defend you, that legal cost will not be allowed by the taxman to come and deduct it in the business. Why? Because it is not business related. You are not doing business. So that is usually not allowable. Number 3, legal costs relating to bank loans, bonds, and debentures. Now we are talking about legal costs relating to bank loans. Why don't we allow them? Because loans are long-term financing. That when you take a loan, the bank will tell you to pay after 8 years or within a period of 8 years, 10 years, or even some others go to 15 years. So it's a long-term item. So the legal cost you incur when you're taking that loan is usually not allowable. Same case related to bonds and debentures. When you hear companies issuing bonds, issuing debentures, they are taking loans from the members of the public. And being loans, they are long-term. They will tell you they will pay you after 10 years or within a period of 10 years, 15 years. So the legal costs in the process of issuing those debentures, bonds, are usually not allowable. After that, we have number 4. Legal costs relating to memorandum of association and partnership deeds. Partnership deeds are also called partnership agreements. What is the memorandum of association? In law, we normally consider that as a constitution of the company. that it is the document that guides the company in the long term. So being in the long term means if the company lasts for 25 years, that memorandum of association will be there for 25 years. So it's a long-term document, not revenue. We call that capital expenditure. Partnership deed or agreements, the same. These are agreements that are signed between partners. And this agreement will be there in the partnership as long as the partnership is there, guiding the partnership, how they are supposed to operate. So it's a long-term document. So we don't usually allow based on that. After that, we have number 5. Legal costs relating to patents, copyrights, and trademarks. Now, legal costs relating to patents, copyrights, and trademarks. Now, this in financial accounting, we used to consider them as intangible assets. Intangible assets used to be classified under fixed assets, long-term assets. So you can see the reason why we don't allow them, because they are long-term, capital and not revenue. So legal costs you incur relating to that, or those ones, are usually not supposed to be allowable. Another non-allowable expense, legal costs, number 6, is the legal costs relating to breach of contract. That or contracts. That if your business break one of the contract you have with your trading partners, be it customers, suppliers, be it staff, and they take you to court, and the court determine that you actually broke that contract, and actually sometimes we are going to see they fine you, that is not supposed to be allowable because you're not supposed to be breaking contracts. Another one, number 7, legal costs relating to tax matters. Yep, we are going to learn. Another one is that sometimes the KRA, taxman, can, for example, assess you and tell you are supposed to pay a certain amount of tax, but you're not satisfied with that. You decide to appeal or even object, but you don't want to do it directly. You hire a lawyer to come and help you in your defense. That legal cost you pay there is not supposed to be allowable. And this we are going to learn. It does not just restrict itself to the tax matters or legal costs relating to tax matters. It also says that all other expenses, as long as they are connected to tax, they are usually not supposed to be allowable because it's assumed you are the one who is supposed to handle your own tax issues. The last one, number 8, court fines and penalties. Now, when you talk of court fines and penalties, when you are fined, it means that you are the one who was on the wrong side. So it means that is not supposed to be related to the business. You did something that was outside what you are supposed to do. So when you are fined, you pay that fine. It's connected to legal matters. That is usually not supposed to be allowable. So these are the allowable legal costs, the non-allowable legal costs. But don't forget, we are still under the allowable expenses. Only that the legal one normally have several allowable and also non-allowable, and we had to look at them. So we go back to the list of the allowable. After number 5, we have number 6, another allowable expense of the business. Number 6, payment to trade associations. Now, to differentiate this allowable expense numbering, as you can see, we have number 6 here. From this allowable legal cost and non-allowable, let me rename this one as A, B, C, D, E, and F. Same case here. A, B, C, D, E, F, G, H. Yeah. So that is just the numbering so that you can differentiate this continuation here from the legal costs. Now, back to number 6, payment to trade association. As the word say, trade association is an association that is related to your trade. What do we mean? For example, if you are operating a bank, they normally have an association called Kenya Bankers Association. It is there to improve the banks, help to fight for the interest of the banks. If you are in manufacturing, there is an association called Kenya Association of Manufacturers. It is there to trade and protect the interest of the manufacturers. So when a business pays to this association, it is helping to strengthen them, to help them fight for their interests. So that amount is supposed to be an allowable expense. Number 7, another allowable expense is the employer contribution on behalf of employees to pension schemes and provident fund. Which are these schemes? Pension scheme or provident fund is where employee and sometimes the employer make a saving for the retirement of an employee. A good example, in Kenya we have NSSF. When you contribute to NSSF, according to the law, the employer is also supposed to contribute similar amount for you. But when they do that, the time of their taxation, they will be allowed to come and deduct that amount against the taxable income. So that is an allowable expense. Number 8, research costs. Research costs and payment to research organizations. Research costs. If you are in the business, for example, you want to introduce a new product. Before you do that, to increase the chances of it succeeding, you need to do some research. What do the customer want? Are they okay with what you are giving them? In the process, those research costs you incur, at the time of taxation, you'll be allowed to come and deduct them against your taxable income. Same case, research payment to the research organization. A good example, if for example a farmer make a contribution or donation or payment to KEFRI, Kenya Institute Kenya Forest Research Institute. So what do? They carry out research on the best, for example, trees that farmers can be able to grow and get maximum benefit. So when a farmer contributes to them, that is supposed to be an allowable expense when it comes to the year taxation. So research costs and payment to research organization. Number 9, we have advertisement expenses of revenue in nature. So the key thing there being advertisement expense of revenue in nature. Revenue, we said these are expenses you incur and the benefit is realized within a short period of time, usually within a year. So when it comes to the advertisement, you may find advertisement on radios, TVs, newspapers, preparing brochures. When you advertise in them, it is usually assumed, for example, when you advertise on radio, the customer can already remember what you have advertised within probably 2 weeks, 1 month. After that, they might forget what you advertised unless you continue advertising. So it's revenue within a short period of time. Those are allowable expenses. But it is important to note that capital advertisement expenditure are not allowable. You can put that. You note that capital advertisement expenditure are not allowable. Capital expenditure, we said, these are expense where you incur an expense, but the benefit you derive over a long period of time. It is the opposite of revenue. A good example is construction of a billboard, construction of a signpost, construction of neon signs. These are long-term advertisement items. When you put a billboard somewhere or a signpost, it advertises you for 10 years or even 5 or even 50. Some are there forever unless you do rebranding. So the cost of putting them up there is not allowable. What we do for them, we claim the capital allowance we talked about here. And we are going to learn, we claim the capital allowance we call wear and tear allowance, whose rate at the moment is 10%. So you take 10%. So if you construct a billboard for 100,000, first year you take 10% of it, 10,000. Then when you get to the second year, another 10%, but we're going to learn it's usually on a reducing balance. The third year, 10% that way, but on a reducing balance. So capital advertisement expenditure is usually not allowable. Then we go to number 10. Number 10. Number 10 of another allowable expense is the employer contribution on behalf of employees to members club. But that members club must be related to employees' work. Employer contribution on behalf of employee to members club. A good example of this is accountants. For you to be a fully recognized certified public accountant of Kenya, you must be a member of ISPAC, even when you are done with your CPA. When you become a member, you will note every year you have to contribute something we call subscription fee. Now, when you get employed, the employer may tell you, I'll be contributing that for you. Every year, I'll be contributing that for you. Because it is related to your work, that will be allowable when it's determining the taxable income. Number 11, we have realized foreign exchange loss. So, when you are looking at the incomes, we had specified that realized foreign exchange gain is a taxable income. Unrealized foreign exchange gain, an untaxable income. How about in case a loss is generated? If it is realized, it is an allowable expense. If not realized, it's usually an unallowable expense. Number 12, another allowable expense, donation to charitable organizations. that is supposed to be another allowable expense. Question is, which are these charitable organizations? According to the Income Tax Act, it specifies that they include any organization that advances religion, education, or to alleviate the poverty in the society or suffering in the society. If you look at that definition, religion, we are talking about churches, mosques. When you talk of education, we are talking about schools. When you talk of alleviation of poverty or suffering, we are talking about like Red Cross. We are talking about NGOs. So when you make a or your business make a donation to them, that is supposed to be an allowable expense. And this we are going to learn. Any other donation is not supposed to be an allowable. Any other. So if you find donation to a political party, that is not supposed to be an allowable expense. A general donation, that is not allowable expense unless it is specific, it's to a charitable organization. Number 13, we have interests on money borrowed, and invested in business. That if a business take a loan from a bank and that money is invested in your business, the interest you pay every year, every period, that's supposed to be an allowable expense in that particular year. And we saw that there's another form of loan, usually taken by the limited companies, debentures. When a company issue debenture, or bonds, when a company issue bonds, these are forms of loans. So when they pay interest, those interests are supposed to be allowable expenses. After that, we have number 14. Payment to directors of a company for service rendered. That's supposed to be a allowable expense. Directors are considered to be employees of the company. So when you pay them director salary, director's fee, director commission, allowances, all these are supposed to be allowable expense because they have rendered the services to your business. So these are the allowable expenses of the business, and this is according to the Income Tax Act. You go, you get them there. After looking at the allowable expenses, we need to look at non-allowable expenses. These are expenses which cannot be deducted against the taxable incomes of the business. Which are these non-allowable expenses? We have number 1, non-revenue stroke capital and non-commercial expenses of the business. That is number 1. This is actually the opposite of what we saw in the allowable number 1, where we said all revenue and commercial expenses of the business are allowable. And we explained. And we said these are 2 broad terms. Same case here. These are 2 broad terms. And when we talk of non-revenue or capital, these are expenses of the business where the benefit is realized over a long period of time. A good example is the costs of a motor vehicle, a fixed asset. You purchase a fixed asset, you don't use it with 1 year and that is over. You use it 1 year, 2nd year, 3rd, 5th, that way. So its cost is not allowable. What we do with it, we said, is to claim a capital allowance, which we said is supposed to be allowable expense. The other one is non-commercial. Non-commercial, we said these are expenses which are not related to the business activities. A good example we said, private expenses of the owner, like rent expenses of the owner at home, electricity expenses of the owner at home, salaries and wages to the house help, gardeners at home. These are usually not allowable because they are not commercial, they are not business related. So any expense that you come across that is non-revenue or capital, that is non-commercial, know that that is not supposed to be an allowable expense. Number 2, we have non-trade, bad debts written off. We said trade bad debts written off is allowable because you are writing off a debt relating to the business trade. Like when you sell goods on credit, they refuse to pay. That's allowable. But those that are not related to the business, for example, you had sold a fixed asset, you had lent money to your customer, your staffs, your relative, they refuse to pay, and after 4 years you decide to write them off, those you cannot be allowed to deduct them against your taxable income of the business because they are not related to what you do on a daily basis. Number 3, general provision for bad debts. The other way to put it is increase in general provision for bad debt. We had said if it is specific provision for bad debt or increase in specific provision for bad debt, that is allowable. General provision, we said, normally arises as a result of estimation. So when you compare general provision at the start and at the end, and you find that they have increased, for example, at the start 20, at the end 25, that year it means that you created 5 million more. That is not supposed to be allowable against the taxable incomes of the business. Number 4, we have depreciation. Depreciations are usually not allowable. And we said depreciation is an expense related to the accountants. In taxation, we don't recognize that. Instead of depreciation, we recognize the capital allowances. So depreciation is not allowable. Number 5, we have the costs of fixed assets. Although we had said or mentioned that under the cost of fixed assets, so this is an unallowable expense, and we said we had mentioned this one here, that capital expenditure or non-revenue expenditure are usually not allowable. Reason, they are long-term costs. So you benefit out of them in the long term. So we don't usually allow them. Number 6, we have loss on disposal of fixed assets. Fixed assets. That when you dispose your fixed asset, like if you have motor vehicle as a fixed asset, furniture as your fixed assets, and you dispose them in the course of your business, if you generate a loss, it's usually non-allowable. And actually, if you remember, we said when we were looking at the incomes of the business under non-taxable, we said income or profit from the selling of fixed assets we don't tax because these are not the items that you deal with in the business. So you make a profit, don't tax. You make a loss, don't allow it. Don't deduct it against the taxable incomes of the business because these are not the items you deal with in the business. They are not stock. They are not goods. Number 7, we have loss on disposal of investments. Now, why don't we allow the loss on disposal of investments? It's because of this. Investments are different activities from what you do on a daily basis. So when you dispose your investments like shares, rent of property, you make a loss, let it be remain in the those investments. If it is rental and you have rental income, deduct it against now rental income. If it is shares, you dispose, you make a, it's supposed to remain there. If you're supposed to tax that income from shares, it remains there. Deduct against that income of that share. So, but don't bring it in the business. It's usually a non-allowable expense. Number 8, we have impairment. Impairments of intangible assets. We said depreciation is usually for tangible assets. For intangible assets, we don't usually depreciate them, we impair them. So impairment is the same as depreciation, only it relates to intangible assets. So same way, we don't usually allow them. Number 9, we have private expenses of the owner. Private expenses of the owner. So, we had also mentioned here that it is a non-commercial expense. It is not related to the generation of income. It's also important to note specifically expenses relating to the owner, electricity expense relating to the owner, salaries, rent, name them, water at home, don't bring them into the business. They are not usually allowable because they are not commercial. Number 10, we have all forms of taxes. All forms of taxes. Taxes like which one? Income tax, corporation tax, value added tax, stamp duty, excess duty, import tax, or what we call custom duty. All these are usually not allowable. If you say any form of tax, don't allow, don't deduct, it's not allowed. Not only that, we have number 11, all expenses relating to tax. This I had mentioned when we were looking at the allowable expense and the legal costs, where we had said that legal costs relating to tax we don't allow. Now I also expound that not only the one relating to legal, but any expense relating to tax, like tax consultancy fee, legal fee to hire a lawyer, any other. Sometimes you may not have paid your taxes, and the taxman charge you the penalties, charge you the interest on the tax overdue. All these are not supposed to be allowed. Any expense related to tax, we don't usually allow. Number 12, operating loss. Operating loss exceeding 10 years. Those are usually not allowable. What do we mean? That if you generate a loss in the business in 1 year, let's say in the first year, you can carry it forward to the next year, year 2. If in the first year you made a loss of 10 million, year 2 you make a profit of 30 million. Before you are taxed on 30 million, the taxman allows you to deduct the 10 million, the loss you made in the first year. So in the second year, instead of being taxed on 30, you'll be taxed on 20. So it is favorable to you. How about in case second year you don't make a profit? You can carry the loss of the first year and now the second year to the third year. Deduct them against the taxable profit of that year. If that year you don't make a profit, carry it to the fourth year. You can do that up to a maximum of 10 years. But after it exceeds 10 years, for example, the one you generated in the first year, now you are in the 10th year, you are moving to the 11th year. In the 11th year, if you make a profit, don't deduct against the loss you generated in the first year. It is not allowed. You can now only deduct it against the loss you generated in the second year. Maximum period we are saying there, you can carry forward an operating loss is usually 10 years. That is number 12. Number 13, we have all donations except to charitable organization. That we had said under the allowable expense, donation to charitable organization, and we gave example: churches, schools, Red Cross, Children's Home, these are charitable organizations. Those are allowable. When you have any other form of donation, don't allow. To a political party, a general donation, don't allow, unless it is specific is to those charitable organizations. Number 14. Number 14. All provisions and reserves except specific provision for bad debts. That when you are looking at allowable expense, we said specific provision for bad debt is usually allowable. General provision is not allowable. Not only that, and actually under the non-allowable expense, we had mentioned that general provision for bad debt is not allowable. But it can even go beyond that. That you may have provision for salary. Like if you know next year you have salaries to pay. Next year you have rent to pay. You may provide it in this year. That this is the provision for salary for next year. That is not allowable. Something equivalent to that is reserve. That if you realize that next year you need to pay rent, electricity, you may put some money in the reserve somewhere to be used when that time comes. That is not allowable. If you decide to deduct it in the incomes of the business of that year, it is not allowable. It can only be allowed when you incur that expense now. When that time comes and now you need to pay electricity and you pay next year, that will be allowable against the incomes of next year. But any other is usually not allowed. After that, we have number 15. Unrealized foreign exchange loss. We said what we allow is the realized foreign exchange loss because it's already generated, it's already incurred. But unrealized, where you say if you exchange foreign currency, you think that you're going to make a loss because of the current exchange rate, but you have not changed that currency. That loss cannot be deducted against the incomes of the business. You are not allowed to do that. Number 16, we have expenses relating to the owner of the business. Expenses relating to the owner of the business. What does that mean? You normally find, like in partnership, the partners may be working in their business. So they decide to pay themselves salaries, commission. Sometimes they charge interest on capital they have invested in the business. Because they are paying themselves, that is usually not allowable. Anything paid to the owners of the business. Same case when it comes to the company. The company is owned by shareholders. So at the end of the year, the shareholders may decide to pay themselves dividends. And we have several forms of dividends. You can have interim dividend, final dividends, proposed dividends, any kind of dividend. It is relating to the owner. That is usually a non-allowable expense. So this one here are the ones that we call non-allowable, and they cannot be deducted against the taxable incomes of the business. So that one mark the end of this topic of looking at the incomes of the business, the classification, where we have the taxable, the non-taxable incomes, where we have the expenses, allowable and non-allowable. And this one generally carry all the weight as long as you are taxing the business. It's the core area. Actually, I call it the constitution relating to the taxation of the business. So you have to really understand these expenses and the incomes. The one we call taxable, the non-taxable. The expenses are allowable, non-allowable. So it's my prayer that you go through them all alone, look at them one by one, try to understand what we have explained. So for now, I think for this topic is over. Then it's my hope that I'm going to see you in our next topic. The next topic would be about one of the allowable expense that we had here, the allowable expense number 4, where we talked about capital allowance. In the capital allowance, we said it is usually granted in place of depreciation, where we say depreciation is for accountant. In taxation, we call that capital allowance. And we said it is used in relation to the cost of fixed asset. So how do we grant capital allowance? And if I remember, we also said there are several. There is an investment deduction, industrial building deduction, the wear and tear allowance, the farm work allowance, the mining allowance, and diminution in value of roost tools. So I hope to see you in our next lesson. Thank you.
In this video, we are going to see how the if statement, that is if and statement and if or statement, are used for analyzing data, or how the advanced formulas for if statement, let's say if and statement, and also if or statement are used for data analysis in Microsoft Excel. Hello and welcome. My name is Nicholas Sikali. So with me here, I have a student's grade sheet that is prepared so that we can be able to use it in applying this formula or putting this formula into practice. Now, the if and statement is an Excel formula that analyzes the contents of different cells, or analyzes the contents of various cells, maximum of 30. It then compares the contents of those analyzed cells against several given conditions. If the conditions are met, that is, if all the conditions are met, now that you're speaking about if and, if all the conditions are met, a true value statement or formula will be brought by this particular formula. But if any of the condition is not met, then a false value or statement will be brought by this formula. For a true value or statement to be brought by this formula, then all the conditions must be met. So all the conditions must be met for a true value or statement to be brought by this formula. That is if and statement. So let's put that into practice and see how the if and statement is to be applied. So all the formulas in Excel are preceded with an equal sign. So we are going to start with an equal sign. Then once we have the equal sign, if, then double click on the if. Then we bring on board and, you can see checks whether all arguments are true and returns a true if all arguments are true, of course. So double click on the and once we have and, that is if and, then the first cell that you're analyzing is age. So you click on the age, that is B4. So if B4 is greater than or equal, so if B4 is greater than or equal, the condition here is 20. So if somebody's age is greater than 20, if somebody's age is greater than 20, comma, if in financial accounting you click on, that is C4, if C4 is greater than 70, the condition here is 70, that is greater than or equal to 70, greater than or equal to 70, comma, if MA, that is D4, so you click on D4, is greater than or equal to 72, greater than or equal to 72, comma. If this is now the last one, tax, E4 is greater than or equal to 75. The conditions are here, 75, can see 20 through to 75. Then if all those conditions are met, so you close the bracket, then comma, then if all those conditions are met, then the formula should return a price, and that price will be your age multiplied times 100. It will be your age multiplied times 100. So which means that we'll have to click back on age, then we multiply that with 100. We multiply that with 100. Otherwise, if you don't meet the conditions that have been stipulated, if you don't meet any of them, then the formula should return no price. The formula should return no price. So you write no price in those quotations, then you close the bracket to finish it up. So that is how the if and statement is applied. So if all the conditions stipulated are met, the formula should return the student's price as the student's age multiplied times 100. Otherwise, the formula will return no price. Let us see. If you hit enter, there is no price for this particular person because maybe there is a condition that this person did not meet. So looking at that, age Kent met the age but never met this one here, that is financial accounting was to be above 70, so he's not getting the prize. MA he surpassed, tax he also surpassed, so he's not getting the prize because of the mark that is scored in financial accounting. He did not meet the condition of 60 as stipulated by what we have here. So you can see the formula, the way it is written here, if, and all those arguments that have been put in place. If it's to be copied down, let us see what do you get if it is to be copied down. So surprisingly, only one person is getting the prize. This is Julie Jael, who surpassed all the conditions that have been set here. So it's only one person that is going to get the prize here. Anyway, a few can be adjusted, like this one is missing the prize only on the basis of age. So we can adjust the age of Gary to around more than 20, that is 21. If you adjust here from what was there to 21, then it brings now a price of 2,100. That can be seen there. Another person that was closer to getting the prize, another person that was closer to getting the prize is this Paul Henry. So for Paul Henry, it's only because of FA got 58 instead of the required 70. Kent Lewis missed only because of FA, so we can adjust Kent marks to just about there, 71, so that he also gets the prize. The formula changes to now a person getting the prize. There is one here who is not getting the prize because of so many reasons. Maybe Chris Hope. Chris Hope met everything except age and tax. Age and tax here. So for Chris Pop, we can adjust the age to 20. Then you adjust the tax here to tax to 76, so that it brings a prize here. So there are those who are getting prizes and there are those who are not getting prizes out of what we've just done in this formula here. So that's how you analyze using the if and statement. Now, what about the tour? So we want to say that if you meet all the conditions, the formula should return granted. But if you don't meet any, the formula should return denied. So if you meet, it will be granted. If you don't meet any, it will be denied. So again, we want to enter the arguments, equal sign, if, double click on the if, you bring in the and, you double click on the and. So if this is greater than or equal to 20, the condition is 20, comma, if this is greater than 70, comma, if this is greater than, something I missed here, is greater than is greater than or equal to 72. So I'll be coming back to this place here. It should be greater than or equal to before we proceed. So if this D4 is greater than or equal to 72, comma, if this tax is greater than or equal to 75, then you close the bracket. Then if you meet all the conditions, the formula should return granted. The formula should return granted. Anyway, failure to meet a condition, the formula should return denied. The formula should return denied. Then we close the bracket, and that one there is now denied. So if all these things happen, this granted and this denied, then you punch enter. You can review how the formula look like. There. Then you enter. Now this one is granted. All the others, let's see what happens to them. You can see granted, denied, denied, granted, denied, denied, granted, and all that. So all those that have been granted also got a prize, and all those that have been denied also did not get a prize. So there is one here, Paul Henry. There is Philip Tan. Let's see why Philip Tan missed. There are those who missed narrowly. Maybe those ones can be, you can just adjust a few things and see what happens here. Like so many people here were denied, like Philip Tan. Tonet Meg, we can allow Tonet Meg. Age is tick. FA, we can say 72 or 3. Then tax, you can say that you're adjusting this to around 8. Then also Tonet will be granted. So it changes immediately as you adjust in your formulas. So prizes, people that are getting prizes, that is 1, 2, 3, 4, and 5. And people that are missing, also the ones that are written no prize are missing to get this. So that is the if statement formula in Excel. What about if or statement? There is also if or statement that you want to use to do the same thing. The difference between if and if or is that for if and, all the conditions must be stipulated for a true value or statement to be brought. But for if or, if you meet any of the conditions stipulated, then a true value or statement will be brought. So if you meet any condition now here, any, you don't have to meet all, then a true value or statement will be brought. Let us see how the if or statement works here. So equal sign, then if, then now instead of and, you write or, all the rest will remain the same. So if this is greater than or equal to 20, greater than or equal to 20, then if this is greater than or equal to 70, you can see the conditions are still here, comma, if this is greater than or equal to 72, you can see 72 here, comma, if this is greater than or equal to 75, then let us see what happens. If you meet all those conditions, the formula should return the price. We are talking about the price as your age. So you click in age multiplied times 100. As your age multiplied times 100. Otherwise, the formula should return no price. So the formula should return no price if you don't meet the conditions stipulated. Then of course you close the bracket and you punch enter. The formula has a problem, so we are going to see where the formula has a problem, and it is here. So if E4 is greater than or equal to, oh yeah, there is a problem here. So if E4, there is no if here. So E4 greater than or equal to 75, then we've adjusted the formula, and after that you hit enter. So the first one is getting a price of 3,400, that's just like the other one. And what if we copy down? Let us see what happens for if or. Now most people are getting. You can see almost everybody is now getting because at least they have met a condition. It's not like the other one where not all conditions were met. In this case, if you just meet any of the condition, then a true value or statement will be brought by the formula there. Now we can just copy this. You can just copy the formula. So you are copying the formula, then bring it here, then you are pasting the same formula or back. So you copy the formula, then you enter, then you come here, then you paste the formula so that it comes here. Then you change a few things. This was, now this case is tour, granted or denied. So you do away with this and you just write something else now, which is granted. And you close that. The other one will be denied, granted and denied. Then you punch enter, then you'll have your other solutions. Then you copy down. What we have are the results for the other guys. So here, for if or, it's more lenient. If you just meet any of the conditions stipulated, a true value or statement will be brought. And in this case, only one person is not meeting the condition that was stipulated, and therefore, that is why we have no prize here. Let us see those who are going, but just by, like David, if you reduce the age to 15 because he's surviving because of age, he's now being denied and it's no price. Look at another one here, Janet Tor is going because of a May, got 89. If he scores 67, that one now is also being no price or denied. Another one that went is 78 with only surpassing tax. If you reduce this from 78 to 75, then that one is also just being denied. 75? No, 74. That one will also be denied here as no price or denied. That one is also no price or denied in that particular case of the student. Then there is also, let's say, Philip Tan. This one we can also reduce the tax marks to 72. And we see that this one is also 72, Philip Tan. Now the age, 19. And you can see it's adjusting across the formulas, no price or denied. So in this case, if you just meet any of the condition, a true value or statement will be brought. Like we can see this person, Gary Hall, is 15 years, did not meet the age. 70 for FA was met, the other one was met. There is also a person who did not meet something here but granted. Paul Henry only scored 58 but was granted because he has met at least a condition. So even if somebody is scoring zero in those other things, but at least met the age condition here, still is granted because the condition of age has been stipulated. Or let's say this person here is underage, that is 5 years, but also did not do well in FA, so scored 17. Also did not do well in MA, only scored 23, but scored 90 in tax. This person will still be granted on the virtue that he has made it in tax other than those others. So that is how the if and if or statement formulas or Excel formulas are used for analyzing data in an Excel spreadsheet. Thank you, and I hope you enjoyed the sessions of if statements, and you'll be able to do a lot of tasks and assignments and other things that will enable you to improve your skills and knowledge on the if statements.
Hi candidates, welcome to another session of Manifested Online Classes. We are still soldiering on with the topic of group account, and in this session I want us to look on an illustration question which require the preparation of the group account or the consolidated financial statement with a scenario whereby the parent company has invested in a subsidiary and also an associate. So let's go through the illustration and we see what we are told. It reads, on 1st of April 2021, Riziki Limited acquired 75% of the equity shares of Sarama Limited when the retained earnings of Sarama Limited stood at 234 million. The acquisition consideration consisted of cash amounting to 510 million and a share exchange on the basis of 2 ordinary shares of Riziki Limited for every 3 ordinary shares acquired in Sarama. The market value of Riziki Limited shares as at 1st of April 2021 was shilling 16 per share. No accounting entries have been made in respect of the share exchange consideration. The draft statement of financial position of the 2 entities or 2 companies as at 31st of March 2022 are as presented below. So we are given the statement of financial position for Riziki and also for Sarama, where we have the non-current asset including property, plant and equipment, investment, and then we have the current asset which include inventory, trade receivables, bank, and then we have the total asset. We have equity and liabilities. At equity, we have ordinary share capital retained earnings. Then we have non-current liabilities, which include 6% debentures. And then we have the current liabilities, which include trade payables, current tax payable. And then we have the total equity and liabilities. We have additional information. Number 1, you're told the fair value of Sarama Limited net asset approximated their carrying amount with an exception of a specialized piece of equipment which had a fair value of shillings 120 million in excess of its carrying amount. This equipment had 10-year remaining useful life on 1st April 2021. 2. It is a group policy to value non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest in Sarama Limited on 1st of April 2021 was estimated at 144 million. Number 3, during the year which ended 31st of March 2022, Sarama Limited sold goods to Riziki Limited for shilling 64 million, earning a gross profit margin of 25% on the sales. Riziki Limited still held shillings 48 million worth of these goods in the inventory as at 31st of March 2022. Sarama Limited still held the full invoice of shillings 64 million in its trade receivables as at 31st of March 2022. However, Riziki Limited trade payables only showed 34 million as it had made a payment of 30 million on 31st March 2022. 4. On 1st of April 2021, Riziki Limited acquired 30% equity interest in Amua Limited for shilling 65 million in cash. Amua Limited sustained heavy losses over the last few years, and Riziki Limited hoped it would turn it around through significant influence over Amua Limited. In the year which ended 31st March 2022, Amua Limited made a loss of 150 million. Number 5, impairment test performed as at 31st of March 2022 revealed that the investment in Amua Limited had been impaired by shillings 5 million due to sustained trading losses. However, no impairment was required in respect of goodwill arising on acquisition of Sarama. So what are we required? Number 1, determine the value of investment in Amua as at 31st of March 2022, Roman 2. Calculate the value of goodwill arising on acquisition of Sarama Limited. Roman 3, a consolidated statement of financial position for Riziki Limited as at 31st of March 2022. So these are questions for group accounts, and recall what we have been doing in the previous sessions. Once you come across a question for group account, the first thing you need to do is always to come up with a group structure, because the group structure is the one to guide you in terms of how to prepare the consolidated financial statement. So therefore, that is the first thing we need to do here. We need to come up with a group structure That will be our working one, the group structure. Group structure. So where do we get information about the group structure? In the first paragraph of the question, whereby we are told on 1st of April 2021, the company which is called Riziki Limited acquired 75% of the equity shares of the company called Sarama Limited, and this took place on 1st of April 2021. That is now the date of acquisition, and automatically from this particular information, this now will be the parent company, whereas this will be the subsidiary. But also, in the information which we have in note number 4, additional information number 4, we are told on the same date, that is on 1st of April 2021, Riziki Limited also acquired 30% equity interest. This one acquired 30% equity interest in a company which is called Amua Limited, and that took place on 1st of April 2021. 1st of April 2021, meaning that Amua Limited here is an associate. So this will be an associate, because we said an associate is basically an entity over which the parent company has acquired shares lying between 20% to 49%. So therefore, this is what? This is an associate. This is a parent. This is what? The subsidiary. Now, if you go to the requirement, specifically Roman 3, the candidates here were required to prepare consolidated statement of financial position. How do we prepare that? So one, we are going to add similar items of asset and liabilities, those of the parent and those of the subsidiary. But as far as the associate is concerned, we are going to compute something called the investment in associate, and we include that in the consolidated statement of financial position as one of the component of the non-current what? Asset. But before we do that, we need to do some few workings, which then will help us in terms of preparing or basically computing what the examiner is requiring. So if we go back to paragraph 1, whereby we are given information about acquisition of Sarama by Riziki, where we are told Riziki acquired 75% equity shares in Sarama on 1st of April 2021, when the retained earnings of Sarama stood at 234. That is now the retained earnings of Sarama on the date of acquisition. That one is used in computation of goodwill. So therefore, when computing the goodwill as required in Loman 2, that will be one of the pre-acquisition reserve. And then we are told the acquisition consideration, the amount of money which the parent company paid in acquiring this particular subsidiary, that is Sarama, consisted of cash, which was 510 million, and then a share exchange and a share exchange. Recall what we discussed in our previous sessions. Anytime the parent company acquires subsidiary and pay the purchase consideration through a share exchange, usually the examiner will tell you two things: that the parent company had not determined that purchase consideration, the share exchange consideration, and the parent company had not accounted for that. In fact, if you go to the last sentence of that paragraph 1, you'll see we are told no accounting entries have been made in respect of the share exchange consideration. So therefore, what do we need to do? First of all, we need to compute the share exchange consideration, and also in this case, we must be in a position to know how to account for that. So let's compute the share exchange consideration, and if you can recall what we discussed, which we have already discussed in our previous sessions, to compute this share exchange consideration, number 1, we determine the number of shares issued by parent company to pay the purchase consideration. How many shares were issued by Riziki to pay the purchase consideration? Multiply those particular shares with their fair value, or basically the market price, on the date of acquisition. That is a formula which you need to recall here. So, and in this case, we are told that the share exchange was on the basis of two ordinary shares of Riziki. Riziki Limited here was to issue 2 shares for every 3 shares acquired. for every 3 shares acquired. So the first thing we need to do here is to determine how many shares did our parent company acquire in Sarama. For us to be able to do that, to determine the shares acquired in Sarama, we need first of all to know how many shares are issued by Sarama. Where do we get that information? We go to the statement of financial position of Sarama, statement of financial position of Sarama, specifically under equity, and we take into account its ordinary share capital. The ordinary share capital of Sarama is equal to 300,000. So for us to be able to determine the shares issued by this company, we divide that with the par value per share. The par value per share is what still we have in the statement of financial position and equity. We are told the ordinary shares issued by these two companies, they have a par value of 10. That applies to the shares of Riziki, to the shares of Sarama. So the shares of this company had a par value of 10. So we divide this, and this will give us 30,000. So mean that the shares issued by Sarama are 30,000. So how many shares were then acquired by Riziki in Sarama? So we know Riziki acquired shares which were equal to 75% of this. 75% of that. So let's work out that. 75% of 30,000, which will give us 22,500 shares. So these are the shares which now the parent company acquired in Sarama, which the parent company acquired in Sarama. That's what we need to have here. The shares acquired were 22,500. So having that, what we just need to do, we cross multiply, then we divide, so that we can be able to determine the shares which were issued by our parent company. So this will be 2 times 22,500. We divide all this with 3. We divide all that with 3. This will give us what? This will give us what? This will give us 15,000 shares. 15,000 shares. So these are the shares issued by the parent company. So from our formula here, we already have the shares issued by the parent company. So what we need to do, we need to multiply those particular shares with a fair value or the market price to determine the purchase consideration. So therefore the purchase consideration here, not the purchase consideration, but let's just refer to this as share exchange consideration. Share exchange consideration. Share exchange consideration. Share exchange consideration would be equal to the shares issued by the parent company, 15,000, times the market price. The market price of Riziki Limited shares is given still in paragraph 1. There is somewhere you're told the market price of Riziki Limited shares on the date of acquisition was 16. So we multiply the 2 so that we can be able to determine the share exchange consideration. So this will give us 240,000. 240,000. So, and take into account this particular amount was not accounted for. Number one, in computing the goodwill on acquisition, the goodwill arising on acquisition of this subsidiary, this will be one of the purchase consideration, because the purchase consideration paid by Riziki, part of it was in cash, which is given in paragraph 1, 510 million, and then we have these 240 million. So the total purchase consideration will be 510 million plus 240 million, and then because the parent company issued shares to pay these purchase consideration, then we're also going to credit this, or basically we're going to increase the ordinary share capital of the parent company with the shares issued by the parent, because the parent company never accounted or didn't account for these shares. That is as per the information given in the last sentence of note 1. So the amount to be credited in the ordinary share capital of the parent will be equal to the shares issued times the par value per share. The par value per share is the amount given in the statement of financial position. The amount given, the value of the share given in the statement of financial position is 10. So that will give us 150. And then the amount which is above 10, because you can see these shares were issued at a price of 16. The amount which is above 10, which is 6, that will be credited, or in other terms, it will be added to the parent company share premium. So therefore, the amount to be added to the share premium, 15,000 times what? Times 6, which will give us 90,000. So that's how we account for that share exchange what consideration. That is something we discussed or we have already discussed in our previous sessions of this topic of group accounts. So I think we are done with that information. Then from there, I think we can go to the additional information number 1, whereby we need to have working 3. In addition, information number 1, you're told the fair value of Sarama Limited net asset approximated their carrying value with an exception of specialist piece of equipment, which had a fair value of 120 million in its fair value adjustment. And actually, this we said is a normal practice. Whenever the parent company is acquiring a subsidiary, the subsidiary company revalue its asset. But we said the subsidiary company do not account for that particular word, revaluation of assets. As a result of that, we make 2 adjustments here. The first adjustment is adjustment relating to the revaluation gain. And in this case, why do we say there was a gain? Is because we are told that that asset which was revalued, its fair value was more. Its fair value was more, or it was in excess or exceeded the carrying amount with an amount of 120,000. And because the figures in the statement of financial position are in thousand, when taking figure from the additional information, we take it as in thousand of shillings, meaning that we omit the last 3 zeros. So this is a revaluation gain. So how do we account for this gain? When preparing the consolidated statement of financial position is required in Roman 3. This one will be added to the group PP. We're going to add this to the group PP. And number 2, we treat it as a pre-acquisition revaluation reserve. When computing the goodwill on acquisition, that will be one of the component of the net assets. Number 2, because the asset which was revalued here is a depreciable asset. Actually, the asset which was revalued here is equipment. Equipment is a depreciable asset. So what we need to do, we need to compute the depreciation other charge. We need to compute the depreciation other charge, and this specifically by Sarama Limited. By Sarama Limited. So how do we compute this depreciation other charge? You have to recall the formula which we covered in our previous sessions. So we take the revaluation gain, divide that with the remaining useful life of the asset times the proportion of time. Proportion of time, which is now the time difference between date of acquisition and date of consolidation. So the revaluation gain is what we have here, 120,000. And then what are we given the remaining useful life of that asset? Yes, in note number 1, we are told it had a remaining useful life of 10 years. 10 years. And then we multiply that with the proportion of time, the date of acquisition to the date of consolidation. So the date of consolidation is the date we are required to prepare the consolidated statement of financial position as per note number 3, which is 31st of March 2022. And then we have the date of acquisition, which is 1st of April 2021. And actually, this is exactly the start of the current financial year, because even here is ending 31st of March 2022. If you go back 12 months, that should take you to 1st April 2021. So basically here we have exactly 1 year. So meaning that we are computing depreciation other charge for 1 year, or basically for 12 months out of 12. 12 months out of 12. So this will give us 12,000. 12,000. So this is the depreciation what? This is the depreciation other charge by the subsidiary company, that is Sarama, which is 12,000. So this depreciation other charge number 1 will be deducted from the group PP, and number 2, we're also going to less that from the retained earnings of Sarama, the retained earnings of Sarama. Yes, so that is the consolidation adjustment required as far as note 1 is concerned. Let's move to note number 2. Note number 2, you're told, is a group policy to value non-controlling interest at fair value at the date of acquisition. Anytime you come across such a statement, that is something I've already explained in the previous sessions, is that when computing the goodwill, you compute the goodwill using the full goodwill method. Actually, that information is given to you to help you in terms of knowing which method to use in computing the goodwill. Here we are going to use the full goodwill method, the full goodwill method. And that's why you can see even in the other sentence we are given the NCI at fair value. We are told the fair value of non-controlling interest in Sarama Limited at the date of acquisition was 144. So we are going to use that information when tackling Roman 1 of that question, whereby Roman 2 actually, whereby we are required to compute the goodwill. So now working as far as that is concerned, let's move to working to addition information number 3. We are told during the year which ended 31st of March 2022, which is the current year, Sarama Limited, which is a subsidiary, sold goods to Riziki Limited for 64 million. This we refer to it as intra-group trading. Intra-group trading, intra-group sales. If we were preparing the consolidated income statement, this one is eliminated from the group revenue, the group cost of sales. But in our case, we are not preparing the consolidated income statement. So our interest as far as that intra-group trading is concerned are two items: any unrealized profit and any amount of intercompany debt. So we are told it earned a gross profit margin of 25%, and then you're told Riziki Limited, which is now the purchasing or the buying company, still held shillings 48 million worth of these goods at all in its inventory at the end of the year. So anytime you come across that particular information, it basically means that there was an realized profit on inventory, and this unrealized profit on inventory always is by the selling company. The selling company in this case was Sarama Limited, was by Sarama Limited. So equally you have to recall, how do we compute this unrealized profit? You have to recall the formula. We take the unsold goods times the gross profit margin, times the gross profit margin. So the unsold goods, we are told the goods which were not yet sold had a value of 48 million times the gross profit margin. The gross profit margin, in our case, we are given that as 25%. 25%. This is like a quarter. That should give us 12,000, but we can just confirm that. Yes, so this will give us 12,000, which is the unrealized profit. So which adjustment are required for this? 1, we are going to less this from the group inventory, and number 2, we also less it from the retained earnings of the selling company. Retained earnings of the selling company, which is Sarama, that is the selling company. Yes, so I think we are done with that. And then still in point number 3, we are told Sarama Limited still had a full invoice value of 64 million in its trade receivables as at 31st of March 2022. However, Riziki Limited trade payables only showed 34 million as it had made a payment of 30 million as 31st March 2022. So what is that? That is information about amount of intercompany debt. Amount of intercompany debt or amount of intercompany owings. So basically we are told this company here, that is Sarama Limited, still held the full invoice. So basically this company, remember, sold some goods now to the parent company, which had a value of 64 million. So automatically the parent company had not paid for those goods. So meaning at the end of the year, Sarama Limited was expecting to receive 64 million. So that will automatically, or that was included as part of the receivables of this. That's what we are told. The receivables of the subsidiary, that is Sarama, included 64 in thousand of shillings, 64,000. So this one will be deducted from the group receivables, and then you're told the payables of this company included 34 million. 34 million. This one will be deducted from the group payables. And in this case, you can see amount of intercompany debt is not the same. Reason being that this company here, at the end of the year, had made some payment which was not yet received and accounted for by this company. And that one we refer to it as cash in transit of 30,000. This cash in transit, which will be added to the group cash and bank balanced. Amount of intercompany debt, which is not the same, and therefore you must be in a position to know how do we adjust that in consolidated statement of financial position. I think we are done with that. Point number 3. Let's move to point number 4, is about investment in Amua, which we said is an associate. We are given the purchase consideration, which was paid 65, which was paid in cash, and we are told in the last sentence that Amua Limited reported a loss of 150 million. So that information, we are going to use it in answering part A of that Roman 1 of that question. So no working which is required there. And then 5, impairment test performed as at the end of the year reviewed the investment in Amua. Investment in Amua here had impaired by 5 million due to sustained trading losses. However, no impairment was required in respect of goodwill arising on acquisition of what? Sarama. Any goodwill arising on acquisition of Sarama had not what? Impaired, had not impaired. So I think now with those particular workings, we can go straight to what is required. We start with Roman 1 of that particular question. Roman 1. Roman 1, we are required to compute investment in Amua. Investment in Amua Limited. In Amua Limited. So remember, Amua Limited is an associate, and therefore what the examiner here was requiring the candidate to compute is the investment in an associate. So this is something we discussed in our previous session, how to compute the investment in associate. So what we need to do here is to have a single column, and all our figures are in thousands of shillings. So what do we start with here? So we always start with the cost of investment. The cost of investment is the purchase consideration paid by the parent company in acquiring shares of the associate, that is Amua. And that information, we have it in note number 4, whereby we are told on 1st of April 2021, Riziki Limited acquired 30% equity interest in Amua for shilling 65 million. So in thousands of shillings, that will be 65,000. So to this, what do we then add? We then add the group share of the post-acquisition retained earnings of Amua. So in this case, as per the information which are given in note number 4, the associate, that is Amua, reported a loss. So therefore, in this case, we're not going to add the group share of the post-acquisition retained earnings, but we are going to less. We're going to do what? We are going to less the group share of post acquisition loss of the associate because during the current financial year, remember this associate was acquired exactly at the start. So therefore, the loss it reported during the current year is a post-acquisition, is a loss reported by Amua after it was acquired by the parent. So that loss in note number 4, the last sentence, 150,000 or 150 million, this is a post-acquisition loss. What we do is that we compute the parent company share of this. The parent company share of that will be 30%, and because it's a loss, we less it there. And also to this, what do? We less any impairment loss. So if this investment in associate has impaired or its value has reduced, we less that there. Are we given any information as far as that is concerned? Yes, note number 5. Impairment test performed at the end of the year revealed that the investment in Amua had been impaired with 5 million. 5 million. 5 million in thousands of shillings, we take that to be 5,000. So let's compute this, and then we get the final answer. So we get 30% of 150,000, which will give us 45,000. Remember, these are loss, so we less it from our figure up there. So we have 65 minus 45 minus 5. This is a total of 50. So this will give us 15,000. 15,000. So 15,000 is what? Is the investment in what? Investment in Amua. Investment in Amua. And actually that's what the examiner was requiring there. And so these automatically were the items to be marked there. That one, and that one. So any candidate was able to do that, got now the allocated marks there. Okay, so let's now move to Roman 2 of the question. In Roman 2, we are required to compute the goodwill arising on acquisition, goodwill on acquisition of Sarama Limited. Goodwill on acquisition of Sarama Limited. And equally, you have to remember in computing this particular goodwill on acquisition of Sarama, as per the information given in note number 2, we are using the full goodwill method. We are computing this goodwill using full goodwill method. Full goodwill method. So what we need to do here is to have two columns. So how do we compute this goodwill? First of all, we take the purchase consideration. The purchase consideration. Purchase consideration is the amount of money which was paid by the parent company in acquiring 75% stake or 75% interest in Sarama. So as per the information which we have in paragraph 1, we know that part of this purchase consideration was in cash. So we have cash consideration, which you are told in paragraph 1 is 510 million, but in thousand of shillings it will be 510,000. So we also have this share exchange consideration also as per the information given in paragraph 1. But remember, I said this share exchange consideration was not given. That's why we computed that. So we have share exchange consideration, which is 240,000. So this is the purchase consideration paid by the parent. And because we're using the full goodwill method, there is something else we need to add here, the NCI at fair value. NCI at fair value. Do we have that information? Yes, we have it in note number note number 2. NCI at fair value is 144 million. So we add all this. That is, we add all this, so that then we less the net assets which were acquired. So we have 510 plus 240 plus 144, which will give us 894,000. So and then to this, what do? We less fair value of net assets acquired. Fair value of net assets acquired. So this is something which the examiner will not give you. Is upon you to compute this, the fair value of the net asset which were acquired. And actually to compute these from what we have already discussed in our previous sessions. We need to compute the fair value of Sarama Limited net asset on the date of acquisition. How do we compute that? We compute that by taking the ordinary share capital of Sarama plus all pre-acquisition reserves plus all the reserves Sarama Limited was having at the date of acquisition. So the first thing we do is to go to the statement of financial position of Sarama, specifically in the equity section, and we take into account its ordinary share capital. The ordinary share capital of Sarama is 300. And actually we said also, if that company is or if you also given the share premium there, you also include it there, but we don't have. And then what we have still at the equity is the retained earnings. But also recall from what we have been discussing in the previous sessions, the retained earnings which we include here is the retained earnings on the date of acquisition. And we have that in paragraph 1 of this question. The retained earnings of Sarama at the date of acquisition was 234 million, but in thousand of shillings will be 234. Yes. Then from there is something else you also need to check. you need to check whether Sarama Limited on the date of acquisition revalued the assets. If that company revalued the asset, there was any revaluation reserve, you include it here. And actually, we have that. Recall this working 3. So on the date of acquisition, Sarama Limited revalued an item of plant. There was a revaluation gain of 120. So that is one of the pre-acquisition revaluation reserve. Yes. So we don't have any other. So what we just need to do is we get the total here. We get the total. So we have 300 plus 234 plus 120, which will give us 654. 654. And because you're using the full goodwill method, we take 100% of this because we are interested with the net asset acquired by both the parent and NCI, 100% of that, which will be 654. So we less that from the figure we have up there, and we get the goodwill. So minus 894, which will give us 240,000. So 240,000, this is the goodwill on acquisition, and actually this is the full goodwill. Full goodwill means that that is the goodwill attributable to the parent and the goodwill attributable to who? To the NCI. So that is it. That's what was required. And equally, there the candidates were allocated 3 marks. So the items which are marked in such a case are these items. These are the items. If you got any of those, or basically if you got those particular items, then you got the allocated 3 marks. So we are done with that. Then we proceed to the last part of that question, whereby the candidates were required to present or to prepare a consolidated statement of financial position of this group. So we have Riziki group consolidated statement of financial position as at 31st of March 2022. 31st of March 2022. So how do we prepare this? So in preparing the consolidated statement of financial position, we are going to add similar items of assets and liabilities, those of the parent and those of the subsidiary. But as far as the associate is concerned, we don't include its assets and liabilities here. In fact, that's why in this particular question, there is nowhere we are given assets and liabilities of Amua. So what do we include here as far as the Amua Limited is concerned is something called the investment in Amua, investment in associate, and that is in accordance with the International Accounting Standard number 28, which requires that when the parent company is preparing the consolidated statement of financial position, it should not include the assets and liabilities of the associate there, but it should only include the investment in associate, which we computed here. So therefore, that's how we are going to present this. So let's start with the non-current assets. So for the non-current asset, we start with the PP. So PP, we take those of the parent, 1593, 1595, 1595, 300, plus those of the subsidiary, 636, 400. And then from there, we need to check whether we have any consolidation adjustment affecting group PP. Do we have any? Yes. So we have this one. So we have the revaluation gain of 120, which we said we add to the group PP. So we add 120. And then we also have this depreciation other charge of 12. We less it here. We less it here. So we will get the final figure. So that is for PP. Then below that, what do we have? We have investment. Now this investment, the examiner will not tell you, but this is the amount now the parent company had invested in Sarama, had invested in Amua, and that should not be included here. So the purchase consideration which was paid in acquiring shares of Sarama, that one is used in the computation of goodwill. So that why we are saying that the amount invested in Sanama, you don't include it here. What we include here is the goodwill. Equally, the amount invested in Amua, we don't include it here, but rather we include now the investment in Amua because this amount has been used in computing what? Investment in Amua. So the investment which you're given there is 575, and this one include the cash consideration paid by the parent company in acquiring shares of Sarama, which is 510. So we need to less it here. And also this included this amount of 65, which was paid in acquiring shares of Amua. So if you less this, you take this minus this, that will automatically give us 0. So that is the amount invested in Amua and also Sanama. We don't include it here. So what instead we include here is the goodwill arising on acquisition of Sarama Limited, which you have computed here, 240,000. We also include now the investment in Amua, Limited, which you have computed here, an amount of what? 15,000. 15,000. Yes, we will come back and compute this, but let's first of all proceed and code current assets. For current assets, we have inventory. So for inventory, we are adding the inventory of the parent, 165, plus that of the subsidiary, 160. So do we have any consolidation adjustment affecting inventory? We have to check whether we have unreleased profit on inventory, and we have it here, an amount of 12,000, which we said we less that from the group inventory. So we less 12,000. 12,000. Do we have anything else? No. We'll get the final figure. Then from there, below that, we have trade receivables. So for the trade receivables, we take those of the parent, 247,100, plus those of the subsidiary, 107,800. And then to this, we should less any amount of intercompany debt. Any amount of intercompany debt. Do we have amount of intercompany debt? Yes, this one, 64, which we said we less from the group receivable, 64,000. And then below that, what do we have? We have the bank balance. Bank balance, we take that of the parent company, 21,000 plus 13,800. And then also to this, there is an adjustment for cash in transit. Cash in transit. Cash in transit, we add it here, 30,000. Yes, and then from there, we will get now the total asset here. We will get the total assets. Total assets. So let's compute those figures here. We start with the PP. For PP, we have 1595, 300 plus 636, 400 plus 120,000 minus 12,000 minus 12,000. So which will give us 23, 39, 39,700, 23, 39,700. So we already have that, this. So then let's compute the group inventory. So 165,000 plus 160,000. That is 165,000 plus 160,000 minus 12,000. So which will give us 13,000. What about receivables? We have 247, 100 plus 107, 800 minus the amount of intercompany debt, 64,000, which will give us 290, 900. What about the bank? We have 21,000 plus 13,800 plus the cash in transit of 30. So which will give us 64,800. Then we add everything here. We have 290 900 plus 313 plus 15 plus 240 plus 2339 700, which will give us a total asset of 32 63 400. Yes, so that is it. We proceed then we record equity. We record equity. So for equity, we start with the ordinary share capital. Ordinary share capital, you have to recall that for the ordinary share capital, we only include that of the parent company, only. So for the parent company is 850. But you also have to recall here that our parent company, in paying the purchase consideration after acquiring Salama, part of that purchase consideration was paid by the parent company issuing its own shares, which the parent company didn't account for. So therefore, we said to the ordinary share capital of the parent, we are going to do what? We are going to add 150 to the share premium of the parent. We add what? 90. So to this, we are going to add 150, which will give us 1 million. And then we also have this share premium. We also have that share premium arising from those shares which were issued. The share premium is 90,000. Is 90,000. So then from there is something we need to compute here called the group retained earnings. This one is not given. We have to compute it. We have to compute that, including something else called the non-controlling interest. Non-controlling interest not also given. We are going to compute those two items once we are done by with recording the other items. So then from there, let's proceed and record liabilities. Where do we need to record? Where do we record our liabilities? We record our liabilities here. I think we can do away with this. Yes, so let's do away with whatever you have here. Yes, next we record the non-current liabilities. Non-current liabilities. We have 8% debentures. So for the 8% debentures, we add that of the parent for 60, that of the subsidiary, which is 40. No adjustment for this, which will give us 500,000. 500,000, and then we record current liabilities. We have trade payables. Trade payables. We add that of the parent, 442,000 plus 167,200. And we have an adjustment for this relating to the amount of intercompany debt of 34, which we need to less from this, that we less 34,000. Okay, then next or below that we have the current tax payable. No adjustment for this. We have 108,000 plus 52,800. 108,000 plus 52,800. No adjustment for that. So what we need to do, we need to get the final figures here. So we start with the tax payable here, whereby you're going to take 108,000 plus 52,800, which will give us 160,800. What about trade payables? We have 442,000 plus 167,200. 167,200 minus the amount of intercompany debt 34, which will give us 575,200. Yes, so then we will get the total equity and liabilities. Total equity and liabilities. But before you do that, There are two items we need to compute here. Let's start with the group retained earnings. We start by computing the group retained earnings. Group retained earnings. And in terms of how we compute this particular group retained earnings, we take 100% of the parent company retained earnings, 100% of the parent company retained earnings, 75% of the subsidiary post-acquisition retained earnings, and then for Amua, which reported a loss, we take now the group share of the post-acquisition loss. So meaning that here we're going to have the three companies, that is Riziki, Salama, and Amua. So for these two companies, parent and the subsidiary, we are going to take the retained earnings as given in the statement of financial position. In the statement of financial position, we have the retained earnings for Riziki and Sarama, which is 743,400. For Sarama is 358,000. So this one is not given. And actually I've said for Sarama, not for Sarama, rather for Amua, we are going to include or to take into account its profit for the current year. Because not the profit actually, because during the current year this company reported a loss. We are going to take its loss for the current financial year, and actually we compute the group share of the same. Yes, so therefore that's basically what we are going to factor in here. So as far as the retained earnings of the subsidiary company is concerned, first of all, you need to eliminate the pre-acquisition retained earnings that only apply to the subsidiary, and which is given in the additional information number, the first paragraph. Its retained earnings on the date of acquisition was 234,000, such that we shall be left with only the post-acquisition. Post-acquisition. So 358 minus 234. 358 minus 234, which will give us 124,000. And then what we need to do is also for Amua here, we can just include the loss for the year. Loss for the year. For the year. This applied to Amua. It had a loss of how much? That is in the information number 4, which is 150. 150. Yes, 150. Remember, these are loss. We take it as a negative. Then we need to check the various adjustments affecting the retained earnings. I think working 1, working 2 will not affect the retained earnings. Working 3 here, these will not affect the retained earnings, but we have depreciation under charge by Sarama of 12, this one, which we said should be deducted from the retained earnings of Sarama Limited. So this 12,000, so which is the depreciation under charge specifically by Sarama to be deducted from its retained earnings, 12,000. Okay, so then we have this unrealized profit still by Sarama to be deducted from its retained earnings, and realized profit by Sarama of how much? Still 12. Still 12. So this amount of intercompany debt will not affect that. Yes, I don't think we have anything else here. Do we have anything else? We have this depreciation under charge and realized profit. Let me see from the additional information. I think we have dealt with additional information number 1. Number 2 is about unrealized profit. Number 4. Yes, and then we also have what? We also have the impairment loss. We have the impairment loss. Yes. So this investment in Amua had impaired, and basically that is impairment loss is recognized as an expense by the parent company here. Impairment loss. Yes. So we get the net amount here, so that now we get the group share of this. We get the group share of this. So let's get the net amount. This should be 100,000. This will be what? Will be 738. 738. Then we get the group share of this. The group share of this will be 100%, 75%, and this one will be 30%. 30% of that. So let's work out that, which will give us now the group retained earnings. So this will be negative 45,000. This will give us 75,000. This will give us 738,400. Then we need to add all that. 738,400 plus 75,000 minus 45,000, which will give us 768,400. 768,400 768,400. So I think first of all we can get the total equity here before computing the non-controlling interest, which will give us 18,58,400. And then next what we need to do is to compute the non-controlling interest. Non-controlling interest. Let's have that working here. Non-controlling interest. So the non-controlling interest, you have to recall that this is the minority shareholders' share of the net asset in the subsidiary. So the non-controlling interest. So how do we compute that? To compute this, we take what? We take the NCI at fair value. NCI at fair value, which we have in the additional information number 1. NCI at fair value. We have it in note number 1, which is a figure of 144,000. 44,000. And then to this, what do we add? We add what if as a to this we add, that is NCI at fair value. To this we add the NCI share. NCI share of post acquisition adjusted retained earnings of the subsidiary, that is of Sarama Limited. So we already have this, the post acquisition retained earnings of Sarama, which is what we have here, 100,000. So we basically compute the NCI share of that. So NCI share of this will be equal to 25% of this. 25% of that, which will give us 25,000. Yes, and I think we are done. So what we just need to do is to add this, which will give us 169,000. So 169,000 here. Yes. So I think we are done. So what we just need to do is we add all those particular figures. So let's start by considering what we have here. The total equity, which is 18,58,400 plus NCI 169,000. 169,000 plus the debentures, that is a figure of 500,000. plus payables 575, 200 plus 160, 800, yes, 160, 800. Yes, and actually that is giving us the same figure there, 32, 63, 400. I hope that is the same figure we have there. Yes, the same figure we have there. So basically that is it, that what was required. So your statement of financial position was supposed to balance at that point, and basically by doing that, the candidate was supposed to get 8 marks. So meaning that the items now which are marked here include PPE, goodwill, investment in Amua, inventory, receivable, bank, share capital, retained earnings, NCI, share premium, debentures, that, yes. So those are basically the items which are supposed to be marked, and by doing that, the candidates were supposed to get 8 marks. So basically that is it, that what was required as far as that illustration is concerned, and that brings us to the end of that session. It is bye for now.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lengwiri and I practice within the financial services industry in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017, and we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here. And so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5%, 4%, 3.5%, and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5%, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas, and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply it with the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here. Because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS. And that's what exactly we are supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent, as a percentage of revenue. Enter there. And like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, we fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I32. Like that. So it's I32, which is this cell over here. But now, where do we pick it from? We pick it from I13. This is I13. I13 is this one here. So we're picking it just from there. And then also this one is going to be I14, which is down there. Now we move ahead and try and model the depreciation and amortization. In real life, trying to model depreciation and amortization will prove to be a bit of a challenge. Determining will be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to use straight line method. For simplicity's sake, the way I've seen it right over here, depreciation as a percentage of PPE, it's just based on straight line method like that, for simplicity's sake. So the depreciation and amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly. And we'll model it a little later on. As well, the interest right here. The interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so, to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard coded values, we just drag them. That. Remember that this value here is bound to change as well as this value is bound to change because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, it's a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if you can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? The accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if you double click, you can see it is the revenue, or it is rather the accounts receivable. Yes, if you said before, accounts receivable. We divide that with the revenue, and then we multiply it by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, how do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue, because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you what you're going to do, because the formula is given to us right over here. You can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days, and then we multiply that with the revenue, and we divide this, all of this, by 365. By 365. Over here, 365. That. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we are saying we get the accounts receivable times 365 over revenue. Just rearranging this formula. And that's exactly what we're going to do over here. We get the days. The days are here. See where they are. Just a second. Accounts receivable days. There. And then we multiply that with the revenue. Then we divide over 365. And we have that value given to us there. So shift, Control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue, and here we're dividing against 365. That. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days. Which days? The inventory days right here, 73, divide by 365. Once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out. Because this is a formula, so Shift, Control R. We can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. The same formula over here, only that we're going to put now accounts payable. Now over here, payable. Payable for revenue 365. So we look for the accounts payable days. Accounts payable days, you can see the accounts payable days are here, 37. And then we multiply that with the cost of goods sold and then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the supporting schedules. So here we drag it like that because this is a formula here, it's just the total. So this one I'll put it in a different color so that for consistency's sake to maintain to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital, then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here. And we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right. And this one remains like so. So Shift, Control R. So it picks the formulas as the way they are. Remember, in a balance sheet, we always have a check. This check, with your permission, it will obviously not balance because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiners asked us, to fill and ensure that this one balances off, the balance sheet balances off based on the forecast. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement and we will be able to also do a check for the cash flow statement and write down over here to determine if we're actually cooking figures or not. We jump onto the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable. You remember we had modeled it just above there in the balance sheet. So we just fill it out. We link it with the one accounts receivable here. And you can see the accounts receivable is here. So we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The The accounts payable, as you can see right over here, is 5938. You see, it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net working capital component. So just put it like that, and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that. Then now I can drag it moving down like that. Shift, Control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule, depreciation schedule. Now we can see something that is very unique from the historical values here. This value, which is the opening PPE, is there picked from the closing value here. This value has been picked from the closing value here. This one has been picked from there. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section. This one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up over here. So debt and issuance repayment right now here, you link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do we get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. Interest as a percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. these values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up, and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is linked to the supporting schedule here, right here, enter. Then we can be able to just drag it towards the right there, Control R. And in a good account or analyst format, we just make sure that this part is the same color because we've already filled out the missing items and our income statement is complete. Now, like I said before, that the cash is going to be filled out at the last, at the tail end. It's like the balancing figure. We can fill out the property, plant and equipment. So we're saying it's going to be from the supporting schedules down. So we are saying it's going to be this value here, the closing. You're reporting at the end of the financial year. So we pick the closing balance there, and we drag it towards the right. Remember, it's just the sum of all of them. As well, the debt, we pick the closing debt, which is right here. Closing debt should be that. We can just drag it, Control R. So we can then, of course, now remove the theme color, put it here like so, with the exception of the cash. Now let's fill out the cash flow statement. Net earnings is picked up from above here. Here 35 is here, the net earnings, you can see the net earnings is there. Here we have the depreciation and amortization over here. Right here, so we pick that. And then we are saying changes in working capital. Where do we pick it from? We pick it from the supporting schedules, right here. Change in net working capital, and we are saying we're going to pick that value. So because this is black and it's a formula, I can just drag it like so. Now we're almost there, but we're not there quite there yet. The investments in PPE represent the capital expenditures. So the capital expenditures down here, capex, you can see the capex is here. Link it with that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt, here. And remember, they are following each other with equity. So, like that. And this can be dragged like so because it's a formula, and we can complete this by doing that, by dragging the formulas moving the right. The net increase or decrease in cash is a formula because you can see it right above over here. We're going to add cash from operations we subtract cash from investing because that's money going out, and then we add cash from financing so that we can be able to get the decrease in or increase in cash. Drag that towards the right. And we're saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So we are saying that we can then link that with that value. This one is a formula like so. So we can then drag these values moving towards the right, and we have the values like so. Now to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules, we can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here, and you can see it has balanced. But dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million like that and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements: the income statement, the balance sheet, statement of cash flows, very well. Thank you for being with Manifested Publishers, and God bless you.
Welcome, learner, to our continuing lessons in human resource management. Today we are looking at motivation theories and practice of human resource management, where we are looking at classical theories of motivation, and we are looking at Douglas McGregor theory X and theory Y. Now, this Douglas McGregor is known for proposing theory X and theory Y, which are two assumptions about human nature, and theory X and theory Y on which are theory X and theory Y on how managers perceived and handled employee motivation. The theory X and the theory Y were developed by McGregor in the 1960s. And these theories have extensively been used to inform decisions in management and in human resource management. So what Douglas McGregor did, when it comes to theory X assumptions are the negative sides of the assumptions where some managers had the assumptions about workers. And theory Y is the positive side, according to McGregor, that there are some managers who made assumptions that, for example, in theory X, that employees are inherently lazy, and these employees may dislike work, these employees must be coerced to work, So when managers have that kind of a view about workers, then those supervisors or managers will handle employees with coercion or a dictatorial management style. But on the other side, where an organization, a supervisor or manager views employees with assumptions of theory Y, then the theory Y is the opposite of theory X. And in theory Y, it is presumed that individuals will even like to do work so long as the environment is created to have them to work effectively. And what Douglas MacGregor proposed is that managers should emphasize on the theory Y assumptions to be able to create environments that help employees achieve their objectives. So we can have a look at theory Y and theory X, and then we see what were some of the assumptions that were made under theory X and theory Y. So here you have theory X assumptions, theory X assumptions. Okay. Now, when it comes to theory X assumptions, as you have said, Lana, this is the positive side. Okay. This is theory Y, theory X, theory X. Theory X is the negative assumptions that supervisors or managers may have regarding workers. And what are some of these assumptions? What are some of these assumptions of theory Y? We have just indicated that in terms of a working environment, a manager may argue that the average worker is inherently lazy. So this kind of a manager makes an assumption that a worker is inherently lazy, for example. 2, dislikes work. 3, cannot take responsibility. 4, should be coerced. Should be coerced. So that means forced. Should be coerced or forced to work. Should be coerced or forced to work. 5, will avoid work at all options. So if an employee has an option to avoid work according to these assumptions, a manager assumes that this employee will avoid work at all options, at all options, or maybe opportunity. So these are the kind of assumptions, and these are not all the assumptions. These are some of the assumptions that were proposed by Douglas MacGregor, that when you look at a work environment, there are some managers, and these managers may have this kind of assumptions about workers. And when they have this kind of assumptions about workers, then these kind of managers are likely to adopt what is called a dictatorial approach to managing these particular employees within the working environment. Then, on the other hand, there is now the theory X assumptions. Theory Y assumptions. Theory Y assumptions. Now, the theory Y assumptions, this was the negative. So theory Y is the positive side. And when it comes to the positive side, according to Douglas McGregor, employees, the average employee will work willingly. The average employee will work willingly. So what is important is for the management to create a conducive environment. So according to McGregor's theory, when it comes to the theory Y assumptions, what are some of these assumptions? One, workers can take initiative for their work. Two, workers are responsible so long as the right conditions are created. Workers will seek extra, will take initiative and seek extra responsibilities. So what we are saying, Lana, if you look at the theory Y assumptions according to McGregor is arguing that this is the progressive side, and workers can be what is called highly ambitious. Creativity is inherent among the workforce and so on. So these are the issues. On the theory Y assumptions, if managers make an assumption that the average worker will take initiative for their work, the workers will be responsible so long as the right conditions are created. Workers will take initiative and seek extra responsibilities. Workers are highly ambitious. Workers are willing to be involved in decision making. And when it comes to performance, these employees are able to provide output. So what McGregor provided is that Douglas McGregor, as a note learner, McGregor indicated that it is the responsibility of management to create the right work environment, for employees to operate in. So according to Douglas McGregor, looking at theory X and theory Y, McGregor, Douglas recommended theory Y for progressive managers. So for motivation purposes, McGregor Douglas provided that managers who are progressive should be able to create a conducive environment, and once they create a conducive environment, the assumptions on which they should base decisions on regarding their workers could be the theory Y assumptions, and encourage employees to be able to perform. So those are the issues that surround the theory X and the theory Y assumptions in relation to a work environment. So we can go through this, Lana, slowly again. We have looked at Douglas McGregor theory X and theory Y, and we have indicated that in the 1960s, Douglas McGregor is known for proposing two assumptions about human nature, and these two opposing assumptions were theory X and theory Y, and according to Douglas McGregor, these were the set of assumptions that managers perceived their subordinates or their work environments, and the kind of the managerial decisions they took were influenced by these assumptions. Then we have looked at theory X assumptions and indicated that the theory X assumptions were the negative assumptions that managers could make regarding their employees, and that would then influence the kind of management styles they adopted. And we have seen that the theory X assumptions may include: one, average worker is inherently lazy; then two, an average worker dislikes work; three, an average worker cannot take responsibility for their actions within the work environment; and then four, an average worker needs to be coerced in order to be able to work, and coercion here we have said is forced. And then number five, an average worker will avoid work at all options or at any opportunity. So this then will make managers who are managing employees with this kind of a perspective to adopt a dictatorial or autocratic management style. So when workers are handled with that kind of a style, sometimes it may create challenges. So that is as far as the theory X assumptions are concerned. And when it comes to theory Y assumptions, this is the positive side. And the average worker, according to the managers who perceive workers this way: one, workers can take initiative for their work; two, workers are responsible so long as the right conditions are created for them; then three, workers will take initiative and seek extra responsibilities; four, average workers are highly ambitious; and five, creativity can be inherent within workers or it can be cultivated. So those are the theory Y assumptions, a set of which some managers may perceive their subordinates and now be able to sometimes adopt what is called a democratic leadership style or management style to be able to get work done. And according to McGregor Douglas, it is the responsibility of management to create the right environment for employees to operate in. And Douglas McGregor highly recommended managers to increasingly adopt the theory Y approach to be able to create a democratic management style to be able to achieve both employee and organizational objectives and motivate workers to their level based in terms of performance. So Lana, before we finish, I want to leave you with an assignment. And your assignment for the lesson today is describe Douglas McGregor's theory Y, theory X and theory Y, as it is used in management. So Lana, this is your assignment. Describe Douglas McGregor's theory X and theory Y as it is used in management. So we have come to the end of our lesson today, where we were looking at Douglas McGregor theory X and theory Y, and we have looked at the theory X assumptions and theory Y assumptions, and also your assignment. So thank you very much. We hope to meet in the next lesson. Welcome, learner, to our human resource management subject, and we are looking today at Friedrich Herzberg's two-factor theory, and we want to look at it in terms of the two aspects two factors presented by Friedrich Herzberg. Friedrich Herzberg's two-factor theory is also referred to as motivation hygiene theory. Is also referred to as motivation hygiene theory. And in 1959, Friedrich Herzberg proposed a two-factor theory, and according to Herzberg, there are some factors that result in satisfaction, while there are some other job factors that may prevent dissatisfaction. So according to Herzberg, the factors which enhance satisfaction should be maintained, and the factors which prevent dissatisfaction should be addressed to ensure that employees are motivated within a working environment. So Herzberg classified these job factors into two categories, and these two categories are hygiene factors. So you have the hygiene factors. You have the hygiene factors and motivational factors. Hygiene factors and motivational factors. And according to Herzberg, within a given environment, there could be some aspects built in the job itself. And these aspects that are built within the job itself, according to Herzberg, these are the satisfiers. And that is what Herzberg proposed, that managers have to be able to find out, organizations have to be able to find out what are these inbuilt factors within the job in relation to motivational factors that may enhance employee motivation, and they can be cultivated, and they can be put in place, and workers can be encouraged to be able to perform. So we want to look at the two factors. So we will start with the hygiene factors. Hygiene factors. These hygiene factors that were brought out by Herzberg, the hygiene factors are those that may, in the working environment, if they are not addressed, bring dissatisfaction within that particular setting. And Herzberg proposed that an organization has to address those hygiene factors. And what are some of the hygiene factors according to Herzberg? So according to Herzberg, the hygiene factors in an organization may be things like pay. And when it comes to pay, number one, pay. So this could be pay structures, and pay levels. Pay structures and pay levels. So what Herzberg was suggesting, if an organization wants its employees to perform, then they have to look at the hygiene factors in relation to pay. And in this case, you are looking at pay structures, you are looking at pay levels, you are looking at commensurate pay that should be given to employees depending on their performance. Then the next thing could be company policies, organizational policies, organizational policies and procedures. So an organization has to look at the organizational policies and procedures in terms of the guidelines that are available within the work environment that govern the relationship between workers, supervisors, managers, and how work is done in that particular work environment. So when that is now addressed, then there are also aspects of fringe benefits, benefits. So these ones are the extra perks that are provided to workers. For example, an employee in a given organization could be told, if they are in an environment where parking is a challenge, that worker could be having a specific area where they park. So when they come to the work environment, they are able to find ready parking. They don't have to move up and down looking for parking. They could, for example, have good physical working conditions. So physical working conditions, physical working conditions. Physical working conditions should be looked at. So when it comes to the working environment, physical working environment. So this physical working environment may encompass things like maybe the machines, the tools, the equipment that employees are using. So here, machines, tools should be in good condition. Should be in good condition. So if an employee is working and the machine they are using, the machine the employee is using, and the equipment the employee is using is in good order, then that employee will enjoy even doing that particular work. So when you give employees equipment that are current, modern technology, even that worker will want to come and see how they can also be able to use those equipment. Then number 5, you have status. Employees should be recognized. And appreciated. Recognized and appreciated. So if you have designations or titles, then an employee will feel recognized, will feel appreciated, and this can also help in enhancing that employee's, for example, position. Then you also have interpersonal relations, interpersonal relations, interpersonal relations. So these should be cordial. Cordial relations should be cultivated within a given environment. Interpersonal relations, an organization should ensure that the way workers relate to each other, the way they also relate with managers and so on, the way subordinates and superiors relate, that should be cordial relations. Then you have the aspect of job security. Job security. So this could, for example, be given in terms of contracts, stable appointments, among others. So an organization should be able to provide job security, ensure there is work for employees, and that way employees can put in more effort. So this could be some of the hygiene factors which must be addressed within a given working environment to ensure that workers are able to be motivated to be able to work in terms of their areas of operation. Then you have now the second part. That one was hygiene factors. Then you have what you are calling motivational factors. Motivational factors. Motivational factors, or sometimes they were referred to as satisfiers. Motivational factors or satisfiers. So we have looked at the one side. These aspects are not inherent in the job. These are things which are around the job. So Hasberg recommended that in terms of the motivational factors, an organization has to look at the job itself now. The organization has to look at the job itself in terms of how that particular organization is able to work. So in terms of motivational factors, there is the first one, which is recognition. Recognition. So the employees have to be recognized in the organization. The organization, like now, if you have a general manager, you have a maybe plant manager, they have to be recognized within that particular organization, and they have also to be recognized in terms of their accomplishments. In terms of accomplishments, which must also be, which have to be appreciated. For example, an employee has invented some way of doing work that has to be recognized in a function, and if possible, that worker could also be given some reward in relation to that particular recognition, and that one will motivate that worker and other workers to be able to work effectively. And then number two, there is the aspect of sense of achievement. What happens, Lana, human nature is that if somebody does something and there is an element of achievement, right? For example, if an employee is given a target, okay? An employee is given a target, for example, you have got 1,000 acres of land that is arid, for instance, and you put there a team, and they are supposed to be able to translate these 1,000 acres into farmland and be able to make harvests from there. So these kind of workers in that kind of a team, they will have a sense of achievement if they achieve this target of translating arid land that is 1,000 acres into arable land that can be able to sustain life and be able to feed people and so on. Then there is the element of growth and promotion. Growth and promotion. So an organization has to provide opportunities for advancement. Opportunities for advancement. If workers have achieved, if workers have performed, then these workers should be promoted, for example. So these ones could be, for example, promotion to higher grades. So that will make those employees who have been promoted to move to higher grades. It will make these employees to be able to work hard, and other employees will also want to work smart so that they can also grow in terms of their career expectation, as the case might be. And then it is important that employees within organizations are also made responsibilities. So we are looking at motivational factors. So if you have a team, for example, if you have a team and you make them responsible for production, for example, responsible for production, so they will set targets, they will bring together their schedules, they will decide when they are supposed to maybe stop the machine and do overhaul, and when they have those responsibilities as a team, if they achieve or if they are challenged to be able to achieve challenging targets and so on, then that particular kind of a group can be able to operate, can be able to be motivated in terms of a team, in terms of the members and so on. Then there is the element of meaningful work. Meaningful work. So that work should be worthwhile. Whatever employees are doing should be worthwhile, something they can be proud of. for employees to be proud. Employees should be proud of what they are doing. If they are doing things that are making lives better, if they are doing things that are changing the environment, that are changing the society, they are, for example, producing products that are being used to save lives. They are making products which are used to feed people who are hungry, dress or clothe people, provide intervention measures and so on, assist humanity. So this meaningful work will make it worthwhile, and it is a motivational factor for employees, and it is one of the satisfiers that management has to make sure within a given work environment employees are motivated. So having looked at now hygiene factors, we have also looked at motivational factors. What are some of the implications of two-factor theory? Implications of two-factor theory. Implications of two-factor theory. So we want learner to look at what are some of the implications of the two-factor theory. So one, managers and supervisors must create a conducive work environment for effective motivation. Two, employees should be involved in decision making. Number three, why this Frederick Hasberg's two-factor theory is critical. Jobs must be designed. To enhance employee motivation. So what you are saying, Lana, in this point is that if you look at the hygiene factors, these are factors which are outside the job. But if you look at the motivational factors, these ones are factors which are inherent within the job. Then progressive recognition should be made to employees, to encourage motivation. So you have a situation where employees have performed well, and it had been agreed that if you achieve, it is important that you are recognized. So the recognition should be made. And number five, organization should combine intrinsic and extrinsic rewards. Organizations should combine intrinsic and extrinsic rewards in their motivation. So what happens, it is not only the extrinsic factors, intrinsic and extrinsic factors are important. So organizations must seek to strike a balance in terms of how they may want to motivate their workers. And then it's also important, number six, job enrichment. Should be used to provide to provide employees with vertical job loading factors, vertical job loading factors to motivate workers, through challenging tasks. So learner, these are just some. Job enrichment should be used to provide employees with vertical job loading factors. So here is where higher level jobs are tasks are brought down to encourage employees to be able to perform in a given organization to achieve that sense of achievement for the meaningful of the work, so that the work is also exciting. So learner, summary of Frederick Herzberg's two-factor theory. We have looked at Frederick Herzberg's two-factor theory, and we have indicated that Frederick Herzberg's two-factor theory may also be referred to as motivation hygiene theory. It was proposed in 1959 by Frederick Herzberg, and according to Herzberg, there are some job factors that result in satisfaction, while there are other job factors that prevent dissatisfaction, and Herzberg classified them as hygiene factors and motivation factors. We have had a look at some of the hygiene factors, and we have indicated that some of those hygiene factors are pay, where you are looking at pay structures and pay levels. We also have hygiene factors like organizational policies and procedures and guidelines. We also have fringe benefits or extra perks, number 3. Number 4, physical working conditions like machines, tools should be in good conditions to facilitate smooth working. Number 5, status, where we have said that employees should be recognized and appreciated. Number 6, interpersonal relations should be cordial. Number 7, job security should be provided to workers where they are appointed in contracts that are stable. So learner, those are some of the hygiene factors. Then when it comes to motivation factors, which we have indicated like satisfiers, number 1, there should be recognition, where employees should be recognized for their accomplishments and appreciated. Number 2, sense of achievement, where workers are given targets that if they achieve, they also feel they have conquered and achieved something. Number 3, growth and promotion opportunities should be provided to workers. Then number 4, responsibilities, where team production could, for example, be encouraged. Number 5, meaningful work should be made available, where workers feel that it is worthwhile to be able to perform those tasks. Then we have also looked at the implications of the two-factor theory, and we have indicated that it has several implications, including number 1, managers and supervisors must create a conducive work environment. Number 2, employees should be involved in decision making. Number 3, jobs must be designed. Jobs must be designed to enhance employee motivation. Number 4, progressive recognition should be made to employees to encourage motivation. Number 5, organizations should consider combining intrinsic and extrinsic rewards in their motivation processes. And number 6, job enrichment should be used or provided to employees with vertical job loading factors to ensure that workers are able to perform higher level activities, to challenge them and to give them an opportunity to make a contribution and feel that their knowledge and skills have been applied. So before we finish, you have an assignment, learner. Assignment. And your assignment today is assess the application of Habsburg's Frederick Habsburg's two-factor theory in human resource management. Human resource management. So learner, that is your assignment. Assess the application of Frederick Habsburg's two-factor theory in human resource management. So I want to take this opportunity to thank you very much for being attentive in our lesson today. Thank you. Welcome, learner, to our subject of today, research, consultancy, and advisory. We are looking at underlying theories, models of research, consultancy, and advisory. And our focus today in the lesson will be on social systems theory, which falls under selected research and consultancy theories. The social systems theory has been used extensively in social sciences, and the social systems theory is also called or referred to as systems theory. This social systems theory has its conceptual origins in social systems theory and can be traced to the 19th century, to the work of a philosopher, Herbert Spencer, and Emile Durkheim. They extensively looked at social systems, and the social systems theory is the study of society as a complex arrangement of elements, including individuals and their beliefs, as they relate to the whole. That is very critical as it relates to the whole. And in terms of the whole, this refers to a country, an organization, an entity, or a corporation. And specifically when it comes to social systems, when it comes to a company, then the company as a whole is an entity or an organization. And inside that particular organization, according to the social systems theory, there are subsystems within that particular organization. And those systems, the way they relate to each other, they contribute to defining what the whole system is. And when it comes to a country, then within a country, there are systems within a country. Within a country, there are organizations, and those organizations, under the beliefs of those people within that particular country, individuals, they define what that particular country is. In the social systems theory, we are going to look at the basic assumptions of social systems theory. Basic assumptions of the social systems theory. And there are four assumptions that underlie or underpin this theory. And the first basic assumption is that there is an underlying general order in the world. So one, there is an underlying general order in the world. So this system assumes or makes an assumption that generally there is the aspect of order when it comes to things, the way things are done in the world. And that's the first basic assumption of the social systems theory. The second assumption of the second basic assumption of the social systems theory is that social ordering is a consistent and dynamic process. Social ordering is a consistent and dynamic process. Dynamic process. What this implies is that when it comes to any society, whichever way the society is structured, or whichever way an organization is structured, there will be dynamics in terms of how order is maintained and sustained in terms of that particular working organization or that particular entity. Then the third aspect is that, the third assumption is that all human social behavior is purposive. All human social behavior is purposive. What this underlying assumption indicates is that any kind of behavior that is exhibited by an individual in a company, in a country, or in any system, whether it is a church, mention any group, that particular social behavior that is exhibited, it's purposive, or it has a purpose. It has a purpose. So that is the third basic underlying principle underpinning the social systems theory. Then the fourth one is that all forms of social organizations display self-responsibility. Self-responsibility, all forms of all forms of behavior reflect a form of responsibility or responsiveness. So all forms of behavior reflect a form of responsibility or a response. They display a response in terms of the characteristics. So these are the four assumptions which underlie the social systems theory. So the proponents of this theory argue that there is an underlying general order in the world. Then two, social ordering is a consistent and dynamic process. They also argue or assume or underpin that all human social behavior has a purpose, and they argue that all forms of behavior reflect a form of responsibility or a form of response. Then when it comes to the social systems theory, there are certain components of the social system theory. Components of social systems theory. There are components or the characteristics of social system theory which define what the social system is. And these components are: you have an input within the system, you have a process in the system, you have output in the system, and there is a feedback loop from output to input, and then there is the environment within which that particular system operates. So the components of a social system can be seen in a display figure. It can be displayed such that you have a figure or a diagram that indicates the components of a social system. And within this particular social system, we have indicated that this social system will have input, or you can call them inputs. And these inputs as they come, you will have the inputs directed towards the process that they have to be processed within an organizational setting. So you have the processes, you can call them processes, and from processes, then you have outputs. So any system will have inputs, will have processes, and then there will be a loop. There will be a loop from outputs to inputs, which provides feedback. So from outputs, then you have feedback, So this is feedback. Feedback. And when it comes to the feedback, then within that particular system, then you have the environment, and within that particular environment, there will be stakeholders. Within the environment, there will be stakeholders, and these particular stakeholders could, for example, be consumers, you have suppliers, you have, for example, government, among other members. So you have inputs, you have processes, you have outputs, you have feedback, and then you have environment within which the social system operates. And this is typical for any organization. If you are taking a company, for example, an organization that receives raw materials, these raw materials will be processed through processes. For example, if it is tea, for instance, it will be, for example, brought in as raw materials. It will undergo a process from the green leaf, maybe raw leaf and so on, to semi-processed outputs, which can now be dried, for example, tea leaves, maybe packaged. Then these ones are now, feedback is given to the output. And then when you have consumers, so from the outputs, the consumers will be there. Suppliers will also be interacting with this particular system and providing the inputs, like now you need energy, you need regulation by government, you need the price controls and so on. So these would form now the components of a social system that is continuously interacting with its environment to be able to provide goods, to be able to provide services within that particular working context. So the components or characteristics, components or characteristics of a system, of a social system, will include the things that will define a social system. Will include, we have indicated, one, you have the inputs. Two, you have processes. Three, you have outputs. Four, you have feedback. And then five, you have controls. Now, these controls can be brought in by, say, government. You could be an organization and you are operating maybe in the service sector, maybe tourism sector or manufacturing sector. So for you to be able to operate, there will be controls that are put in place by a government. There will be codes of ethics that are put in place by suppliers. You will also have consumers. Consumers will also have the bodies that are representing them in relation to the benefits or maybe the rights of consumers. So the system is in constant interaction with its environment. So when the feedback is provided that what has been produced is being accepted by consumers, then that particular system will basically continue working effectively. If the feedback is negative, then wherever the inputs are coming from, there'll be controls implemented to ensure that if consumers are complaining, if suppliers, for example, are not being paid, then it is important that that arrangement is made to ensure corrective measures are taken into consideration. Otherwise, if there are products being produced by a given company or by a given organization, if they don't meet the expectations of the environment, then those kind of products may not be readily acceptable in the market. So those are the components or the characteristics of a social system as envisaged in the social systems theory. And we have indicated you have inputs, you have processes, you have outputs, you have feedback, and then you have controls. So one may ask, so what are the applications of the social systems theory? Applications of the social systems theory. How can the social systems theory be applied, or of what use is the social system? Now, the way the social system has been put forward by its proponents, a social system looks at a system as being more important than the subsystems. So one, the whole is more important than the subsystem. So when it comes to operations within a given work environment or organization, it is important to note that there will be different sections within a particular system or components. But when it comes to the issue of preferences in terms of choices, what should be done, then the outputs or the processes or the components have to ensure, or the players within the system have to ensure that the players as subsystems are not more important than the whole system. So the whole system and its requirements take precedent when it comes to structuring of events and activities. It is also important to note that those making decisions should be aware that the environment within which a system operates is important. So the environment influences how organizations operate. Environments influence how organizations operate. Let us take an example. You have an organization that is in the manufacturing sector. Now, government and government agencies, for example, you have NEMA. If an organization is manufacturing, it is expected to comply to the regulations that have been set by government and its agencies like NEMA. So if that organization does not comply, then that organization may suffer consequences. So the social systems theory try to explain that as organizations operate, those organizations must be sensitive to the environment. The same thing with Kenya Bureau of Standards. So if an organization is operating, then it has to meet the quality mark. If that organization does not meet the quality mark, then that particular organization may suffer in the market, and customers may not be very confident in, or consumers may not be very confident in patronizing the products of that particular organization. So that's another area where the social systems theory underpins or informs decisions within the area of organization operations. Then it's also important to note that another area of application of the social systems theory is that organizational structures should be designed to be adaptive to changes. Organizational structures should be designed to be adaptive to changes. What is noted widely is that change is the only thing that is permanent. So as organizational structures are designed, it is important to be informed by the social systems theory that change will come. So organizational structures should be designed in terms of how they relate to different functions, with that particular understanding that when change comes, this particular structure is flexible enough, can be adaptive to the changes that are anticipated within a given working context. Then it's also important to note that another area or use of the social systems theory is that subsystems have to be aligned to support the main systems. Subsystems should be aligned. Subsystems should be aligned to support the main system. So if you have a country, we have given an example that an organization or a country could be now the main system. or the main organization. So the way subsystems are designed, they should be aligned to support the main system so that the main system can be able to function and function effectively. Then it is important to ensure that the principles and concepts should be designed to be broadly applicable. Principles and concepts should be designed to be broadly applicable. So when it comes to organizational settings, if concepts or systems are designed within an organization, those systems should not be designed for just specific functions. Those systems and underlying principles within systems should be designed in such a way that because systems relate to each other, principles and concepts should be designed to ensure that they can be broadly applicable within the context of operational organizations and so on. Then it is also important to ensure that when it comes to the social systems theory, every system is bounded by space and time. Every system is bounded by space and time. Every system is bounded by space and time. So at any one given event, if the system is supposed to receive, for example, input, then that particular system that is receiving input, that input is expected to come at a particular setting. And that bounding in terms of time may affect the operations of another system. So the issue of space and time should ensure that the way the systems are working, they are properly synchronized, so that if you have the receiving point, you have the processing point, you have the output point, you have the feedback time, then those systems must be interconnected and interrelated to work effectively as the case might be. Then it is also important that to note that the social system is consistent with the systems thinking approach. The social systems thinking, social systems theory is consistent with systems thinking. Social systems theory is consistent with the systems thinking. So basically what this implies is that in any given organization, it is important that though you have subsystems, you have sections in a department, you have processes like input, processing, outputs, and others. It is important to ensure that for effectiveness of performance of organizations, there must be one approach for the whole organization. So the whole organization must look at issues holistically. Whatever decision that is being taken, the decision has to be taken in the context of the entire organization. So these are some of the areas where application of social systems theory can be able to be applied in management and other operational areas. So in our lesson today, Lana, we have looked at social systems theory as one of the selected theories in the area of research and consultancy. And we have seen that social systems theory is also called systems theory, and it was conceptualized in the 19th century, and it is attributed to philosopher Herbert Spencer and Emil Durkheim, who was a sociologist. And we have seen that the systems theory is the study of society, and it looks at society as a complex arrangement of elements that include individuals and their beliefs, what they believe in, as they relate to the whole. And we have seen that when it comes to the whole, it could be a corporation, it could be a country, it could be a county government, for example, it could be an entity like a church or maybe any other social organization. And we have gone ahead to see some of the basic assumptions of social systems theory, where we have looked at the 4 assumptions, and the assumption 1 is that there is an underlying general order in the world. That is an assumption of the social systems theory. Number 2, social ordering is a consistent and dynamic process. To put things in order, it has to be done consistently, and the process is dynamic. Number 3, the third basic assumption is that all social behavior is purposive. Any behavior that is in an organization, in a work environment, in a group, it has a purpose. Then 4, all forms of behavior reflect a form of responsibility or responsiveness. Then we have gone ahead and looked at the components of social systems theory, where we have looked at inputs, processes, outputs, and we have looked at the feedback loop. And we have also discussed that the social systems theory operates within an environment, and this environment may include stakeholders like consumers, suppliers, government and government agencies, and the components and characteristics of a social system. We have mentioned them as inputs, processes, outputs, feedback, and controls within the system. And then we have also gone ahead, Lana, and looked at the applications of the social systems theory, where we have looked at 7 of the applications where the social system theory can be applied. And we have indicated the number 1, that the social system looks at the whole, indicates that the whole is more important than the subsystem. There will be subsystems within an organization, but when it comes to the degree of importance, then the whole should be looked at as more important and than the subsystem. Then number 2, environments influence how organizations operate, and we gave an illustration and indicated an organization in the operating in the production setting should be aware that the environment, for example, government and government agencies or suppliers or consumers may have an impact on what the organization does. Hence, it is important that organizations become sensitive to their environments. Then thirdly, organizational structures should be designed to be adaptive to change. So this social systems theory can inform those designing organizational structures, so that the organizational structures are designed with an element of flexibility, so that they are flexible and they can be able to operate and adapt to changes. Then 4, subsystems should be aligned to support the main systems. So the subsystem exists for the purpose of supporting the main. So if it is in a government setting, for example, government agencies and government operational areas must be able to support what the entire government is doing. When it comes to a company, the departments and the sections within a company should ensure they are moving towards the realization of the organizational vision. That is how the social systems theory can inform decisions at that level. Then principles, number 5, principles and concepts should be designed so that they are broadly applicable. There should be no principles or concepts that are designed in an organization. If you are designing, say, a system within an organization, then that system should be strong enough and versatile enough to be able to be applied within the organization to achieve the greater goals of that particular organization. Then number 6, every system is bounded by space and time. Whatever system that an organization has, whether it is an open system or a closed system, then that system is bounded by space and time. For example, you may have inputs by a particular time, processes must take place by a particular time, outputs must take place. So if you are receiving raw materials, the system of receiving raw materials should be conditioned to the operational cycle of maybe the operational machines, so that if the machines are, for example, uptaking, then that uptaking of raw materials should be done at a particular time. Processes must be, for example, started. Then you have the outputs in relation to the issue of space and time, so that the systems are well synchronized. Number 7, where the social systems theory can also be applied, Social systems theory is consistent with the systems thinking, where the whole organization is supposed to think as one. So decision making processes must be synchronized so that the organization is able to operate from one point of command. So that is your social systems theory in relation to selected research and consultancy theories in our lesson that we have completed. And before we finalize the lesson, there is an assignment that you need to work on to be able to consolidate your knowledge in the area of theories as they are applied in relation to the social systems theory. And the assignment is examine the application of the social systems theory of the social systems theory social systems theory in management. So learner, your assignment for today's lesson: examine the application of the social systems theory in management. Thank you very much for being attentive in our lesson today.
We have answered required 1. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required 2, distribution schedule for the profit or loss. So distribution schedule is the way we had said. So we'll come and now distribute whatever we have determined. So I'll delete just part of this. And then I'll also change the names here because they are 2. And then I'll also change this. Let me delete this. So I'll call this the partnership name, Kasuku Traders Partnership. Income distribution or allocation schedule. And then here we noted there were 3 partners, by the way. So I'll delete this so that I can introduce the 3 partners. I'll give them the initials. As you have seen, there's Kamara. So I write KA to stand for Kamara, Susan, SU, and Kubasu, KU. And then totals because of the space. So shillings. So we had said the first thing we normally distribute is the salaries to the partner. So you just need to go to the question and determine if there was salaries to the partner. When you read through from the income statement, there was none. Additional information number 1, 2, 3. It was in point number 7. So you come and say now salaries to the partner, Kamara, 600,000. Susan, 450. Kubasu, 225,000. And now we get the total. We add the 3 to get the total. So 600,000 plus 450,000 plus 225, which give us total of 75,000. There. Then the second one is interest on capital. This one, when you go to the income statement, you have to remember the 4 that we talked about first. The salary, interest on capital, commission or bonus, there's interest on drawings, those 4. So you follow them that way. The next one is the interest on capital we had written. So we check. It is there in the income statement, interest on capital. So we would have here 47,500 The other one is 185,000. The other one is 146,000. And now we get the total. So 407,500 plus 185 plus 146, which give us 738,500. Then the other one that we had here was the commission or bonus to partner. But I'm very sure as we went through the question, there were no commission or bonus to the partner. So if it is not there, ignore, just assume it. You go to the fourth one, raise interest on drawings. In the question, we didn't have interest on drawings to the partner, none. So now we do the last one, fifth one, which we said is the profit share. Profit share. So profit share, how do you get? We said we take the operating income, this one, of 125 to 50 minus what you have distributed. You have distributed this and this, which is 75,000 and also 738,500. Then what remains, you share according to the profit sharing ratio. That's what we said. Profit share, you share according to the profit sharing ratio. If you look at the first paragraph, is where we have the profit sharing ratio. Kamara, Susan, and Kubasu are in partnership trading as Kasuku, sharing profit and losses equally. They are three, each to get a third. So first one, a third. The other one, a third. The other one, a third. So let's see what remains. We'll start with 125 to 50, and then we minus 1275,000, and then we minus 738,500. Then we have negative. It will be negative. We have negative 1888. So I'll extend this a bit. 250, which is a negative. Now each is supposed to get a third, so you divide by 3. Each to get 629. 416. I want to round off to, because it's 416.6. 417. So 417, which is a negative. Same case here, because it's for each, and the other one is 629, 417. All they are, remember, are negative. So from there now, we need to get the total taxable operating income. Operating income. So total taxable operating income would mean we take this plus this minus this, because it's a negative. The same case for everyone. So we start with 600 for the first one, 1,000 plus 407,500 minus 629, 417, and then we get positive 3. So this would be 378, 083 positive. And then now we go to the second one for Susan for 50,000, and then we add 185,000 minus 629, 417, 5583. Then for Kubasu, 225,000 plus 146,000 minus 629, 417. This is a loss of 258, so negative 258, 417. Then now we get the total, which would be 1275,000, and then we add 738, 500, and then we minus 1888 250, which we get 125 250, 125 250, and that answer you'll find it is starting with the operating income, because remember we have been distributing this operating income. Actually, we can even write it here, 125 250. So at the end, the total column should tally with the operating income, because we have distributed through salary, interest, and profit share. Once you do that, now we said the investment income come here. You add the taxable investment income. Taxable investment incomes. So for the taxable investment incomes, so we need to go to the question, especially in the income statement, determine if we had an investment income, and then we share if it is taxable. The first investment income in the income statement is the dividend income, which we are told it is net. What we say is this: if you are given an income like dividend or interest, and you're not told where it's coming from, always assume it's a non-qualifying dividend or non-qualifying interest. Like this one, they have not indicated where it's coming from. So being non-qualifying means that the withholding tax was not final. We need to tax it further. So the dividend that we don't put here are the one that we indicated as exempt or qualifying, because exempt are not taxable. And here we are talking about taxable. Qualifying, withholding tax, if it's final, you are not supposed to tax it again. So only non-qualifying. So this one, being that it has not been indicated, we assume is non-qualifying, so it should be here. So dividend income, where we have 562,500, and then it is net. Remember, we said that for non-qualifying dividend, if you are told net, withholding tax is 15, meaning they have already deducted 15, meaning this is 85%. Remember, we said you only tax the gross. So if this 85, 100 will be what? To get 100, multiply by 100 over 85. And then profit sharing ratio, each was to get a third. A third. So it will be 562, 500. We multiply by 100, divide by 85, you get 661, 764. Uh, 765, we round off, and then divide by 3, which comes to 220, 588. Now with that one, we have distributed the dividend. There is another investment income, rent. We said if you're not told where the rent is coming from, you assume it's a commercial rent, so that you tax it further. So here we have not been told. And then for the rent, you must minus the allowable expense relating to rent, repair, caretaker salary for the rental. But for this question, we haven't been told whether there were any expense relating to rent. So we distribute the way it is. So rent income, which we have a 415,000, and then profit sharing ratio, each to get a third. So that would be in total 415 divide by 3, giving you 138,333. 138,333. And then since there is no other investment income, we can now get total taxable incomes. So total taxable income, we do them this way. if the operating is positive, that's the time that we add investment. Like this one is positive. But if it is negative like this, we don't add. We cross it there. Remember, we say that a loss from one activity can only be deducted against profit of the same activity. So operating for this guy, this person, they had a negative. It will be carried forward to next year. So next year, when they generate a profit, he generate a profit or she generate a profit from the operating, she deduct this loss. So for this year, he will be taxed on the investment income only. So for this one who have positive are the one that we add. The negative we don't add, we only add the positives. So we start with the first one, 378,083. 083 plus 220. 588 to 2588, and then we add 138 333, which give us 737 004. We go to the next one, 5583, and then we add to 20 588 to 2588, and then we add 138 333. We get 364 504. For this one, remember we said we don't add the negative, carry forward to next year, we only add the positives. So 220 588 plus 138 333, which we get 358 921. And then we go to the total, 125 250 plus 661 765, and then we add 415,000, so giving us 1202 015. Yeah. And the question ends there, and this total cannot be the same as this way because this we didn't add. So this we carry forward to next year. So as per the question, that is where we stop, and that is how we determine the taxable income of the partnership, and we do the distribution. For now, we are going to stop there until I see you in our next lesson, where we are remaining with one business, that is the limited company. We see how limited companies are usually taxed. Thank you very much. However, make sure that you do the assignment that is being shown at the end of this video. Thank you very much. Hi there, my name is Patrick Kamau Kamure. You are a lecturer in public finance and taxation. Welcome to today's lesson. Today we continue from where we stopped last time. Remember, the topic we are looking at the moment is called the taxation of the business income. And we said that there are three businesses that we need to look at how they are usually taxed: the sole proprietorship, partnership, and the limited company. So far, we have looked at the sole proprietorship. Last lesson, we started looking at the partnership, whereby after looking at how partnership is usually taxed, we went ahead and we used the net profit method to get the taxable income of the partnership. So today we continue with the same lesson, but we look at another question where we used a different approach to answer the same question, a different question using now the gross profit method. Welcome to today's lesson. So we are going to start by reading the question. After reading the question, then I'm going to help you solve the question. So here is the question. This is what the question says. Karimu and Shika commenced trading in partnership as Kashi on January 2019. They share profits and losses in the ratio of 2:1 for Karimu Shika respectively. The partners were to receive monthly salaries of 18,000 and 22,000 for Karimu Shika respectively. The partnership did not maintain complete set of accounting records. The following summary of the bank statement for that year has been presented to you. So we have the receipts consisting of capital introduced, Karimu and Shika, cash sales, receipts from debtors, sale of a van. We go to the payment side. Equipment of office, rent for go down, salaries and wages, purchase of for resale, repair and maintenance, insurance, interest expense, motor vehicle expenses, sundry expenses, motor van purchased, tax penalty, electricity, medical expenses, balance carried forward. Additional information number 1. The following payments were made in cash from the cash sales before banking. We have the motor vehicle expenses per annum, wages per annum, sundry expenses per annum, weekly drawings for Karimu and Shika. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118,000. As at that 1st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. Depreciation was to be provided on equipment at 10% on a straight line basis. As at that 1st December 2019, the amount owed to supplier was 780, while the amount owed by the customer amounted to 1420. An amount of it 2,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad debt. This amount was excluded from the total amount owed by a customer as at that 1st December 2019. Salaries and wages include the salaries to the partners. The go down had been occupied since 1st November 2019 at an annual rent of 450,000. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. The wear and tear allowance, and it's good to note that wear and tear allowance is the same as the capital allowance. So wear and tear capital allowance was agreed with the Revenue Authority to be 112,000 for the year ended at 1st December 2019. So number 11, closing inventory was valued at 620,000 on 31st December 2019. Assume that year of income had 52 weeks. Required 1. Adjusted partnership profit or loss for the year 2019, and number 2. Distribution schedule of the profit or loss calculated in C1 above. So the first question is to get the taxable income, and we say that whenever you are told to get the taxable income of any business, you either use the gross profit approach or the net profit approach. Net profit approach, we said, is when you have been given net accounting profit or loss or income somewhere. If you haven't been given, you use the gross profit method. So this question, we are not given the net profit or loss or income. So automatically we use the gross profit method. Now gross profit method, we said, we usually start with the sales. We less the cost of sales. Cost of sales, we take the opening stock plus purchases, less closing stock minus any item that reduce the stock. And then we get the cost of sales. We less from the sales, we get gross profit. And the reason why we call it gross profit, we said. And then you add other taxable operating income, and then you less the allowable expenses. So, but we said before you start, always confirm. Do you have the sales? Do you have the total purchases? If you don't have, or you haven't been given, then in that case you have to determine them first. So in this question, we take note that we're starting with the sales. We are given only one, the cash sales. But the cash sales does not represent the total sales. We have to look for the credit sales. We add to the cash, we get the total. So now, we are not given the sales, so we have to look for it. The other one is the purchases. Have we been given the purchases? Yes. In the payment, in the statement of bank statement, there is a purchase for resale, but that is a cash purchase. Now, how about the credit? So in this case, we have to determine the credit purchase so that we can add to that cash, we get the total purchases. So this is what we said you normally do. To get the total sales, you do it this way. You say total sales is equals to credit sales plus cash sales. We said for the cash sales you'll be given, it is there, like we have seen it's already there. The issue is about the credit sales, where you have to determine it. Now, the best way to approach the question, we said, leave a space like 2 lines, where now you'll be able to open the debtors or receivable account to determine the credit sales. So we'll come here and have the debtors stock receivable. You start with balance brought down here. That's what we said for the debtors. And then jump 4 or 5 lines here where you'll be posting those items that affect the debtors. And then balance at the end here for the debtors. And then totals would be here. Same case on the purchases, we say total purchases is as a result of credit purchase plus cash purchases. For the credit purchase, we jump a space of 2 or 1 line, and then we have the creditors or payables account, where we will be able to get the credit purchase. Then for the creditors, you start with balance pro down here for the creditors, and then jump 4 or 5 lines, then have the balance carry down for the same creditors. And then you'll be able to post everything and the totals there. Once you have done that, now go through the whole question. If you come across some cash sales here, something affecting the debtors here, cash purchase here, anything affecting the creditors here. So we start. From the first paragraph, the only figures that we have are 18,022, which were monthly salaries to the partners. So those do not affect, so we ignore. We go to the receipt. Capital, introduced, that's not. Cash sales, yes, here. So we post it here, 12,700,000. And then receipts from debtors. Receipts from debtors, we said it reduces the debtors. Here, receipts, which we have 5,200,000. Then sale of motor van, that doesn't affect. We go to the payment side. Equipment for the office, that does not affect. Rent for the go down doesn't. Salaries and wages, no. Purchase for resale, yes. Here, that's a cash purchase, of which case we have 9,900,000. The other one is the repair and maintenance doesn't affect. Insurance, interest, motor vehicle, sundry expense. Motor vehicle purchase, that's a fixed asset, not goods. Remember, what we are looking for are for the goods. Tax penalties, electricity, medical expense, balance carried forward, those do not. Then we go to the additional information number 1. The following payments were made in cash from cash sales before banking, meaning what went to the bank, as we can see the bank statement was this. But before that figure was posted, not really this one, but the one in the bank statement, we had 12,700, this one. But before they banked the 12,700, they had paid some expenses, meaning our cash sales was more than what was banked. So to get the how much it was, we need to add the one that was sold on the one that was sold on cash and then used to pay the expenses. Which one? Motor vehicle expense. So the key thing there was from cash sales, were paid from the cash sales. Motor vehicle expense per annum, that we had 138,000. The other one is wages, 162, plus sundry expenses per annum, 35. Then weekly drawings by Karimu and Shika. So weekly drawings for the whole year, it has to be for the 52 weeks. So 52 weeks times, now weekly for the total, which is 7,200 plus 6,400. And that ends there. From there we go to number 2. During the year, discount received from the supplier amounted to 132,500. Discount received reduces the creditors, so we'll have it here. discount received, which we had 132,500. The other one, where discount allowed to customers amounted to 118,000. Discount allowed, which reduces the debtors, discount allowed, which we have 118,000. I want to bring this one a little bit up here, but I haven't changed anything. It's just this. And so we had said the balance carried down for the creditors. We leave it there. So we continue. After that, we go to the point number 3. As at 31st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. That doesn't affect. Depreciation was to be provided on equipment at 10% straight line. No. As at 31st December 2019, the amount owed to supplier was 780. Now, this at the end of the year, what the supplier are owing is 780,000. And then, while the amount owed by customer 1420. What is owed by the customer is 1420 at the end there. We continue. An amount of 82,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad. This amount was excluded in the total amount owed by the customer as at 31st December 2019. So that's a bad debt written off. Bad debt written off reduces the debtors written off, which we have 82,000. 82,000. The other one is number 7. Salaries and wages include salaries to the partners. That doesn't affect. Number 8, go down had been occupied since 1st November 2019 at an annual rent of that. Doesn't affect. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. Doesn't affect. The wear and tear allowance was agreed with the Revenue Authority to be 112,000 for the year 2019. Doesn't affect. Closing inventory was valued at 620 on that 1st December 2019. Doesn't affect. So we are done. So from there we do the computation. So we are going to add the totals on this side and compare to the total on this side. Actually, we have seen the balance brew down is 0 and also balance brew down here because we started or they started the business at the beginning of the current year. So there was no balances from last year. So it's all about the total on this side will be now the credit sales here. Credit sales. So we add them 5,200,000 plus 118,000 plus 82,000 plus 1420, which gives us 6820,000. And this one, 6820 should be the totals, 6820, because we now have written the balancing figure. So then this one, we transfer it here, 6820,000, which we should be able to add now the cash. So we'll start by taking 7,200 plus 6,400 times 52. So it will be 7,200 plus 6,400 times 52 weeks, because that was per week. That becomes 707,200 plus 35,000 plus 162,000 plus 138,000 plus 12,700,000. Then now we add this one plus 6820,000. 6820,000, giving us 20,200,200. That is the total. We come here, we add this plus this. This is 0, so that will be the credit purchases. So this plus this, 132,500 plus 780,000. So that will be 912,500, which will be here 912,500. 912,500. We transfer that one here, 912,500, And then now we add the cash purchase. So plus 9,900, which give us 10, 8, 12, 500. There. With that one now we can prepare the statement of determining the taxable income. So we'll come here, the name of the partnership is Kashi Enterprise Partnership. We get the taxable income for the year ended 31st of December 2019. So we start with the sales, which we had determined 20, 562, 500. Then we less cost of sales. Cost of sales, which we take the opening stock. But here you'll note that we were not given the opening stock because we started the business at the start of this year. So there were no opening stock from last year. So 0 plus the purchases. Purchases is what we have determined here. 10, 8, 12, 500. Then we minus the closing stock. Closing stock is the one given in point number 11, 620,000. So minus 620,000. And then we also minus any item that could have reduced the stock during the year. Damaged, withdrawn stock, stolen, of which case the whole of this question, we didn't have any stock that was stolen, damaged, or withdrawn by the partners. There was none. Let me confirm properly. There wasn't any. The drawings that we are given in additional information, number 1 was cash drawings, not goods. So in this case, we cross to get the cost of sales. Cost of sales, which will be the 10, 8, 12, 500, you minus 620,000. And that gives us 10, 192, 500. And then we can be able to get the gross profit. Gross profit will be, we minus that from 20, 562, 500. And that gives us 10, 370,000. Then we said this, after getting gross profit, and the reason why we call it gross profit method is to add other taxable operating income. Other taxable operating incomes. Other taxable operating incomes. Of which case we said you jump a space of like 3 lines and then you less. I want to bring this one here, 1,000. So you less allowable expense after jumping around 3 lines. Allowable expenses. So what we do now, we go through the whole question. If we come across a taxable operating income, an allowable expense, we post here. We start from the top. The first paragraph was about the salaries to the partner. We said anything to the partner we don't allow. It's an expense yet, but not allowable, so we cannot post. We go to the summary of the bank statement. On the receipt side, capital is not an income or an expense. Cashes, we used it to get the sales. Receipts from debtors, we used it to get the sales. Sales from the van, we said income from selling fixed assets we don't tax, so we cannot post here. We go to the payment. Equipment. Equipment is a fixed asset, which we should claim capital allowance at the rate of 10%. But we won't do that. Why? If you look at additional information number 10, we are told the wear and tear allowance, which we said is the same as capital allowance, was agreed with the revenue authority to be 112,000. So that's the one that we use. Anywhere we require to compute capital allowance, we use that. So we can even post it now, the capital allowance, also called WTA or wear and tear allowance for the year. It was agreed to be 112,000. From there, we go back to where we found that in the bank statement. After equipment, rent for go down. That's an allowable expense, rent expense. But we have an additional information to that rent. If something has an additional information, check it out. In additional information number 8, the go down has been occupied since 1st November 2019 at an annual rent of 450. So annual is per year. And now it was occupied from 1st November. Those are 2 months. So forget about the one that you are given. Use the one that you can get for this particular year. So in this case, we are going to take 2/12 times the 450 because it was only occupied for 2 months to the end of the year in this particular year. So this is going to be 2/12 times 450. That will be 75,000. That is the one that we allow. Any other, we forget. Then we go back. After the rent for the go down, salaries and wages. That is allowable. But we have to check whether it is mentioned somewhere else. Salaries and wages. Yes, it had been mentioned in additional information number 7. The salaries and wages include the salaries paid to the partners. Salaries. And here they have made it very clear that it is salaries and wages. Another place that we have wages now mentioned is number 1. The following payment made through the cash from the banking. So we have the wages. So what do? We'll come here and have the salaries and wages. So we open a bracket. Remember, we want to know the allowable salaries and wages for this year. 890,000. And then now we have to add the one that was paid through the cash. This was through the bank. The cash was 162. And then number 7, it includes the one paid to the partners. So we have to remove because we said anything to the partners we don't allow. To the partners was how much? In the first paragraph is where we were told the monthly salaries to the partner was 18 and 22,000. Monthly, underline monthly. So meaning to get the whole year, we have to take minus 12 times 18,000 plus 22,000. So that we can get, and since it is not mentioned somewhere else, we do the computation. So we take first of all the 18,000 plus 22,000, and then you multiply by 12 months because it was monthly. We get for 80,000. Then we remove them from this. So we take 890 plus 162 minus 480. That gives us 572. That's the one that we should be allowing there. After that, we go back to where we found the salaries and wages. After salaries and wages in the bank statement, purchases for resale, that we used to get the purchases up there. Repair and maintenance, that is another allowable expense. Repair and maintenance. So we check if it is mentioned somewhere else. There isn't. So we just pick the figure as it is, 860,000. After that, we go back. After the repair and maintenance, there is insurance. Insurance is also a allowable expense. So we have insurance. Is it mentioned somewhere else? Yes. Additional information number 3. As at 31st December 2019, electricity and insurance prepaid. So this was prepaid, and it's at the end of the year. We said prepaid at the end of the year is for next year, not for this. Anything that is not for this year, we minus. So we are going to take the insurance of 625 And then we minus the prepayment which we have 12,800. That will give us how much? This will be 62, 500. We minus 12,800. That gives us 49,700. After that, we go back to where we found the insurance. After the insurance, there is interest expense. Interest, we say, is allowable. So interest expense. But it is mentioned somewhere else. In additional information number 9, included in the interest expense is the interest on partner's capital contribution at the rate of 5%. Included in interest. Anything to the partner we don't allow. So we will take this interest, which is 612,000, and then we minus the one that was paid to the partners, which was 5% of the capital. The capital is in the bank statement, where we have for the two partners 3,500 plus we have the 2,500, that is 2,500,000. That. So we add the capitals, which are 35 plus 25 times 5%, which give us 300,000, and we minus from 612, that give us 312,000. That's the one that is allowable, the one paid to the partners. Then we go back after the salary, after the interest, after the interest. Motor vehicle expense. Motor vehicle expense is allowable, and we say that is not the cost of motor vehicle, it's the vehicle expense incurred to run the motor vehicle, fuel, repair. So in this case, that is allowable, not a fixed asset. Motor vehicle expenses, where we are told the motor vehicle expense is 186,500. After that, we have sundry expense. Maybe there is something that I should have confirmed. In additional information number 1, there is more motor vehicle expense. The one that was paid in cash, 138. We forgot about that, so we should add it. So it will be 186,500 plus the one that was paid cash, which we have 138,000. 138,000. We check if it is mentioned somewhere else, but the motor vehicle is not mentioned anywhere else. So what does that mean? Then that means that we do the computation. 186,500 plus 138,000, which we get that 245,000. That 245,100. Then we go back after the motor vehicle expense. We have sundry expense. Sundry expense is an allowable expense, so we continue. Sundry expenses. And this one again, it is mentioned somewhere else in additional information number 1, the one that was paid through the cash. So we'll have 18,000, and then we add the one that was paid through cash, which we have 35,000, which we have 218 plus 35,000, which give us 253,000. Then we go back after the sundry expenses. Motor van purchased. That's a fixed asset which we should claim capital allowance. But remember, we were already given the capital allowance, so we ignore. Tax penalties. We said any expense relating to tax we don't allow. Electricity expense, that is allowable. So electricity expense. But we check for the additional information. If you go to the additional information number 3, we had electricity prepaid, and we said prepaid is for next year. So that one we need to remove. We need to minus, because of what was paid this year of the electricity, 45,800. Part of it is for next year, and so we should minus from here, where we have the 25,000. That gives us 2,800. Then we go back to where we found that. After the electricity, there is medical expense. Medical expense are allowable unless we are told it was relating to the partner, which we haven't been told. So medical expense. Medical expenses 630,000. Then now we go to the additional information for any taxable, operating, or allowable expense. Additional information number 1. The following payments were made in cash from cashes. Motor vehicle expense we have considered. Wages we have. Sundry expense we did. Weekly drawings, those are not allowable expenses. Additional information number 2. Those are the figures for the balances of debtors and creditors at the end of the year. So they are not incomes or expenses. Number 3, we have already adjusted for them. Number 4, depreciation. Remember we said depreciation is not allowable. We claim capital allowance instead, which we have been given. Then number 5, as at 31st December 2019, the amount owed to supplier was 780, while the amount owed by customer was 1420,000. That we had said actually, there's something, there's additional information we jumped. Number 2, during the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118. Discount received, that we know is a taxable operating income, so it should come here. Discount received, that is a taxable operating income. And we have the discount received of 132,500. And then we have the discount allowed. Discount allowed is an expense and it's allowable. Discount allowed. Discount allowed, which we have been given as 118,000. There. From there we continue. We were actually in point number 5. That's where we were saying that we had the balances at the beginning and also at the end. And then from there, number 6, an amount of it 2,000 owed by Jamira Mamba, a customer proved irrecoverable, and it is to be written off as bad debt. This amount was excluded in the total amount owed by the customer as at 31st December 2019. That is a bad debt written off, which we said is allowable expense. So we'll have bad debt written off. Bad debt written off, which we have an amount of 82,000. After that, we go to number 7 now. Salaries and wages include the salaries paid to the partner. Now that we had adjusted in the salary here, if we had forgotten, now you should be able to adjust. Number 8, we had adjusted on the rent. Number 9, we had adjusted in the interest. Number 10, capital allowance we had posted. Closing inventory that we used to get the cost of sales here. There is nowhere else it's supposed to be used. Now that is the end. What remains, and this being a partnership, it should end here, is to get the net taxable operating income. So how do you get the net taxable operating income? It is the gross profit plus discount received minus these expenses. So we do the computation. So we start with the 10. 370,000 plus 132,500 minus 112,000 minus 75,000 minus 572,000 minus 860 minus 49,700. Remember this was 7. 49,700 minus 312 minus 324.5 minus 253 minus 2,800 minus 630 minus 118 minus 82,000. That gives us 7 million 093 500. And that answers required 1, where we are supposed to get the taxable profit of the partnership. With that one, we are supposed to go to the required number 2, where we do the income distribution. So the income distribution schedule, this is what we said or how it is supposed to look like. So income distribution schedule. We start by distributing the operating income. So we will start with taxable operating incomes, which is the one that we have determined here, 70, 93, 500. And then now we list the partners that we have, which we have Karimu, Shika, and now the totals. So we go through the question. Remember, we start by looking for the first 4 items that we said: the salary, interest on capital, commission or bonus, less interest on drawings. Those 4. So if you look at the first paragraph, we had the salary to the partner, salary, which we were told it was per month. So the first one was to get 18,000 times 12. The other one was to get 22,000 times 12. Because they were monthly amounts. So we have 18 times 12, which give us 216,000. So 216,000. The other one is 22,000 times 12, giving us 264,000. And now we have the total plus 216. 480 for 80,000. Then we go to the capital, to the cash bank statement. In the bank statement on the receipt, we had capital, which is not one of the item we are posting. You go to the payment side, there is none. You go to the additional information, number 1, drawings we said we ignore. Number 2, no. 3, no. 4, no. 5, no. 6, no. 7, we have posted. 8, no. 9, there is interest on capital. So interest on capital, which is supposed to be 5%. 5% of the capital. How much is the capital? In the bank statement, we have capital of 35. And also, the other one is 25 for each. So we start with 5% of 35, which gives us 175,000. The other one is 25 times 5%, giving us 125,000, and the total gives us 300,000. Then after that, point number 10, none, and 11, there is none. So the only remaining one is now the 5th one, profit share. How do you get the profit share? We said you take the taxable operating income we have, like in this case we have 70, 93, 500, and then you minus what has been shared already. We have shared the 480,000 and also shared the 300,000. So whatever remains you share according to the profit sharing ratio. And what was the profit sharing ratio? In the first paragraph, they were sharing 2 to 1. So the first one will get 2 out of 3, the other one 1 out of 3. So let's minus 70, 93, 500, we minus 480, and also we minus 300,000. For 80,000 and 300,000, give us 6313. So 6313, 500. Then the first one will get 2 over 3. That give us 4209. 4209, 900. Thousand, sorry. And there now, the other one, we can take the 6313, 500 minus what we have given this. 63, 13, 500. That will give us 2104, 500. And now we can get the total taxable operating income. Total taxable operating income. So for Karimu, it will be 216,000. We add 175,000. We add 4209, which we get 4,600,000. The other one will be 264,000. We add 125,000, and then we add 2104, 500, which gives us 2493, 500. And now the total, which would be for 80,000 plus 300, and then we add 63, 13,500, which give us 1793, 500, and which is the same as the operating income we had determined. Remember, if we had an investment income that is taxable for this question, after getting the operating income, we add taxable investment income, and we share and then get total. But the whole of this question didn't have an investment income. So meaning our question then should end here. So this one will give us now the total taxable income, which should end there. That is how we tax a partnership when you have not been given the net accounting profit. So for this question ends here. And now what is remaining is the taxation of the limited company, which we are going to look at in our next lesson. For now, we stop there until we meet in the next lesson. After this video, there is some assignments, questions that you can attempt. Kindly do attempt and then see if you can be able to do the way we have done it. Thank you very much. Hi there, my name is Patrick Kamau Kamure. Welcome to today's lesson of Public Finance and Taxation, where we look at the taxation of farming activities. So farming activity is somehow connected to the taxation of the business that in our previous lessons we have covered, because all matters is how is the farming activity carried out. Is it done by a limited company, a partnership, or a sole proprietorship? So when it comes to the taxation, determination of the taxable income, everything remains the same. So the only difference are just two things that you need to know. Additional taxable income in farming. Those are incomes that are specifically for farming, in addition to the one that we said are taxable under normal business, and also additional allowable expense. The one that we talked about are still applicable, and now they are those specific in farming because farming is a special activity. So I want to write something about the taxation of the farming activity here. Before then, at the end of it, we look at a question. This is what you need to know, that farming is also called farming is also called agriculture. And it involves keeping of animals or growing of crops. for food or commercial purpose. When farming is done, for commercial purpose, then the income generated become a taxable income. Another point is farming is taxed depending on how it is carried out, either in partnership, by a limited company, or by a sole proprietor, where it is taxed in the same way as these businesses as already covered. However, the following apply specifically in farming. So we have number one, the following specifically apply in farming. We have additional taxable income. This includes all incomes generated in farming, i.e., income from selling of crops, livestock, farm produce, animal produce, etc. Before we continue, what we are saying is that, as I had introduced, that you do farming either for food, for commercial. If you do farming for commercial purpose, then the income you generate become taxable profit like any other business. Now, how do you tax the farming activity? It depends on how it is being carried out. Is it being done by in partnership? You tax it in the normal way, like a partnership, the way we have covered in our previous lesson. Determine the taxable income, then distribute the income to the partners, then tax them individually. Is it done by a limited company? It is a company, determine the taxable income of the company, then tax the company, just normally. Is it done by a sole proprietor, where you determine the taxable income of that sole proprietor, then tax him? However, we are saying the following specifically apply in farming: additional taxable income. Like that, any income that come out of farming activity, like selling of crops, livestock, animal produce. Animal produce are like eggs, milk, hide for the animals. All those are supposed to be taxable, and any other income that come out of farming activity. Then we have number two, additional allowable expenses. Additional allowable expenses. These include, we have A, costs of purchasing seed, fertilizer, and livestock. B, we have farm operation expenses. Such as cost of water, electricity, transport, etc. Then we have C, costs of clearing land and planting permanent and semi-permanent crops. D, costs incurred to prevent soil erosion. I.e., construction of gabions, terraces, and making of windbreaks. The last one, capital allowance. Capital allowance on capital expenditure or farm work costs. This one, check capital allowance computation. So what we are saying is this: when you see these expenses and they are incurred in farming, treat them as a allowable expense. One we are saying is the cost of purchasing seeds, fertilizer, and livestock in farming. They are allowable. Treat them as allowable expense. Farm operational expense, just like any other business, water expense, electricity, transport, and any other expense incurred in farming, allowable. Cost of clearing land and planting permanent and semi-permanent crops. Permanent crops are the crops that can be in the farm in the long term, like coffee plants, tea plants. The cost of planting them are allowable. Semi-permanent are like pyrethrum. They're usually in the short run, but 2, 3, 4, 5 years. They are all allowable. Cost incurred to prevent soil erosion, like construction of gabions, terraces, making of the windbreaks. All these are allowable as long as they are to prevent soil erosion. And capital allowance on capital expenditure in farming. Capital expenditure in farming is also called farm work cost. So when you see farm work cost, claim capital allowance under farming. And this I'm reminding you to go and check the capital allowance computation because we learned about it. Now at this moment, I'd like us to look at a question to see what we are talking about. So I read the question. This is what the question says. Mazao Ranch Limited practices mixed farming and milk processing. The following is the company's statement of profit or loss for the year ending that 1st December 2020. We have the revenues consisting of sale of milk, sale of livestock, sale of manure, proceed from the sale of an old tractor, discount received, expenses, which we have general expenses, construction of water tank, vaccine for livestock, loan repayment, depreciation, electricity and water, conveyance fee, construction of chicken sheds, animal feeds, salaries and wages, bad debt provision, repair and maintenance, professional fee, net profit. Additional information number 1, farm work acquired on 1st July 2020 comprised of the following: granary, labor quarters, cow sheds. Number 2, general expenses include subscription to a farmers association, acquisition of a 50-year lease, staff Christmas party, parking fine. Then number 3, repair and maintenance comprised, provision for fencing expenditure, repair to machinery, other repairs. Number 4, professional fee include 500,000 paid with regard to pursuing a dispute with the Kenya Revenue Authority, VAT department. Then assume corporate tax rate during the year was 25%. Required, adjusted taxable profit or loss for Mazao Ranch Limited for the year ending 31st December 2020, and the tax payable if there is any. So in this case, we take note. Yes, it's a farming activity, although they are mixing it with processing, but the key thing is farming activity. And then the farming is done by a limited company. So whatever we have been saying about a limited company apply with addition of this additional taxable income we have talked about and additional allowable expense. So we treat it as a normal, it's a company actually. So the next question should be, which method are we supposed to use to get the taxable income? Like any other business, for this one we use the net profit method because we have been given the net accounting profit after the income statement. So this is how we go about it. For the year ended 31st of December 2020. So we start with net profit provided, which we have 157,000. Then when you are using the net profit method, we said you add non-allowable expenses in P&L and taxable operating income not in P&L. So just like we have been using the net profit method, we'll go through the P&L, look for the expenses that are not allowable in the P&L first. So which expenses are in the P&L? General expense. General expense we have been saying is allowable is for the business. Construction of water tank. We don't allow water tank, that's a fixed asset. So construction of water tank, a fixed asset we don't allow. Of which case we have 240. Had been deducted, isn't allowable. Next, vaccine for the livestock. That is allowable expense, vaccine, because it's a farm operational expense. Loan repayment. We said loan repayment is not allowed. What we allow is the interest on loan, not the loan. So we disallow that. Loan repayment, 350,000. After that, depreciation. Depreciation isn't allowable, so we add it. Depreciation, which you have 180,000. Electricity and water, that is allowable expense. Conveyance fee, no. If you go to the legal expense, we said conveyance fee is not allowable. And which we have 156,000. Then construction of chicken sheds. That's also a fixed asset, you know, a structure. We disallow. Chicken sheds, a fixed asset for 80,000. Animal feeds, that is an allowable expense. We said an operational expense. Salaries and wages is allowable. Bad debt provision. Provision we don't allow unless there are specific provision. So we disallow that. Bad debt provision, which we have 150,000. 150,000. Repair and maintenance, that is allowable, and also professional fee are allowed. From there, we go to the additional information we look for, an income not in P&L. If an income is not in the P&L, can only be in the additional information. And if it happens to be taxable operating, we add. And at the same time we go there, we look if there is an analysis of the expense in P&L. In the analysis, if they do happen to be non-allowable, we add still. We start with the additional information. Number 1. Farm work acquired on 1st July 2020 complies of the following. Now, farm work, that's a fixed asset. We said here, it's a capital expenditure. We don't allow capital expenditure. We claim capital allowance. But those expenses, if you look at them keenly, they are not in the P&L, so we cannot touch them. Then number 2, general expense include. Now, general expense is one of the expenses in the P&L, so we look for the non-allowable expense in it because it's an expense in the P&L. Subscription to Farmers Association, that's a trade association which we allow. Acquisition of a 50-year lease, that's allowable. We said up to 100 years, up to 99-year lease is allowed. Staff Christmas party allowed for welfare. Parking fine, we don't allow fine. So in this case, we disallow. Which we have 129,000. Then after that, we go to number 3. Repair and maintenance complies. Now, repair and maintenance is in the P&L. So we look for the non-allowable in it. Provision for fencing expenditure. We don't allow provisions. So we add provision. Only specific provision for bad debt do we allow. This provision for fencing, it's not specific provision for bad debt. For fencing, which we have 145,000. The other one is repair to machinery, that is allowed, together with other repairs. They are all allowable, revenue expenditure. Then we go to number 4, professional fee include. Now, professional fee is in the P&L. If you go to the P&L, the last expense is actually the last one. Is in the P&L. We look for non-allowable in it. It includes 500,000 paid with regard to the pursuing dispute with Revenue Authority VAT. We said any expense relating to tax we don't allow. So we'll have a professional fee for VAT. $500,000. We don't allow. Number 5, assume the corporate tax rate during the year was 25%. That's not an income, it's not an expense. So we are done with an allowable expense in P&L, an income not in P&L. Unfortunately, we didn't come across any. Now we now come to the deduction. Remember, we deduct 3 items: non-taxable operating income in P&L or investment income in P&L and allowable expenses. Allowable expenses not in P&L. So first thing, we go to the P&L. We look for non-taxable operating income there. And also the same P&L, we look for all investment income there. Let's see. In the P&L, these are the incomes. Sale of milk. We said sale of milk is a taxable income. Taxable operating in farming. Income from selling of an animal produce. We said here under taxable operating income. Sale of livestock are taxable operating for farming. Sale of a manure, that's an animal produce, a taxable income. Proceed from the sale of an old tractor. Under normal circumstances, we don't tax income from selling fixed asset. That's a fixed asset. So profit on sale of tractor, which we have an amount of 820,000. We remove, not taxable. The other one is discount received. Discount received is a taxable operating under normal business. That's what we said. So since we are done, there is no other income in P&L that we have not considered. We now look for allowable expense not in P&L. An expense that is allowable that isn't in the P&L. If it is not in the P&L, then it can only be in the additional information. Let's see. Number 1, farm work acquired on 1st July 2020 comprised of the following. Now, farm work that is not in the P&L and it's also not allowed. We said, what do? We claim capital allowance on farm work. Which one? If you go to the capital allowance we discussed earlier on in the previous lessons, so we said granary, that should be 50% without considering time. Even if it was from 1st July, we don't consider time. Labor quarters in farming, remember in farming, is supposed to be 50%. Now, cow shed, that's supposed to be another 50% without considering time. So we claim them. So we are continuing here. On that, we are looking for allowable expense not in P&L. So we have capital allowance on. We start with granary, which should be 50% of 420. That will be 210,000. Labor quarters, 50% of 1,200. That will be 600,000. Then cow shed, 50% of 160. That will be 80,000. So we are done with number 1. We continue looking for allowable expense not in P&L. Number 2, general expense is in the P&L, including whatever is in there. Substitution, all of them are in the general expense. Repair and maintenance is in the P&L, including whatever is in there. Professional fee is in the P&L. 5 is not an expense. Now that we have not been given capital allowance, and that's the reason why we are computing, you have to come back here and now look for fixed assets so that now you can finish on the capital allowance. We had construction of water tank. That is a structure construction. So that's supposed to be 50%. It is a structure in farming. The other one is construction of chicken sheds. That's another 50%, a structure in farming. And this fencing, if it was not a provision means that they have not yet incurred. They are providing they are going to incur. We don't claim capital allowance. But if it was incurred, we could have claimed 50%. And there isn't any other fixed asset. So you'll come here, a water tank construction of, we have tank, which is supposed to be 50% of 240. That will be 120,000. The other one is chicken shed, construction of chicken shed, which should be another 50%. Chicken shed we had for 80. That will be 240. And since there is no other fixed asset and we are done with the allowable expense not in P&L, we get the net taxable operating incomes. So we are going to take this, add, and then minus. So we start 157,000, and then we add to 40,000. We add 350,000. We add 180. We add 156. We add 480. We add 150. We add 129. We add 145. We add 500. And then we minus the 8, it was 820. We minus 210. We minus 600. We minus 80. We minus 120. And we minus 240, which we have 417. So this is 417,000. Now note, this was a company, limited. So we said company, since it is taxed on its own income, we add the taxable investment income. Investment incomes. But if you look at the question, in the income statement, these were the income. Sale of milk, sale of livestock, manure, proceeds from old tractor, discount. There is no investment income. So this would be a dash, meaning the total taxable income would be the 417,000. So that mark the end of required one, adjusted taxable profit or loss of Mazao Ranch Limited for that year. Number two, tax payable or on profit or loss. So in this case, we say this is a company. We say that, like any other company, corporation tax rate that we have not been told is an unresident or a foreign company, 30%. So we'll say tax would be 30% of 417,000, which will give us how much? 30% of 417. That gives us 125, 100. And that is the end of that question. So that is how you tax the farming activity. And you would have noted that it's not different from the businesses that we have looked at. You just consider it like a normal business. Sole proprietorship if it's done by a sole proprietor. A partnership is if it's done under partnership. A limited company like the way we have done it there, then you just tax it that way. The only additional thing that you need to know is this additional taxable income and additional allowable expense. So that marks the end of the taxation of the farming activities. And I want you, below this video, there is an assignment. Kindly go through it, look at it, attempt it, then see if you can be able to do it the way we have done ours here. So for today, we end there. Thank you very much.
Greetings and welcome back to the lesson. The subject is Introduction to Law and Governance. We today going to study compliance obligations. But first of all, we define compliance. Now, compliance, candidate, is the act of adhering to and the ability to demonstrate adherence to mandatory requirements. The law requires companies to do certain things or not to do certain things. So the act of obeying the laws, the act of obeying the regulations is what is known as compliance. The act of adhering to mandated requirements that are defined by law, that are defined by regulations, as well as voluntary requirements resulting from contractual obligations and also internal policies of the company. And compliance mainly operates at two levels. One is compliance with the external rules that are imposed upon an organization as a whole. Then the second level of compliance is compliance with internal systems of control that are imposed to achieve compliance with the externally imposed rules. So compliance can be seen from two levels or two perspectives. That is the compliance with the external rules, then compliance with the internal rules or regulations or internal systems of control. Now, candidates, compliant organizations need an effective approach to verify that they are in conformity with the external standards or regulations and also internal policies. A company that complies, what I'm calling a compliant company, needs an effective approach. There has to be a system in place to verify that the company is adhering to rules and regulations. There has to be an approach because we know, candidates, companies operate within a certain legal environment. Companies are expected to adhere to many laws. Many laws have to be adhered to. So it's important for an organization to have a system or an approach which can help the company in verifying if the rules are being adhered to. And such an approach or a system is assisted by what we call risk management. Risk management, which must identify and prioritize risks that are already aligned with corporate objectives defined by governance. So compliance with law and regulation must be managed as an integral part of any corporate strategy. And the board of directors and management must recognize the scope and implications of laws and regulations that apply to the company. They must establish a compliance management system. Compliance management system. Compliance management system. There has to be a system in place to verify that the company is adhering to rules and regulations. And that's the role of the board. The board and the management as well must recognize the scope and implications of laws, the scope and implications of regulations that apply to the company. They must establish a compliance management system. And this compliance management system is a system that helps support the risk management system. Because when a compliance management system is put in place and there is a risk management system that is also put in place, that reduces compliance risk to a great extent. Compliance risk management, compliance risk candidates is the risk that the company or the risk that the company may face as a result of failing to adhere to regulations and laws. And to ensure an effective approach to compliance, the participation of senior management in development and the management of compliance program is necessary. They should review the effectiveness of its compliance management system at periodic intervals so as to ensure that it remains updated, so as to ensure that it remains relevant in terms of modifications, in terms of changes in the regulatory regime, including acts, rules, regulations, and so on. And also due to changes in the business environment. Compliance what? Obligation. So in today's lesson, candidates, we will study the approaches of compliance. We are going to study 3 approaches or aspects of compliance. Aspects of compliance. The first aspect is legal compliance. The second aspect is corporate compliance. Legal compliance, corporate compliance, and also the third one is regulatory compliance. Regulatory what? Regulatory compliance. 3 aspects. Now, legal compliance, candidates, is the process of or the procedure to is the process or the procedure to ensure that the procedure that the company puts in place to ensure that the organization follows relevant laws, relevant regulations, relevant business rules, and so on. Legal compliance, I repeat, is the process or the procedure to ensure that an organization follows relevant laws, regulations, and business rules. Okay? Failure to which will failure to ensuring that the company complies to laws and regulations and business rules, then there is that what we call a compliance risk. All right? There has to be an approach or a process through which the organization checks or verifies that the company is obeying or adhering to regulations, adhering to laws, adhering to business rules. And there are two requirements for an enterprise to be compliant with the law. That is we may have the policies, all right, the organization's policies, and that need to be consistent with the law. Then we also have its policies that need to complete with the respect to law. So there are two aspects. The policies that ought to be aligned with the law, and also its policies that need to be complete with respect to the law. So the role of legal compliance has also been expanded to include self-monitoring. To include what? To include self-monitoring and the monitoring of the non-governed behavior. And that is mostly in respect to industries and also corporations that could lead to workplace indiscretions. So there are certain aspects that are not regulated, but which could lead to risks. The organization should ensure that such areas are also looked into. So the role of legal compliance, I'm saying, has been expanded not only to laws, explicit laws, but also the non-governed areas with the industry and corporations that could lead to problems at the workplace. And it is also important to keep in mind that if a strong legal governance component is in place, then risk can be accurately assessed and the monitoring of legal compliance can be carried out efficiently. And therefore, companies today are challenged to comply with laws and regulations while also increasing shareholder value and protecting the brand of the company. Legal compliance with laws, regulations, and business rules, now expanded to cover areas that are not regulated. Then there is corporate compliance, corporate compliance. Now, corporate compliance program, on the other hand, is generally defined as a formal program specifying an organization's policies, procedures, and actions within a process to help prevent and detect violations of laws and regulations. So this is limited to a certain process within the organization. And it goes beyond a corporate code of conduct, since it is an operational program. It's not just a code of conduct. No, it is a program. It is a program. It could be a program that is used in carrying out a certain operation, or what we can just call an operational program. It's not just adhering to a code of expected ethical behavior, no. Because clearly, candidates, a code of conduct is an important component of compliance program and ethics, which remains the heart and the soul of all corporate compliance programs. However, a comprehensive program goes further by applying the code to the specific risks of organizations and also integrating measures to address those risks. So a more integrated approach also focuses on legal as well as internal compliance to mitigate the risks of fraud, to mitigate areas to do with strategy, operations, the financial reporting objectives, and so on. So a corporate compliance program is a magnet that brings all of a company's regulatory and internal compliance requirements, as well as a roadmap to action. A roadmap to what? To action. It is a comprehensive program that helps position a company to divert disasters, to meet objectives, and grow shareholder value. Corporate compliance. Then the other aspect of compliance is a regulatory compliance. Regulatory compliance. Now, candidates, regulatory compliance is an organization's adherence to laws, regulations, guidelines, and specifications that are relevant to its business. And violations of regulatory compliance regulations often result into what we call legal punishment, including penalties, including fines, and such like. So regulatory compliance has become more prominent in a variety of organizations today. And we have seen the trend towards creation of positions within the company, like the chief regulatory compliance officer. Such a position is used to hire employees whose sole focus is to make sure that the organization conforms to stringent, complex legal mandates. So regulatory compliance varies not only by industry, but also by location. And the financial, the research, the regulatory structures in one country, for example, may be similar, but with particular difference in another country. So there could be similarities and differences, which often lead to changing of objectives, changing of requirements in different countries, in different industries, and also different policy contexts. So regulatory compliance, we have bodies that regulate the conduct of companies, like the stock exchanges. They have regulations. We have capital markets authorities. They regulate certain industries. So each industry could have some bodies that put in place measures or laws that companies within that industry should adhere to. Legal compliance, on the other hand, mainly these are laws that are put in place by the government through statutes, statutory instruments, and so on. So these are three major aspects of compliance: legal compliance, corporate compliance, and regulatory compliance. So that will mark the end of the lesson. I'm going to give you one question. Explain assignment. Explain the following aspects of compliance in the context of corporate governance. A, legal compliance. B, corporate compliance. C, regulatory compliance. Thank you for attending our today's session. Bye-bye. Hello and welcome to the lesson. The subject is Introduction to Law and Governance. We continue with the topic Introduction to Corporate Governance. In our previous sessions, we defined corporate governance as the way in which corporations are controlled and managed and also directed. In today's lesson, we will study the role of stakeholders in corporate governance, the role of stakeholders in corporate governance. Candidates, we know that organizations cannot achieve their intended objectives without involvement of various stakeholders. For a company to achieve its objectives, then it requires the input of various stakeholders like the shareholders, the management, the employees, the suppliers, the customers, the government, and so on. In today's session, we are going to study roles of stakeholders, specifically the shareholders, the directors, and the government. We will restrict our study to three stakeholders. Number one, the shareholders. Number two, the board of directors, and the government. Let's begin with the shareholders. What is the role of shareholders in corporate governance? What is the role of shareholders in corporate governance? Now, candidates, shareholders of a company, both jointly and severally, are expected to protect, preserve, and actively exercise the supreme authority of the company in general meetings. The voice of the shareholders, as far as corporate matters are concerned, is to be expressed in the general meetings. They have a duty jointly and severally to exercise supreme authority, because shareholders are the owners of the company. Shareholders appoint the directors to run the affairs of the company on their behalf. So they have certain duties to perform in relation to corporate governance, which is said corporate governance is a way in which corporations are managed and directed. So what is the role of the shareholders in directing and managing a corporation? Number one, shareholders have a role to ensure that the directors who are appointed are persons that are competent and reliable, persons who can add value to the company when elected or appointed. So directors or the board of directors is a group of individuals who are appointed by the shareholders. So that is the first important role of the shareholders, to appoint the board of directors. And when appointing board of directors, the board should comprise of individuals who are competent and reliable. So when appointing the directors, the shareholders ought to ensure that the individuals who they are putting in office are people who will discharge their functions as required. They ensure that only competent and reliable persons are appointed. So their role is to ensure only competent and reliable persons or individuals are appointed to the board. To ensure only competent and reliable persons are appointed to the board. That is supreme authority of the shareholders to ensure only competent. Competent means persons who have the required skills, persons who have the required experience. So when appointing these board of directors, they should be persons that have the relevant skills, relevant traits to discharge the functions of a director on a board. Now, the second role of shareholders in corporate governance is to ensure that the board of directors is constantly held accountable. To ensure that the board of directors are constantly held accountable, because they ought to account their responsibilities to the board. So the shareholders should ensure that the board of directors are constantly held accountable. They are constantly held responsible for the efficient and effective governance of the company. All right? Held accountable and responsible for the effective and efficient governance, right, of the company. Efficient corporate governance of the company. Corporate governance of the company. So the shareholders should ensure the board of directors are constantly held accountable and responsible for the efficient and effective corporate governance of the company. All right? What is the third role of shareholders in corporate governance? Is to change the composition of the board of directors that do not perform to expectation. Where the shareholders have appointed the board and the board is not discharging its functions as required, then the shareholders have a role to change the composition of the board of directors. To change the composition of the board of directors. To change the composition of the board of directors that does not perform to expectation. All right? That does not perform, because when the board of directors are appointed, there are certain expectations. They have certain duties that they need to perform. They have certain responsibilities. When they do not perform to the expectation of the company or the board of directors, or to the expectation or in accordance with the mandate of the corporation, then the shareholders have a duty to ensure that they are removed from the board. Where directors are not performing or discharging their functions as they ought to discharge their functions, the shareholders have the duty to ensure that they are removed from the board so that more competent and reliable directors are appointed. Confidentiality is another role. Confidentiality. Shareholders, candidates in a limited liability company are obligated to protect and maintain the confidentiality of company secrets. Shareholders of a company, by virtue of their position, may or will come into contact, will have access to certain information that may be considered secret, company secret. And such information should not be disclosed to third parties. And therefore, the shareholders have a role to maintain confidentiality. They are obligated to protect and maintain the confidentiality of company secrets. Now let's move on to the second stakeholder. The first stakeholder is the shareholders. The second stakeholder is the board of directors. 2, what is the role of board of directors in corporate governance? Now, the board of directors exercise all the powers of the company subject to the limitations contained in the law and the memorandum and articles of association. That means that the powers or the duties or the responsibilities of the board of directors is limited to what the law says, is limited to what is contained in the memorandum and articles of association. And therefore, one of the roles of directors in relation to corporate governance, number 1, is that they exercise leadership enterprise. Exercise leadership. Board of directors exercise leadership. They do what? They exercise leadership. They are also expected to make sound judgments in directing the corporation so as to achieve continuing prosperity and to act in the best interest of the enterprise while respecting the principles of transparency and accountability. They exercise leadership, they act, they make sound judgments, and when exercising leadership, they're supposed to exhibit high levels of integrity, because these are individuals who've been entrusted with the duty to steer the company to prosperity. So exercise leadership. The second role of board of directors in corporate governance is to ensure that through a managed and effective process, board appointments are made that provide a mix of proficient directors, each of whom is able to add value and bring independent judgment to bear on the decision of the company. Independent judgment. They have a role to bring independent judgment. The board of directors exercises its functions through board meetings. When decisions are to be made, the board sits, and therefore, the directors who sit on the board are expected to bring independent judgment, which is expected to bear on the decision-making process. Independent judgment is a judgment that should be objective. Judgment should not be biased. Judgment that is in the best interest of the company. Judgment that is free of conflict of interest. The third role of board of directors in relation to corporate governance is to determine the corporation's purpose and values. Determine the corporation's purposes and value. To determine the corporation's purpose and value, to determine the strategy to achieve its purpose and also to implement its values in order to ensure it to ensure that it survives and thrives, and ensures that procedures and practices are in place that protect the corporation's assets and the reputation of the corporation, to determine the corporation's value, to determine the corporation's purposes, and to ensure that there is a strategy in place for implementation of the purposes and the values of the company. To monitor and do what? And implement. To monitor and implement. To monitor and evaluate the implementation of strategies. Monitor and evaluate implementation of strategies. First of all, the board envisions. The board envisions or comes up with the what we call a picture of what the company should be in future. The board determines the strategic direction of the company. The board develops strategies, and then the strategies are to be implemented by the management on day-to-day basis. So they come up with a vision of the company, where the company ought to be and all that. They come up with strategies, but the implementation is carried out by the management. And therefore, the board of directors has a role to monitor and evaluate the implementation of strategies. Okay? To do what? To monitor and evaluate the implementation of strategies, the implementation of policies, and management performance. Policies and management performance. These directors are monitored by shareholders, and these directors monitor the management. So it's a very key role that the board of directors plays in corporate management, that one of evaluating the implementing of strategies, policies, and also evaluating the performance of management. Number 5, the board of directors should also ensure that the company complies with various laws to ensure compliance to various laws, regulations, and so on. Ensure that the corporation complies with all relevant laws, regulations, codes of best practices, and so on. Regulations, codes of best practice, like the one we are studying. We are studying the code of corporate governance, which is a set of guidelines on how corporations are to be managed. So the board of directors should ensure that the company complies with the laws. These are laws that are put in place by the government, the acts of parliament, the taxation laws. There are also regulations that are put in place, like authorities like the capital markets authorities, the securities exchanges, and also the codes of best practice. The board ensures compliance to such laws. The next role of directors in corporate governance is to ensure that the corporation communicates with shareholders. The corporation communicates. Is to ensure the corporation communicates with stakeholders. to ensure that the corporation communicates with the stakeholders and the shareholders and stakeholders effectively. Effectively. There ought to be communication. The company is required to communicate with all the stakeholders, the government, the shareholders, the financiers, the customers, and all that. There has to be proper communication because candidates, we know that the company cannot achieve or attain its objectives without the input of different stakeholders. Number 7, the board of directors serves the legal interests of the shareholders. That's another role of the board of directors, to serve the legal or the legitimate interest of the shareholders and the corporation, and also to account to them fully. Serves the legitimate, let me use the word legitimate, to serve the legitimate interest of the shareholders. They have a role to do what? To serve the legitimate interest of the shareholders. So these are seven roles. Let me add another one, 8. Regularly review processes and procedures. Board of directors have a role to regularly review processes and procedures. And why should the board regularly review and review processes and procedures? So that the board can ensure effectiveness of its internal systems of control, so that decision-making capability and the accuracy of its reporting and financial results are maintained at a high level at all times. So the processes and procedures of the company ought to be regularly reviewed by the board of directors. Number 9, appoint the CEO, Chief Executive Officer. It is the role of the board of directors to do what? To appoint the Chief Executive Officer of the company. And they should at least also participate in the appointment of senior management to ensure that the motivation and protection of intellectual capital intrinsic to the corporation. Remember, candidates, corporate governance refers to the way in which an organization is managed and directed. The chief executive officer of a company plays a key role in proper management of a company. The chief executive officer is the one who is in charge of the day-to-day operations of a company. Then, if that be the case, then the board of directors should be responsible for the appointment of such an individual. Of course, we have seen here that the board of directors develops strategy, policies that the company ought to be guided with in the process of discharging its function. They develop strategies. They give strategic direction. But the day-to-day operations of the company are left in the hands of the CEO. So this CEO ought to be a person who has the required skills, the required expertise, the necessary experience in order to steer the company to the desired end. And therefore, the board of directors should appoint the chief executive officer. And we know the chief executive officer does not work as an individual. No, there's a team of management, the management team. So the board of directors should at least participate in the appointment of senior management to ensure the motivation and protection of intellectual capital that is intrinsic to the corporation. So that is appointment, but that's not enough. The board of directors should ensure that this team of managers, these senior managers, are continuously trained. They should have continuous training, continuous training, so that they discharge their functions effectively. Appointment of the CEO and the senior management. So we can go on and on, candidates, and mention roles like that are related to technology. We can say that the board of directors ensures that technology and systems used in corporations are adequate to properly run the business. All right? So that such technology can help the company to maintain what we call competitive edge. The board of directors, you can also say that has a role in relation to risk. The board of directors have a role to identify key risk areas. Identify key risk areas. Identify key risk areas. Identify the key risk areas and also the key performance indicators and key performance indicators. Key performance indicators of the business. And the board should not just identify, but should also do what we call monitoring. They should monitor the key performance indicators of the company. Yet another role is in relation to going concern. Going what? Concern. The board of directors should ensure annually that the corporation will survive, the corporation will thrive, and the corporation will continue as a viable going concern. As what? As a viable going concern. So these are 13 roles of board of directors in corporate governance. We are going to discuss the last stakeholder, C, the government. The first role that the government plays is legislative and regulatory. Now, government through parliament makes public policy, it legislates, and also makes what we call statutory instruments. The government creates a conducive environment for business to operate. The government regulates and comes up with what we call the statutory frameworks. And the government, through the courts, also interprets and enforces the legislation that is done through the courts or the judiciary and other national enforcement agencies. So legislative and regulatory role. Government through parliament, I've said, makes legislation, makes statutory instruments. The government creates a conducive environment for business to operate, and through making regulatory and statutory frameworks, the government can also the interpretation And the enforcement of legislation is done by the courts and other national enforcement agencies like the Kenya Police and other such bodies. So legislation ensures fairness, legislation ensures a level playing field, legislation ensures transparency in business dealings, and that is very important. It's an important tenet of corporate governance. Transparency, disclosure and transparency is a key component, is a key tenet of good corporate governance. Through legislation, we know the government can, for example, determine what kind of financial records are to be published, right? We know candidates that the company law provides for the financial statements that the public limited companies ought to make public, to disclose. That's a legal requirement. And transparency and disclosure, those are important tenets of good corporate governance. So the first role is legislative and regulatory. To legislate and to regulate. And by legislating and regulating, the government creates a conducive environment for business to operate. Is that clear, candidates? The second role of government in corporate governance is a monitoring role. Monitoring. Monitoring what? Monitoring. The government ensures that there is fair play in business through monitoring. How does that happen? The government oversees and monitors organizations such as the Securities Exchange Commission, the Stock Exchange, and other financial institutions. Another role that the government plays is an overall role, or what we can call an overarching role. The government provides an enabling environment within which the private sector can thrive. The government is responsible for example, for providing basic what I call basic security. The government, through the public law, maintains order. The government ensures the protection of private property. And it also has an obligation to protect the vulnerable members of the society. All right? Overarching role. Let me call it overarching role. The government has an overarching role. It provides the general basic security, it provides law, it provides order, it helps in the protection of property, and so on. The fourth important role that is played by the government is that one of solving disputes. Solving disputes, and when disputes are solved, then justice is ensured and ensures justice. And where there is justice, candidates, there is most likely to be peace. So the government helps to bring justice in corporate leaders. Because you know corporate leaders who are from time to time involved in scandals. The government does what? Solves disputes among the corporate leaders, disputes between companies, disputes that may arise because of financial scandals, because of fraud, and the government can also help gather enough evidence against the corporate leaders who are involved or who are involved in scandals. The government can gather enough incriminating evidence against such individuals, and that is a very important role in corporate governance. Justice. The government does what? Ensures justice. So these are 4 roles that are played by the government in corporate governance. And that will mark the end of our today's lesson, where we've discussed the role of stakeholders in corporate governance. The syllabus restricted us to study the 3 stakeholders, that is the shareholders, the board of directors, and the government. Today we have learned that the shareholders ensure only competent and reliable persons are appointed to the board. We also learned that shareholders ensures that the board of directors are constantly held accountable and responsible for the effective and efficient corporate governance of the company. Efficient, good corporate governance of the company. The third role played by shareholders is that they help change the composition of the board that does not perform to expectation. In case there are directors who sit on the board who do not perform their duties as expected, then the shareholders have a role to remove them from the board. There is also the role in relation to confidentiality. Shareholders are under obligation to maintain information that is considered secret. The company secret should be protected by the shareholders of the company. We went ahead in this lesson to discuss the role that is played by the board of directors in corporate governance. We saw that board of directors exercise leadership, they bring independent judgment, they determine the corporation's purpose and value, they monitor and evaluate implementation of strategies, policies, and management performance. The board of directors also ensures compliance to various laws, regulations, and calls of best practice. The board of directors communicates with stakeholders efficiently. Number 7, they serve the legitimate interest of the shareholders. Number 8, they regularly review processes and procedures. They also have a role to appoint the chief executive officer. And number 10, they identify key risk areas and key performance indicators. Then there is a role in relation to going concern. We've also discussed the role that the government plays in corporate governance. The first is the legislative role and regulatory role, the monitoring role, the overarching role, and the role of solving disputes and ensures justice. The government helps to bring justice in corporate leaders who are involved in scandals. Who are done what? Who are involved in scandals. So candidates, I'll leave you with an assignment based on what we have studied today. Discuss the role of the following stakeholders in corporate governance. A, shareholders. B, board of directors. C, the government. Thank you for taking time to attend today's lesson. When answering this question, close the notes, close the video. Try and see if you can recall what you have learned in today's lesson from your memory. God bless you. Bye-bye. Greetings and welcome back to the lesson. The subject is Introduction to Law and Governance. Today we're going to study the legal audit as a subtopic under the chapter on Introduction to Corporate Governance. In our last session we discussed the compliance obligations. Today we're moving on to legal audit. By the end of this lesson, you should be able to define legal audit, should also be able to explain the importance of or the objectives of legal audit. Legal audit. Remember, in our last session we said that compliance is the process of adhering to rules, regulations, and laws. We also mentioned that a company should put in place a system to monitor and check if the company is adhering